if this deal were to happen. And obviously, to them, there is that additional kicker coming in of the cash from the RCB stake sale as well. So all these factors and the underperformance on the stock working for it. But let's talk about the cables and wire space. That too has been buzzing for a while right now. Another bullish note coming in this morning, and this one's from Motilal Oswal. Upasana joins in with the details.
Well, Motilal Oswal has put the spotlight on cable and wire industry. It believes that the outperformance for this sector will continue as the sector is the key beneficiary of ongoing infrastructure expansion and even electrification drive that the company is witnessing. Now, cable and wire industry, the demand tailwinds are likely to remain intact over the long term as India's energy transmission remains one of the key growth driver for the sector. Hence, it has the higher growth visibility will drive the overall earning upgrades is what the brokerage believes. Now, coming to RR Kabel, here the brokerage has given a rating upgrade from neutral to buy with a target price of 2,600 per share. It has also raised the EPS estimates for Polycab by 8% and RR Kabel by 11% for FY27 to FY28. On the back of the strong revenue growth outlook, supported capacity expansions, market share gains and even margin expansion going ahead is what the brokerage has highlighted. Overall, it has maintained a buy rating on Polycab and KEI Industries. And when it comes to revenue CAGR growth, it believes that the Polycab will continue to deliver industry-leading growth of nearly 22% from FY26 to FY27, followed by RR Kabel and KEI Industry, which it estimates a CAGR of nearly 21%, and lastly, Havells at 14%. So all in all, certainly a bullish note coming from Motilal Oswal on cables and wires.
Thanks a lot for that, Upasana. Well, let's turn our attention to Vedanta Aluminium. And we have two brokerages that have come in there, and they have initiated coverage on Vedanta Aluminium. First up, Citi. They have initiated coverage post the demerger. They have a buy rating target price at 560. They say the company is their top India metals pick. The drivers include the positive aluminium outlook, the growth potential, both at Balco with regard to the expansion that's currently underway, and Vedanta Aluminium has, has the deep bottlenecking opportunity as well. Balco, remember, the listed entity has 51% stake in Balco. Next, on cost focus, they are citing the higher captive alumina, domestic bauxite and captive coal as well. That will help them on the cost side. They're expecting the company as well to be net cash positive by FY28. That's interesting because currently they're having a debt of close to around $3.5 billion odd. But what are they working with? They're incorporating aluminium prices for the next 2 years at around $3,400 per ton. That's a little bit higher than what current prices are. So they're clearly factoring in that the aluminium market will stay in a deficit. Inventories will get drawn down, which will drive up prices by around 15 to 20% is what they mentioned in their note. It could also move towards $4,000 on a per ton basis. So they're extremely positive, it seems, on the aluminium sector. And that's why they're bullish on Vedanta Aluminium as well. Moving to Kotak, they have initiated coverage, buy rating, target price, fair value they're saying is around 600 rupees. Factors that they're working with, the capacity additions underpin around a 6% volume growth over the next few years. So that's interesting because they are one of the few aluminium companies domestically that has capacity ready as they move from around 2.5 million to around 3 million tons odd. The integration benefits as well will flow in because of bauxite and coal mines as well. And that's why they are working with the cost of production falling by around $150 per ton. They believe that the aluminium market will be in a structural deficit, and that's why prices will remain elevated for longer, which in turn will support earnings. They also cite that the free cash flows will drive the deleveraging exercise and in turn reward shareholders. So put everything together, two brokerages, they are optimistic on the prospects of Vedanta Aluminium, and that's why they've initiated coverage with target prices much higher than current levels. We'll see how that goes.
All right, we take that point. Just a word on Calpis. Calpis is a brand in India, which Varun Beverages is currently going to introduce. It's a Japanese cultured milk beverage known for its sweet, tangy, and refreshing yogurt-like flavor. And this comes immediately after the company, in its recent approval with Pepsi, said that they are looking at beverages outside of PepsiCo's fold as well. So this just adds a little more to their overall portfolio of beverages. The stock has been doing well, also aided by a longish summer this time around. So all these factors doing well for them. This is just the first of the many that the street was expecting coming in from the non-Pepsi part of the portfolio. Calpis, a Japanese-based fermented milk-based beverage. How does that taste? Whether we are interested in it or not, that's for Nigel and me to discuss in the short break that we will take right now, because we are out of time on this edition of Chartbusters. But you stay tuned. The team of Trading Hour takes the market action forward.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormis Fatakia. Joining me as always, Ritu Singh. Well, it's been a quiet day for the market so far, and well, unsurprisingly so, considering the fact that we have recovered almost 1,000 points from last week's lows of 23,070. So we have recovered significantly in the last 4 to 5 trading sessions on the index, and therefore taking a bit of a breather in today's trading session after that 4-day rally that we have seen that started on Friday afternoon. Similar sort of price action playing out on the banking stocks as well. No significant moves there, other than of course the fact that today being the Sensex weekly expiry, it brings along with it its fair share of volatility. The banking stocks are outperforming, yes, but that is of course not contributing to gains on the index as of now. 170 points higher, so the Nifty bank is headed towards the higher end of that range of 57,000 to 58,000. That's doing well, and there you can see the contributors as well. HDFC Bank, SBI, all of them doing fairly well for themselves. Ritu, hi, morning.
Good morning, Hormaz. Yes, pretty volatile on account of that expiry. That's playing out. But at least you had the frontline index holding up, above that 24,000 mark. And that's what the bulls would be hoping. The next, of course, hurdle would be the 100-day average. That is about 24,231. So we'll see if we get there. But for now, holding up mildly in the red as we speak for the Nifty and back again in the green. The advance decline ratio also, tells you there's just about one stock that's advancing, for about 1185. 1791 stocks that are advancing for about 1185 stocks that are declining on the National Stock Exchange. Looking a bit even Steven there. Those lines look like they might be converging. So we'll have to see how that plays out. The macros are looking good. Oil is below $78 a barrel. That's looking good as well. The bank Nifty, like you said, holding up. The broader markets are doing relatively better. The IT pack also seeing a bit of red. But Hormaz, as always, has walked over to the wall to give you the list of stocks to keep your eye out on. Hormaz, over to you.
We are a couple of hours into the trading session and the index has gone absolutely nowhere other than the topsy-turvy moves that we are seeing. A positive macro indicator is the fact that oil prices are down, yes, and they continue to remain sub 80. In fact, now they are sub 78 as we speak on Brent. So they've given up almost everything that they had gained during the war starting March. And the dollar, though, that is the one that's you need to watch out for. It's strengthened significantly after the Fed policy last night from levels of around 100.4, it's down to around 100.2, but still above the mark of 100. The big event from last night was the fact that NSE filed its DRHP for its IPO, and New India Assurance is one name among the selling shareholders that's expecting a big windfall, 13.5% higher. Of course, it's been a big underperformer as well, still 50% below its IPO price. IFCI seeing some profit booking. Of course, it has had its run in anticipation of the fact that the NSE will be filing its DRHP, and LIC not among the selling shareholders in the IPO. They are going to stay put, and stock is up around 2.5%, although slightly off the highs of the day. You take a look at the newsmakers today. RR Kabel is doing well. On the lines of the wires and cables companies received an upgrade today from Motilal Oswal, 6% higher from the stock. The 6% higher for Nykaa as well. It just put out its investor presentation a couple of minutes ago, and that's doing well. Reddington on reports of Apple hiking product prices. So that's led to a 5% up move here. And Anthem Biosciences, after a block deal that took place earlier in the day, the stock is up around 4%. Defense stocks were doing well yesterday. They continue to do well today as well. MTAR Tech made a new record high in today's trading session of around 85.75. So that's up 2% as well. Zen Technologies, Acres, Solar Industries, all of them continuing to add on to their initial gains. The big India-UK FTA, which comes into effect soon, has seen a positive reaction on a lot of these textile companies. Gokaldas, Wellspun Living, both up around 4%. What's also up 4.5% is United Spirits. And lastly, the volume-led movers in today's session. Take a look at the move seen in CDSL. The stock is up in 4 out of the last 5 trading sessions. So from around 1150, 1160 odd, the stock has moved to 1400 in just 5 sessions. Star Health and Carborundum too seeing healthy gains on very strong volumes, Ritu.
Okay, Hormaz, thank you very much for running us through that list. Another stock in focus is Shyam Metallics. That's up about more than 3% in trade today, buzzing on the back of their FY31 targets that the company has released. Nigel D'Souza is here to put that into perspective. Nigel, what kind of commentary is coming in from Shyam Metallics?
Well, Shyam Metallics had their investor meet here in Mumbai, just yesterday, and they've laid out a very ambitious 2031 target. Let me run you through a few details. They're talking about revenues at around 42,650 crores. The EBITDA number they're talking about is around 6,236 crores. Very, very ambitious if you just look at what they've done and where they believe they're headed. Now, in terms of return ratios, they're going to maintain it healthy at around 20% to around 22%. They also say that the net cash positive number will continue, and the entire focus is going to be on value downstream products. And that's why the EBITDA number in various segments are going to balloon up. A lot of focus is on stainless steel, and from around 77 crores, they're talking about 1,100 crores by 2031. That's extremely ambitious. Now, on carbon steel, from around 1,700 crores, which is bulk of the EBITDA right now, they're saying it moves closer to around 2,866 crores. On special bar quality steel, that's going to move to around 1,019 crores or thereabouts. So that's broadly the breakdown in terms of the EBITDA number. For this, there'll obviously be a capex. They have highlighted that around $1.1 billion of capex will be deployed over the next 4 to around 5 years, which will be funded by internal accruals, and there'll be no external debt. Let's see how that goes, because that's a very ambitious number. The past record was pretty good. In the last 20 years, on a far lower base, they have compounded their EBITDA, their revenue, as well as PAT at around 20% CAGR. But from this base, it'll be interesting to see whether or not they can go the distance. Jefferies, one of the brokerages that were positive, they're even more positive. They have a buy rating. The target price, they've upped to around 1,150 from around 1,040 earlier. What are they factoring in? EBITDA and EPS to compound at around 14 to 16% over the next 3 years. They believe the company is offering one of the best growth potential in India metals. So that's why they're optimistic. Stock as well, reacting positively.
Nigel, thank you for that. But stay on because the street wants to hear more from you, this time around from Kirloskar Ferris. And that's a $13.5 million order that the company has won. 9.5% higher on that one.
Well, that's right. Kirloskar Ferris, that stock is buzzing in today's trading session. They have bagged an order, which is not very large in size, but it's clearly an effective one from the street's perspective. Remember, the stock, though, had corrected close to 25% from its 52-week high. So it appears it's recouping some of that lost ground. What's the news piece? They've received a contract for the supply of pig iron. The buyer, well, they has an office in London, UK. The order details, well, quite interesting. 30,000 tons of basic grade pig iron on FOB basis. Contract value around $13.5 million approximately, and the latest shipment will need to be completed by the 15th of August. So around 30,000 tons is effectively around 4% of their entire pig iron volumes, which is ballpark around 7 lakh tons approximately. So not very large in size, but it appears the street is latching onto this. Maybe they see a bigger potential in the time to come as well with regard to exports, and probably that's the reason why the stock is excited on this not too large order.
Nigel, thanks very much for putting that into perspective. Another stock that is excited is Nykaa. That's buzzing on the back of the company's beauty and fashion segment targets for FY30 that they've presented in this Investor Day presentation. Manglam Malu is here to put all of that into perspective for us. Manglam.
Well, tall targets given by Nykaa in its Investor Day, and they've given targets for all the way up to FY30 as well. In fact, on an overall basis, they target nearly 50,000 crore plus gross merchandise value in both beauty and lifestyle businesses. And what do this mean for their overall business right now? For FY30, they expect the revenue from current levels to grow anywhere between 2 to 3 times. And were that to happen, the EBITDA would obviously grow a step faster, and they expect the EBITDA to either quadruple or grow 5 times over the next 3 years from FY26 levels as well, which would mean that the FY30 EBITDA margins would be anywhere between low to mid-teens, and this compares with the last year's number of close to around 7.5%. So they expect revenues to triple, EBITDA to go 4x, and margins to double from current levels as well. For the beauty segment, they target a GMV growth of anywhere between 2 to 3 times and healthy double-digit EBITDA margin. Remember, the last quarter exit numbers were closer to high single digits on the EBITDA. So they expect that to move to healthy double digits. And the retail footprint would expand from current levels to around 600 plus stores by FY30 as well. For fashion business, now this has been a bit of a drag on the profitability of the company. Broke even just in the last quarter. They expect that there would be high single digit EBITDA margin by FY30 with GMV growth target anywhere between 3 to 3.5 times, and steady state EBITDA margins, which is beyond FY30, they believe could cross that 10% mark as well. And some other highlights, House of Nykaa, which is basically their own brands, which did a net sales value of around 3,200 crores in FY26. They expect this portfolio to jump all the way up to over 5,000 crores by FY30. And Superstore, which is basically their B2B business, they expect to reach about 1 million stores in the country with a gross merchandise value target of nearly 3,500 crore plus. This number too was shy of 1,200 crores in FY26. So across the board, multiple, multifold jump is what we're seeing across all their parameters, and which is why the stock is up 5% now, despite being 5% higher yesterday, taking this weekly gain to double digits.
All right, some tall claims there. Let's see if the company makes good on them. Manglam, thanks very much for bringing that into perspective for us. The stock now up more than 6% as we speak. We'll take a short break, but up next, we're going to bring you all the action from the bond market with Manisha Gupta, so stay tuned.
Welcome back. As promised, we're shifting focus to the bond markets. Then Manisha Gupta is here with the latest. Manisha.
Thank you for that, Hormuz. Well, the Indian bond markets are facing a dual directional impact at this point in time. On one side, you have the US and Iran peace agreement. And on the other side, markets are dealing with the hawkish US interest rate outlook as well. So on one side, the decline in crude oil prices, which, by the way, have now declined below $78 a barrel as well. Our new 3-month lows on your screens is pulling domestic yields lower. But then on the other side, you have the hawkish US outlook, which is capping the domestic rally, as it were. Interestingly, you have the dollar index as well, which is now trading above 100. The markets are looking at the Indian rupee as well, which has been choppy, opened with a gain. But since then, we've seen banks also selling dollar for the exporters therein. The Iran nuclear program is something that the street will now watch out for the next 60 days. It's going to be a lot of back and forth, and the markets will look at the new US Fed statements coming in and during that period as well. So it's going to be a choppy market at best, is what the street believes. In the meanwhile, there are also better numbers coming into the Indian bond markets therein. There is a strong inflow that we've seen from FCNR deposits, which seems to be helping the bond markets, which are absorbing external shocks. And then you have foreign investors, which have injected to the tune of $2.2 billion into the domestic bond markets over the last 9 sessions itself. The corporate bond market, the trading there also has seen a volume surge as well, driven by, of course, lower digital entry barriers. And then retail and institutional overall trading volumes have gained up by a 30% on an year-on-year basis, to the tune of hitting a record number of 22.07 lakh crores therein. The larger corporations also are looking at fundraising. This is being done via the short-term debt instruments. So when you look at the overall number there as well, from 1st of April until 15th of June, the companies raised 4,39,000 crores via 1920 commercial papers issuances. So we're looking at stronger numbers coming back into the street right now.
Thanks very much, Manisha, for bringing us that. But let's stick with the bond space. And one of the most exciting corporate actions recently has been HDFC Bank, that has raised $750 million in offshore bonds that were priced at 90 basis points above the 5-year US Treasury at a coupon rate of 5.067% per annum. The bank becomes the first lender to take advantage of that 1.5% fixed swap that is provided by RBI for banks to raise money overseas. And it's the largest such deal by any Indian lender since SBI's $750 million bond in 2023. So let's bring in Arup Rakshit, Group Head of Treasury at HDFC Bank, for more on this one. Arup, thank you very much for joining us here on CNBC TV 18. You know, a very tight, just a 90 basis point spread over the 5-year US Treasury. Were you surprised by this kind of a reaction, given what's happening, with the global volatility? And, what is the takeaway? How do we read into this, into how, the India risk premium is being treated by, some of these investors overseas?
Thank you. Thank you for giving me this opportunity. No, I think we were not surprised. I mean, we were working with our partner banks, and they had guided us in how to go about it. And, it was a very successful bond raise, I must say, but surprise, no. I think, India has got one notch upgrade since we had hit the market last time. And I think there was only one bank who had come into the bond market after the upgrade scenario of India. So from that perspective, there's a supply side which will start now coming in. So we were quite happy with what we have got. Yes, it's a very tight pricing, and we have managed to get that. So it shows that India is still recognized well in the international markets, and obviously it has priced the name well also. The HDFC Bank name has also worked in this situation.
Well, Arup, $750 million raised. Let me just push and ask you if this is it, or will you come back in the market sometime in the near future to take advantage of RBI absorbing this hedging cost, and especially because the bank CD ratio has been high. There's been pressure on the deposit front. Some of this borrowing coming from overseas, will that ease some of that pressure as well?
Two things. You asked two questions. First, it's just 2 days, so let us first the money come in and things like that. So we did move quite fast, and our overall approach has always been that whenever there has been an opportunity in the international market, we have hit the market. If you see our track record in the last 5 years, that's how we have gone about. It's not a plan that every year will come or something like that. So if there are opportunities which exist, we have been opportunistic in that. Insofar, will it ease? Yes, so it will obviously ease the dollar rupee part of it, the weakness of the rupee which was coming. If this kind of a supply starts coming in, that will get eased out. There has been a gap between the deposit rate and the credit growth rate. So some amount of that will also get eased out once the FCNR deposit starts really picking up and coming on shore. So those are the positives which are likely to happen for the market.
Arut, the other repercussion is what is happening in the domestic bond market as well. I mean, every dollar that you raise overseas, and banks like you are huge borrowers in the CD market. That is one less rupee that is borrowed in the CD market. We've already seen the short-term rates fall by about 30, 50 basis points or so. We had, the Piramal Finance CEO earlier saying how it's a bit of a relief for NBFCs. Do you expect the short-term rates to trend lower given banks like yourself have tapped that market? More are expected to follow suit.
If you see the decent market, it has already come down ever since the announcement of RBI came through, including some of the CD rates have come down. But I think it's a question of the CD rates have also been a question of the demand supply between the credit offtake and the deposit side growth, so which has had a decent gap going into this the current fiscal. We have had a decent credit offtake which has also happened, and deposit growth has not really seen that kind of a growth. So that's where the bulk deposit rates and the CD rates have been a little high. Yes, we hope that if external supply starts coming in, some easing on those rates will happen. But there's also the hangover of the 10-year yield, which will continue to be a little on the right only, a little higher on the higher side only, because obviously the other things don't change. The SBL issuances and all will still remain. The easing out on the bond market, which has happened for the FPIs, where some amount of money has already started coming in, that should help ease out the bond yield also.
Arup, I don't know if you could help us with the FCNRB rates as well. The bank has priced them at about 6%, and I'm seeing some of your peers like Bank of Baroda, others price it at, Federal Bank as well, 6.25, 6.5%. And now, of course, you have RBI that has removed the cap on 3 to 5 year FCNRB, fresh bonds. Are you comfortable with the current rate? Could it be revised upwards because of RBI removing this cap? And is there an initial estimate or on how much the bank could raise through this window?
So from the rates perspective, I think every bank will be somewhere anchored on what the market is at. So yes, we were among the first ones to announce the rates. People have come with different rates, higher, lower, both sides. We will always be anchored on what the market is at. We don't want to be away from the market. So let's see how the market pans out on the rates. Yes, I know the RBI has removed the cap, but you'll also have to see that where I can deploy the funds. So that will also play out on what the rate is offered at. With regards to the amount, let's see, because last time, there is a history of last time how much money had come in. Obviously, things are a little different to last time. So let's see. I mean, I don't want to hazard a guess here how much money can come in. Not just for us, even for the country. Maybe a country that there have been talks in the market about a $40-50 billion from the market, from the country's perspective, through the FCNR route. Let's see. I mean, very early days. It's just about 10 days have elapsed since the circular has come out. People are figuring out the processes and everything, and every bank is in touch with customers. So let's give us some time to figure out how this pans out.
But, Arup, if I'm not wrong, you were one of the biggest beneficiaries in 2013 as well. You, along with SBI and ICICI Bank, of course, having a better overseas presence. Any ballpark figure you could give us? I mean, how much did you exactly raise last time? Could you top that?
I think last time we were almost over at 10% of what market had raised. I don't want to hazard a guess at this juncture because every bank has its own ways of doing business now. So that time there were a lot of fewer banks who had presence overseas. This time, many banks are there in the city. But yes, we are very hopeful we will be able to be among the top few banks only in this field. Let me not quote it.
Giving us a number, but Okay, not giving us a number, but we'll be among the top few banks that are able to raise some of the largest sums through this FCNRB window. Arup, thank you very much for taking the time out. I know you're pressed for time, so we'll let you go and hope to have you back perhaps later when you have clearer visibility on how much the bank is able to raise. Thanks very much.
Thank you. Thank you.
Okay, we'll slip into a break on that note, but when we return, we'll discuss market technicals with Rajesh Palvea of Axis Securities, also get his top trading bets.
Welcome back. Well, the markets have taken a bit of a leg down in just the last few minutes. The Nifty Bank, well, it is where it was at the start of the show, but the Nifty is down around 30 points. So still holding on to the levels of 24,000. The bulls would be hoping that this level or at least the base lower down at 23,900 or 23,800, that is one level that should sustain on a closing basis as we go into the second half of the weekly expiry session. A good time to get in Rajesh Palvea from Axis Securities for a quick chart check, some trading ideas as well. Rajesh, good morning. Thank you for joining in. Are you witnessing some exhaustion at that 24,150 level now that we have recovered almost 1,000 points from last week's lows? Your call on the index now and your trading ideas for the morning as well.
Yeah, hi, morning. So yeah, after a strong rally of almost 900,000 point from the recent low, Nifty is consolidating in range only. Though we have already registered a breakout about 24,000 level, but still follow-up buying action is still missing in the Nifty. Bank Nifty has also run up sharply in last couple of week, and here also we are seeing some sort of consolidation in Bank Nifty also. But overall, if we analyze the broader market, it clearly shows that there is a strength in the market, and the kind of stock specific buying action is taking place, which gives us confidence that maybe after a brief consolidation, we could see a breakout about 24,150, 24,200, and once that happen, I think this really can extend further, and possible target towards 24,500 to 600 we may witness in the coming weeks. So buy and accumulate would be the strategy. On the downside, 23,850 needs to keep as a stop loss. Until these levels are intact, I think buy on dips one can adopt as a strategy. On the stocks front, we are focusing here at capital market related theme. Lot many stocks have shown good accumulation in last couple of days, and there is a breakout took place. So Angel One is looking attractive. The way stock managed to give breakout of its multiple supply zone on weekly chart, we believe that this stock has potential to extend gain, and possible up move we may witness towards 385 to 390. So one can buy and accumulate. On the downside, 340 needs to keep as a stop loss. Another stock where we are focusing at this juncture is Amber Enterprises. Here also, since last couple of days, stock is making higher high low formation, and looking at the buying action in especially in last 2-3 trading session, which clearly showing that buyer's confidence is there in the stock, and near term chart is already registered a breakout. So projecting target of 8,250 to 8,300. On the downside, 7,880 needs to keep as a stop loss.
All right. Thank you very much for that. Appreciate your time here. And we just slip on, into a short break on that note. But up next, we'll get you Nikhil Khandelwal from Systematics Group, who will be here to give us more on market fundamentals and his views on some sectoral bets. Stay tuned. 24,064 on the Nifty. It's now in the red, down by about 21 points, led lower by the IT pack as well. The broader markets, though, still holding in the green, and the Bank Nifty trading with gains of about 200 points as we speak. But let's get in Nikhil Khandelwal from Systematics Group, who joins us now to discuss market fundamentals and his top sectoral picks. Nikhil, welcome. Thank you so much for your time here on CNBC TV 18. Let me first start with that, conference you recently concluded. There are 29 promoters that have made presentations, and you've come up with this detailed note on it. But, in a few lines, if you could sum up the mood from the conference for us, are corporates a tad more optimistic now, given that, the war in West Asia seems to be tempering down, oil prices are, looking better, cap expense picking up. What was the biggest takeaway?
Yeah, hi, good morning. No, so we had a very interesting event just a couple of days back. We invited companies which are primarily in the small and mid cap space from 5,000 crores to about 75,000 crores of market cap. Companies ranging from financials, capital markets, to manufacturing, consumption, healthcare, etc. The larger takeaway from the interactions with the companies was, everybody has seen probably the most difficult period of, logistical uncertainty, the overall inflationary environment heating up, unavailability of raw materials, etc., etc. Even the tariff scenario, which continued to play over the past 3 quarters, has played a lot of havoc on companies' supply chain. The companies are broadly covered ground from there and are looking at a market much more optimistically. Most of the companies across these 29 to 30 names spoke of volume growth of upwards of 15 to 18% in their business, whether they were wealth management firms, whether they were chemical manufacturers, etc. The second thing was that everybody's beginning to now look at this weekend signing of the peace agreement and potentially looking at a life beyond the West Asia war. So I think given all of that, there is a lot more optimism across most of the businesses. We believe that the cyclicals, companies which are more cyclical in nature and more prone to the inflation cooling down, are looking more stronger at this point of time in terms of their earnings expectations and visibility, while others are more optimistic given that a lower inflation will help cool down will actually bring a lot of consumption thrust in the Indian economy.
In that light, Nikhil, which are the areas that you have put money to work with during the war period as well, and now with this uncertainty coming to an end, and as you mentioned, looking at a life beyond the war, are you making any tweaks to your investments that you have made recently?
No, so I think we've been consistent on investment in certain sectors, which we believe that a war or no war, I think they would be areas which will continue to show sustainable growth. So we have been quite positive in our weightage on the larger manufacturing space in India, whether it's the capital goods manufacturing, whether it's the electronics manufacturing, or even certain export-oriented businesses like textile manufacturing. We have been quite positive on that space in general, because what we have seen that the China plus one and the Europe plus one theme has continued to play to the advantage of Indian manufacturers, whoever are in export-oriented businesses. And in general, the India's power and capital goods manufacturing theme will continue to play strong. So I think that sector and that weightage for us in that space remains quite strong. However, given the last a week or so of developments, we believe that a significant amount of weightage we are now bringing back into cyclicals, and we believe that a lower oil is not just a reduction in inflation; it is also a potential sign of strengthening in rupee. It can also lead to a lower interest rate environment in the mid to long run. So given all of that, we have started to become quite overweight on financials as a space. We believe that the larger banks will be the first big beneficiaries of the next 6 to 12 months as inflation, rupee, and the interest rate environment cools off. So the larger banks becomes a big overweight position for us, led by the ICICIs and SBI in particular. Cap goods and manufacturing space, which I spoke about, I think across the board, whether it's defense, whether it's power, or it's railways, or textile products. I think across the theme, we like a lot of large to mid-sized companies and believe that they will continue to be a strong play going forward. So I think these are the two top most weighted ideas and investment themes as far as our house is concerned.
All right, Nikhil, thank you very much for laying that out for us. Out of time, and hopefully hope to get you back later for more on your views. Thanks very much for being here today. We'll take a short break. When we return, more on the markets in just a bit. Well, high valuations in the Indian market have been a concern for domestic and international investors alike. But do higher valuations also imply underperformance? Now, according to a Jefferies note, multiple sectors have seen strong returns in the last few years despite valuations being high. Hormas puts the spotlight on the takeaways from there. Hormas.
There's a very interesting note from Jefferies. Usually you would say that, oh, expensive valuations means there is a cause of concern for a lot of these companies. But Jefferies has highlighted eight examples in the last 15 years where they have said that in instances like those, valuations may have surged to those quote-unquote expensive levels. But despite that, a lot of these stocks and sectors have delivered strong returns over the next 2 to 3 years. Now, which are those sectors that they have highlighted? Defense, NBFC, cement, FMCG, retail, capital goods, hospitals, hotels. And this is over a period of the last 15 years where Jefferies has analyzed all of these sectors across different periods. Look at defense. They analyzed this between September of 2022 to July 2024. By September 2022, the defense sector had a PE of 41 times, which was 41% higher than its 10-year average. Despite that, by July of 2024, the entire sector had outperformed the Nifty by a whopping 229%. And that was led by a 33% EPS CAGR as well. Now, what led to this outperformance? The strong indigenization push, order visibility, improves import substitution, all of that contributed to this outperformance on the defense companies. Look at the NBFCs as well. Now, come October of 2021, their PE was 78% higher than their historical 10-year average, but yet they managed to outperform the Nifty by 40%, led by a 23% EPS CAGR as well. Now, what led to their outperformance? It was the rising credit penetration, the improved asset quality after the IL&FS saga that took place, and scalable digital models as well. All of them contributed to that growth. Cement was one such sector as well. By June of 2014, their PE multiples had risen to 74% or higher than their 10-year historical average, yet they outperformed the Nifty by 47% by May of 2017. But this is possibly the only sector where the earnings growth has been subdued as a 7% EPS CAGR, and that was on the back of hopes of an infrastructure and construction upcycle during this period. The FMCG at one point was the darling of the street during that 5-year period between 2014 and 2019. And that time their PE multiples were higher by 44% than their 10-year average, yet they outperformed the Nifty by almost double, and it was a 12% EPS CAGR as well. And that was led by the formalization of the economy, the GST-led shift to organized players, and of course, mind you, all of this is excluding ITC, the numbers that you just saw. Retail as a segment also did very well between December of 2019 to September of 2024. Their PE multiples were 41% higher than their 10-year average as well by December of 2019, yet they outperformed the Nifty by almost 2.5 times and an EPS CAGR of 20%. Here too, it was formalization and premiumization that led the outperformance along with the rising discretionary spends. Capital goods as a sector was first getting re-rated between September of 22 to June of 24, and here too the outperformance of the Nifty was 90% despite their valuations being 28% higher than their 10-year average. The contributing factors here were the investment cycle revival after COVID-19, strong order inflows, better margins, all of them were there in place. Hospitals as a sector also did very well over this 4-year period between December of 21 to October of 25, outperforming the Nifty by 85%, a 23% earnings CAGR, and this is despite their valuations being 44% higher than their 10-year average. And this was, of course, because of the rising insurance penetration, operating leverage, and their improving operating revenue per bed. Now, all of these are prior examples, and now they are saying that the power sector is heading into a similar theory of higher valuations, but they might go on to outperform. Why is that so? The supply and demand side drivers are aligning, and therefore the power stocks are among the best structural plays to play this strong demand visibility. Additionally, there are improved balance sheets of the state electricity boards, and of course, the rising data center demand that is proving to be a positive as well. Among the top picks within this space, Jefferies has highlighted JSW Energy, Adani Energy Solutions, Premier Energies, and Siemens Energy. They've highlighted the fact that expensive valuations may not necessarily mean underperformance. They've highlighted prior examples as well, and power is now heading into a similar theme as well. And with that, we head into a short break. Back with more on the markets on the other side.
Well, let's get you the macro signal for the markets, holding up above 24,000, but still in the red. Crude oil prices, they've tumbled today. That's been the big macro story following the signing of this initial peace agreement between the United States and Iran. Both the benchmarks are down by more than 1%. The Brent crude now trading below $78, in fact, $77.35 a barrel now. It's been a massive retreat from the highs of, just over $100 we saw a few weeks ago. The rupee has seen some volatility, but it is now trading at about 94.25 against the dollar, again helped by these lower oil prices, although the US Fed keeping interest rates steady, officials signaling a potential rate hike later this year. This hawkish tilt did boost the US dollar index, and that did add some pressure on all emerging market currencies, including the rupee. But the rupee is appreciated for several consecutive sessions now from the record lows that we saw earlier. But beyond the oil prices, what's also supporting it today is signs of renewed interest from foreign investors, that were buyers in equities. The 10-year benchmark, G-Sec yields, they're also tracking this surprisingly hawkish signal coming from the US Federal Reserve. But that upward pressure on the yields has been tempered to some extent by the falling crude prices. As a result, the 10-year is now trading at slightly lower 6.86 as we speak. So that's the macro signal for the day. And on that note, Hormaz and I will take your leave on this edition of Trading Hour. But stay with us. Halftime report will be up next shortly.
Stocks trade steady after US-Iran ink a peace agreement, even as US Federal Reserve strikes a hawkish tone. Healthcare and financials notch some gains, while IT and utilities drag.
NSE files its draft offer document with SEBI revealing 10 shareholders will sell near 6% equity. The likely over 30,000 crore rupees offer will not just rake in profits for the sellers but can now draw in crucial foreign portfolio money.
Stocks of textile exporters climb after July 15th is fixed as the effective day for the India-UK FTA, and EU promises to ink its FTA by year-end. Indian exporters to UK will see tariffs drop to zero, while imports of spirits by the likes of Diageo-owned United Spirits will get cheaper.
Brent crude oil slides below $78 a barrel after Trump signs the deal with Iran ahead of the Friday schedule. The move aimed to opening the Strait of Hormuz quicker could see 60 oil vessels with 120 million barrels sail through.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Ekta Batra and Vinny Motiwala. Girls, good afternoon. Consolidation, that's the name of the game today. Absolutely flat on the Nifty, but yes, there is some negative bias that we are seeing below that 24,100 mark. We've come up from the highs of the day. The high today was 24,180 and we've seen a sharp fall from those levels. But again, there is a recovery which is underway. Whether that's sustains or not is the question that we're asking, but for now a recovery nonetheless. We do have mid caps which are trading in the green, but again it's a flattish move on that index as well. PSU banking index, that's the top gainer, contributing to the gains that we are seeing from the lows. Bank Nifty is also recovering, and the recovery that we are seeing on the Nifty is on the back of that as well. IT continues to sulk, so that's the top sectoral loser. We do have the auto index also, which is not doing so well, but overall I would say for now consolidating despite the peace deal agreement being signed as well. For the recovery that has come by, the question is whether that sustains or not.
Absolutely. Whether that sustains or not is something key. 24,000 as of now is what the Nifty is managing to hold on to. An advance decline ratio today a bit more in the favor of declines versus advances, what we're seeing. So yes, that's what we'll watch out for in the trading session. Apart from that, a lot of individual movers also in trade. You have New India Assurance that's managing to hold on to gains. Star Health also managing to hold on to gains. So that's something that we'll keep an eye out on. As of now, the convergence of the advance decline ratio is nearing, but that's something that we'll keep an eye out on.
Hi girls, yes, absolutely. It is a day of consolidation definitely for the markets at this point in time. But what stands out is that there are around 139 stocks which are at fresh 52-week highs in today's trading session, and around 28 stocks which are at fresh 52-week lows. So just want to point out that a couple of stocks which are at fresh 52-week highs include the entire banking space. So do watch out for that. We have Federal Bank, J&K Bank, Bank of Maharashtra, all of these stocks which are at fresh 52-week highs, along with the likes of Angel One as well as HCC. So all of these stocks are doing well today. Otherwise, Bajaj, Consumer, Bharat Forge, all of these stocks are now sitting at fresh 52-week highs in today's trading session. So really, you have to dig a little deeper and you will find those stocks which are creating some amount of wealth and value in this market. But let's concentrate on our What's Trending segment today. We're focusing on the UK-India Free Trade Agreement. First, we have Devyani, who's breaking down the impact on India's textile sector. And later we have Mangalam, who's decoding what changes in the alco beverage space. So Devyani, over to you.
Well, India's textile exporters are gearing up for a major structural tailwind that's coming their way, the FTAs. The India-UK FTA will be coming into effect from the 15th of July onwards, which means that it will eliminate 8 to 12% of import duties on textiles and garments that we're currently paying, opening up a $28 billion UK market for us, where we currently just export about $1.5 billion. Now, it's not just the UK. The proposed India-EU FTA could also provide duty-free access to us to a $260 billion market, where India already exports about a $5 billion worth of textiles, and that's expected to be signed by the end of this year. Now, the big benefit, India closes the tariff gap with Bangladesh, Cambodia and Vietnam, improving competitiveness in key markets such as ready-made garments, home textiles and carpets. Now, analysts expect a 5% market share improvement in the UK over the next 2 years and a potential 50 to 100% jump in exports to Europe over the next 5 to 7 years post the FTA signing. Now, the key stocks to watch out for are Gokuldas Exports, KPR Mills, Pearl Global on the garment side, and Indocount, Wellspun Living, etc. on the home textile side.
Okay, Devyani, thank you so much for taking us through the beneficiaries in the textile space because of the FTA. But we have Alcobev stocks that are in focus as well on the back of this India-UK FTA. And Mangalam is here to decode that. Mangalam, United Spirits is surely in high spirits.
Well, a lot of them are saying cheers because, while this was expected, now what we have is a date. From July 15th, it will be in effect. United Spirits up 4%, Radico Khaitan up 4%. If you look at, the other smaller players as well, Allied Blenders as well as Tilak Nagar Industries, all of them are in the green, outperforming the other parts of the market as well. So what we know so far is that this deal will come into effect from July 15th. The important part, however, while all the details aren't out, we know from the initial talks of the deal that the 150% import duty on Scotch will now be halved to 75% immediately, and over the next 10 years there will be a gradual way of reducing it to about 40% itself. So all of this would mean immediately there would be a price reduction, assuming no other increase in duty, to the tune of around 5 to 15%, and all the prestige and above products which were earlier imported will now be available at a slightly cheaper price, which means that volumes of that will be increased, and that would lead to some sort of uptrading as well. Now, over the last year or so, ever since this was first announced, we've been speaking to companies, and at various points companies have given us some estimates. United Spirits for one would save about 110 to 120 crores on this. Radico Khaitan would save about 70 to 75 crores on this. AB, Allied Blenders and Distillers would save anywhere between 30 to 35 crores as well. The question is whether they let that sit in their EBITDA, or do they pass it on to increase their volumes. This morning we had Karan Taurani, who joined us as well, said that once this would happen, it would, for a player like United Spirits, increase their volumes from about 4 to 5% to between 7 to 8%. So that would be an upward shift. And the important part for United Spirits, apart from the stock being an underperformer lately, is that over a month and a half from now, we'll also get that one-time payment that the company will get from the sale of Royal Challengers Bengaluru. So that additional cash coming to their books gives them a proper trigger in the next month and a half, along with the UK-India FTA. So all these factors leading to all the whiskey players, including United Spirits, to say cheers.
Okay, cheers it is ahead of Friday. Thank you so much, Mangalam, for joining us with all those details. So that's what UK FTA means. Comes in effect from 15 July. Ahead of that, these sectors are buzzing in trade today. Let's slip into a short break now. When we come back, we'll have Sir Bharto Mukherjee of CareEdge joining us. We'll discuss the impact of delayed monsoon, possibility of an El Nino on the Indian economy.
Welcome back to Halftime Report on CNBC TV 18. Nifty, moving and inching closer to the 24,100 mark. Tried, went back to the green, again coming back to the red. So let's watch out for that. But a lot of stocks that are moving around in the trading session. And to take us through those buzzing stocks, we have Hormuz here to take us through those details. Hormuz, over to you.
Some interesting movers in today's trading session, and none better than New India Assurance as an underperforming insurance name. The reason why the stock is up around 12% today, it features among the selling shareholders in the NSE IPO and an acquisition cost of 30 paise, and is going to be a big windfall for them when they sell over 1 crore shares of their own in this IPO. Now, the others, some companies that are reacting to their growth targets that have been laid out. Nykaa is one such name. The stock is up 10% in the last two sessions, 7% today, was up another 3.5% in yesterday's trading session. And the other one that's reacting in today's session is Reddington, and there have been reports of Apple hiking prices of their products, and the stock is up for the 7th day running today, and during this 7-day period the stock has gained as much as 13%. Polycab and Kia Industries were stocks that were doing well in yesterday's trading session, and taking cue from that, RR Kabel is following suit, is up 4%, slightly off the highs of the day though. The upgrade coming in from Motilal Oswal earlier in the day, the firm continues to remain bullish on the entire space. There's some profit booking seen in some of the high-flying names in yesterday's session. IFCI, of course, has had its run in anticipation of the NSE IPO, extending its losses now down 7%. IDBI Bank was up 18% in yesterday's trade, seeing some profit booking, and Central Bank of India too coming off yesterday's highs. And lastly, some stocks at 52-week high levels. Netweb Technologies continues to move higher, another 5% added to its tally. Carborundum Universal doing well on very strong volumes. Titagarh Rail and Sirma SGS at a 52-week high as well.
Okay, all right. Thanks very much, Hormuz, for joining in and giving us all of that perspective. But let's focus on the macros now. The IMD has forecasted a below normal monsoon this season. In a recent report, CareEdge Ratings warns that the weak rainfall could possibly fuel food inflation, with tomatoes, onions and potatoes amongst the most vulnerable commodities. The report also notes that deficient rains may hit rural incomes, which in turn could weigh on overall consumption demand in the economy. To discuss this and more, we have Sir Bharto Mukherjee, who's the senior economist at CareEdge, joining in. Mr. Mukherjee, thanks very much for taking the time out. I just wanted to understand, how resilient do you think the Indian economy could be if in case we do see this deficiency come through as adversely as it's predicted?
So thank you for having me. The thing is, the Indian economy is much more resilient as compared to the past, but the impact of the El Nino would be there. So we are not completely immune to the fact that the rainfalls are going to be deficit. We have the resilience part largely stems from the aspects such as a better irrigation coverage. So currently, almost 60% of the total gross sown area is under irrigation. And also we have diversified a lot to the non-allied or the non-crop component side of the agriculture, which is less reliant on the rainfall. So these are the aspects which add to the resilience aspect for the economy.
So, Mr. Mukherjee, you said maybe not such a big impact on GDP. We are resilient here, but there could be some impact on food prices. Can you give us a sense of how much of food prices already risen? Because it's just not a possibility of El Nino or deficient rainfall. We did have supply chain issues because of West Asia crisis, which might not continue now. But adding on to that pile on because of food inflation, how much have prices risen? What is the risk of price hike from here on?
So while we have a good buffer crop levels, then that's largely in the wheat and the rice segment. But the food inflation could be higher for crops like, say, for segments like vegetable, pulses, and edible oil. It's also important to keep in mind that El Nino is a global phenomena, and countries like Indonesia and Malaysia, from where we import a lot of palm oil, are also likely to see the adverse impact of the El Nino. And if there is a fall in the production in those countries, the pass-through can happen because almost 50% of the global, 50% of the Indian edible oil consumption is imported.
Mm-hmm. Mr. Mukherjee, good afternoon. I want to understand one thing, right? While you said obviously the link between GDP, monsoon, that's reducing. 43% of the workforce is still agriculture side, right? Approximately. One, does this cause maybe a bit of a slowdown then on the rural front if we see those concerns coming in, rural demand slowdown, and then overall weighing down on the GDP as well?
Yeah. Obviously, the impact won't be much from the agri GVA growth front, but the impact would play out from the price as well as the rural demand side. Given that 43% of the employment comes from there, and if there is an overall impact on the agricultural output, that can have impact on the rural consumption side. And over the past couple of years, the rural side of the demand was holding up well as compared to the urban side. And any impact on the rural economy will play out in the consumption story.
Okay. Well, Mr. Mukherjee, while we're talking about El Nino, Citi has come out with an interesting report where they've upped the India GDP forecast simply because of Brent crude prices, which they now see softening to around $70 from that $93 forecast that they had for Q2 to Q4 of FY27. So that obviously is going to be an incremental positive for us. Just give us a sense, how much of a benefit do you think it could be? How much do you think it'll offset the impact of the possible El Nino? And in your sense, what is the GDP forecast that you're working with?
So we are holding on to the GDP projection of 6.7%, assuming that the Brent oil prices average around $90 per barrel. Even though the Brent crude oil prices have corrected to a level of around 80, there can be some upward pressures from the buildup of inventories, which during the crisis, we have seen a huge drawdown on the inventories of the crude oil prices. So realistically, the crude oil could average somewhere between 85 to 90 levels, and we are still waiting for the cues to see at the levels at which the crude oil prices will stabilize going ahead. In terms of the El Nino part, the impact will largely depend upon the temporal and the spatial distribution of the monsoon that will play out in the coming months. Obviously, there will be some impact, and our 6.7% growth projection already takes into account that there will be a lower rainfall this year.
Okay. Quickly, Mr. Mukherjee, coming back to the food inflation bit, you indicated some of the food prices or some of the crops which could be impacted. How much price rise has already taken place? What is the risk? If you can give us some numbers.
So overall headline inflation wise, we are currently projecting around 5%. And as I have said, this number already takes into account the impact of El Nino. The food price rise, for example, in the global edible oil basket, if you look at the Food and Agricultural Organization's data, for the month of May, the overall inflation in the edible oil segment was around 29%. So that will basically flow into the domestic basket, and the food price inflation can go up and will basically peak towards the third quarter of this fiscal year.
Mr. Mukherjee, do you think there is any intervention that may be required? It's too early, but from the government point of view, anything in terms of price stabilization fund, MSP adjustments, anything that already should be taken as a step now given the El Nino conditions that are expected?
So government has already taken some measures like, say, restrictions in the exports of certain commodities. I think government will see how the monsoon progress, and we are at a very early stage right now. And we'll see how the progress of the monsoon goes on and then devise the policy accordingly. And obviously, if there are pressure points, then we can see some import of pulses from abroad to adjust the price pressure within the economy.
Okay. I didn't quite get what you're expecting from the RBI.
So from the RBI's perspective, we see a possibility of a rate cut towards the end of this calendar year. But RBI will now basically hold and see how the overall macroeconomic condition plays out, especially on the inflation side. The risk on the growth side have subsided significantly with the recent deal between US and Iran. But the inflation risks are still high. RBI will see how the impact is flowing into the household expectation part of the inflation.
Okay, take that point. A lot of factors to consider before any policy decision could be taken. Mr. Mukherjee, thank you so much for joining us today with your thoughts on a possibility of El Nino and what the policy outcome could look like going forward. Time for a break now. Manish Hatirumani of Deen Dayal Investments will join in with some trading strategies on the other side.
Welcome back. Well, for the markets, it's extremely quiet at this point in time. So we have the Nifty, which is just about higher by around 15 odd points, and the mid-cap index, which is up around 0.2%. The bank Nifty also up around 0.4%. But one space which really stands out this year, in fact, is a couple of these pharmaceutical stocks which have a little bit of an R&D bent or a research and development bent. So I'm just going to name a couple of them. I'll start with Spark. which is up around 75.8% this year. We have Panacea Bio, which is up around 45% from the vaccine space, Wockhardt, which is up around 44%, and Orchid Pharma, which is up around 35%. So 4 of these companies are linked to R&D in some form or manner. So I'll take you through each one of them. Spark is basically the R&D arm of Sun Pharma. It recently sold a $195 million priority review voucher, which they received from the US FDA, which means that they've received this amount of money into the company, which will then fuel their R&D programs going forward. So that stock has been in focus on account of that, and that's possibly one of the reasons for the outperformance. Separately, we have Wockhardt, which has been in focus because their novel drug Xenic, which is the drug that they've developed themselves, is an antibiotic which is now approved by the US as well as India. And the peak sales potential for this is $1.5 to $2 billion. So that continues to be in focus on account of that. Orchid Pharma, remember that last year the company bought back the rights for a global ownership of an antibiotic drug from a pharma company, Allecra. So this particular antibiotic is something that they themselves had in their portfolio, which was then out-licensed to Allecra. It eventually hit the market, and now they've basically bought back the rights. So the street would be looking at this particular journey quite closely. Lastly, Panacea Bio. The company recently announced that they're a part of the DenStar project, and they are the developer of Dengue-All, which is basically a tetravalent dengue vaccine targeting all 4 virus serotypes of dengue. So that is something which the street will be focusing on in terms of efficacy and the usage of it. It's currently in late stage development in India. So these are a couple of stocks which are in focus, which do have this R&D bent and which have performed very well on a year-to-date basis.
Okay, makes sense. Thank you for bringing that on the radar. So some of those pharma R&D stocks on our radar. The markets have recovered, by the way. The Nifty is very close to that 24,000 mark. So it's a good time to get a technical check on the markets. Manish Hathiramani, proprietary trader and technical analyst at Deen Dayal Investments, is joining us on the show now. Manish, good afternoon. Thank you for joining us. Will we continue this recovery that we're seeing from the lows? What are the next important levels on the Nifty now?
Good afternoon, Sonal. Thank you so much for having me on the show. As we had discussed last time, the key level really was 23,700. We have flown out of that resistance level. This should take us from the short term to 24,250, and that should be the first pitch stop. If we're able to sustain that, we can go as high as 24,500, 24,600 also. The new support range currently is now 23,700.
Okay, point taken there. And, Manish, could you talk to us about your individual names as well before we have some couple of queries from our viewers? So before that, your individual stock picks.
I'm working with 2 buy calls. The first one is on SBI Life, which is for a target of 1880, stop loss of 1750. After a downward move, this stock has shown early signs of a breakout after crossing the resistance of 1770. If we can keep above the levels of 1810 on a closing basis, this stock can achieve higher levels, 1880 being the first stop. Eicher Motors is the second one for a target of 7850, stop loss of 7450. This stock was trapped in a sideways zones for a couple of weeks. That was idly between 6750 and 7500. We have broken out of this range with higher than average volumes.
Manish, talking about some of the queries we've received from our viewers, the first one is from Utpal Jain. He's writing to us from New Delhi, holding 180 shares of RR Kabil, and this is at a price of 1,400 rupees per share. Is asking whether he should add more shares of the stock. What's your take on the technicals? Is it a good level to add more?
No, I would not suggest doing that, because when we broke out of the resistance, those were as low as about 1,600, 1,700 rupees. We have kind of moved up. I would rather suggest that he should start using trailing stop losses on his particular trade. For the time being, the stop loss should be around 2,000, and we can expect a target of 3,000.
Okay, all right. We have one more. Tina Kapoor writes to us from Chandigarh. She's asking if she can buy Sterlite Technologies for the short term, or is it a long-term play?
Sterlite Technologies is currently quoting at about 600 rupees. We have had back-to-back upper circuits right now, so I would not recommend somebody to buy it at this point in time. If we can get a drop closer to the levels of about 500, those would be good supports, and then she can continue holding that for a target of about 850 to 900.
Okay, take that point. We have one more for you, actually. Kamal More is writing to us from Mumbai, holds 300 shares of ITC at 380 rupees a share. He asked whether to hold or exit at current levels. Sitting on a loss currently, what are you suggesting, Manish?
This seems like a sell simply because we have been in an intermediate downtrend. However, if we can get above the levels of about 310, 320, those would be resistance levels we can continue holding thereafter. If he breaks the levels of 280, I would recommend a sell rather than exit from the current strategy.
Okay, point taken there, Manish. Thank you so much for joining us this afternoon, taking us through your individual bets, as well as helping viewers also get answers to their queries. So thanks so much for that. But let's move on and talk about what's happening in the world of F&O. Nifty's come back about the 24,100 mark. What does it mean there? Mangalam is at the F&O desk to take us through all of that. Mangalam, afternoon.
And markets near the day's high, so doing extremely well for the frontline index. Alongside that, we have the mid-cap index doing extremely well as well. The only counterbalancing factors right now for the Nifty are the two largest components. We have the Nifty Bank and the Nifty IT index. The Nifty Bank has been outperforming, but the IT index is the one which is underperforming, and which is why we're seeing the market, seeing some selling at higher levels or a bit of a lid on the gains that have been kept. Low volatility would make bulls feel a lot better. So the India VIX, which is down about 2.5% after being rather flat in yesterday's trading session. And we have a lot of consumer discretionary stocks which are buzzing for various reasons. Yesterday we had Trent, which did well. Today continues to do well. United Spirits higher on prospects of better margins from the India UK FTA. You have Nykaa on the back of strong commentary coming in their investor day. So all these consumer discretionary stocks doing a lot better. In the last few minutes or so, if you look at the intraday chart of the Nifty Realty Index, that's also seen a bit of a spike. Yesterday the Realty Index wasn't doing as well, the Mumbai-based ones in particular, and now that dip has been bought into, so we'll monitor that too. But as we move along, the 24,100 call writers are still fairly active on the Nifty, telling you around 24,200 to 24,250, where the 100-day moving average comes in. There could be some supply. Even as the support has moved higher, 24,000 put writers equally active, telling you that the support for the Nifty is around that 23,900 thereabouts itself. A lot of stocks on our radar, shorts added on Infosys and L&T Finance. A lot of long positions initiated on names like LIC, which is doing extremely well in today's trading session. We have Radico Khaitan as well, which has been spiking among all the other Alcobev stocks. A lot of long positions added there too.
Okay, thank you so much, Mangalam, for joining us. So with that F&O setup, markets, by the way, is at the day's high. There's a sharp recovery from the lows, as Mangalam mentioned as well. So keep an eye out on that. For now, we are at that 24,128 mark. We'll slip into a short break. When we come back, we'll get you more on markets and stock-specific action on the other side.
Welcome back to Halftime Report on CNBC TV 18. Nifty near the day's highest point, 24,120. Around that mark is what the Nifty is trading at. And since we started the show, we've seen a 40-point uptick from that level as well, 50-point uptick. Now, let's look at the contributors, right? You have the bank side. So private banks, they are coming up top of the list, HDFC Bank, ICICI Bank, Axis Bank, and we have SBI also. So bank is something that is managing to pull up the markets, while IT on the flip side today is not doing that great. Infosys, TCS, we have seen on the flip side being a bit of a drag, while Maruti Suzuki, Reliance also seeing some bit of a red on the screen, but markets have seen that up move and recovery coming in as well. So that is what we will keep an eye out on. But yes, that's what we are watching out for in the trading session. Broader end of the market also is managing to do well. Let's go across to Manisha, who's here also to take us through what's happening in the world of commodities. Manisha, over to you.
Well, thank you so much for that. It is the crude oil prices that we are talking about because the prices have continued to decline at a 3-month low, trading below $78 a barrel. Well, there's two things that the street is watching out for. One, of course, is the US and Iran peace deal that has happened. And the second is the very hawkish comments that we have seen come in from the US markets therein. Joining us then to talk about that is Sushant Gupta. He's director at Mood McKenzie. Sushant, hi, thank you so much for joining in. First of all, your reaction on the signing that we've seen happen between the US president and Iran. A more official signing perhaps would happen on 19th of June as well. But from where we stand with a 60-day clock ticking away, what is your initial take?
Hi, thanks, Manisha, for having us here. I think this is something which the market was always expecting. And if you see the trend of oil prices from April to May to June, the prices have been coming down. And just before the peace deal announcement was made, we saw prices already hovering around 85. And now, so a lot of the market is expecting that the Strait of Hormuz flow will start, after the peace deal is signed this Friday, which is tomorrow. And I think that's just being priced into the market.
Sushant, we've seen prices come off quite strongly, trading below 78. Would you say much of this news is now factored in, or there is still a further downside that you're looking at?
In fact, we are looking at the opposite. We think a lot of this news has already been factored in. The market is still forgetting that this is just the first step. Yes, in the right direction, but this is just the first step. We potentially see that the flow passage through the Hormuz will be very slow because there are hundreds of ships waiting, on each side of Hormuz. The upstream production, which is shut in, will take time. The tanks which are full will take time to draw down. And by the time the crude oil coming from Hormuz will hit the market or the destination market, it will take time. And by that time, the inventories will keep drawing down. And towards, in July, mid-July, end of July, we expect inventories to hit the lowest point. And that's when the market will, start reacting to that. And we expect prices to slightly move upwards, from there.
So are you looking at an 80 coming back or an 85 as a possibility?
Yeah, so I think in the next, for July, we are forecasting on an average $85 per barrel and slightly moving upwards from August. And only after that, once the passage is established, market is relaxed, that things are moving on smoothly, then the market are fundamentally oversupplied, but just that it takes time to get that oil back in the market. Then we see a slow decline in the prices towards 2027.
How are you also looking at the second half of 2026 and most part of 2027 in sense of supplies and demand going forward? The IEA report, which says that 5.05 million per barrel of day of surplus is what they are working with in next year. Increased supplies from UAE, from OPEC, from Iran, etc. will start hitting the markets by next year. How are you looking at this year vis-a-vis next year in sense of production, supplies and demand?
So, first of all, this year, the demand growth will be negative. We are expecting a decline of around 1 to 1.5 million barrels per day with slight recovery after this news and the lower prices we see in the second half of this year. But net, we will still see a decline in the demand for this year. Next year, demand growth will be positive. But at the same time, the supply growth will be extremely positive. So supply growth will surpass demand by, order of magnitude. and we expect prices for this year, right? Even though second half of this year, from August, as I was saying, will be in the range of $85 to $90. August, September slowly come down toward December. So average for this year, we're looking at $104 a barrel, right? Average for this year. And for 2027, because there will be much more supply than demand growth, we expect close to around $80 for next year. The weakest point being the second quarter.
And how are you looking at the demand consumption going forward?
Well, I think demand for this year is falling but decline, but of 1 to 1.5 million barrels per day. For next year, we expect the normal levels around 0.5 to 0.7 million barrels per day of demand growth for next year, which is much lower than the supply growth.
And what kind of supplies would we be looking at next year?
I think I don't have the number off the top of my head, but it is definitely much more than this year. It could be 5 to 6 million barrels per day of supply growth. But again, that really boils down to we are year-on-year change is something which we can't compare because we are starting out with a low number for 2026. But yeah, I mean, UAE, as they're not a part of OPEC Plus now, we'll be looking forward for more volumes from UAE. But for the key countries in OPEC, Saudi, Kuwait, Iraq, and Iran, I think that the growth will be slow, returning towards 2027. So net, I think the growth will be much more than the demand growth.
And how are you also looking at the China factor? Because the only thing that put the prices in a balance in the month of May and June, perhaps, was that 3.5 million barrels per day of a demand decline from China. Do you see that coming back?
Well, I think China, as I said, oil demand growth in China is anyway, has been slowing down. Gasoline, diesel have already peaked. So I think we were not anyway forecasting or banking our oil price forecast, solely on the oil demand growth in China. The large part of the demand growth is from Southeast Asia and India, and that's what was driving whatever positive demand growth we were seeing, pre-war. So China certainly will not, add to the demand growth. The story in China is still the same. Oil demand is peaking, and the focus more towards diversification of demand towards renewables. That's the key story for China.
Okay, Mr. Gupta, thank you so much for joining us with your insights. Manisha, thank you for taking us through that conversation. With that, we'll slip into a short break. When we come back, we'll get you more on markets. We'll focus on Nykaa as well, which is buzzing in trade today. Stay tuned for that.
Welcome back. Well, for the markets, it's consolidatory. The bank Nifty, however, has picked up pace, so that seems to be gaining some amount of traction, up over 300 odd points. But just watch out, because there are a lot of volume buzzers in today's trading session. So Shelly Engineering is at around over 40 times its 2-week average in today's trading session in terms of volumes. We also have Supreme Industries, which is at over 12 times its 2-week average in today's trading session. And Devyani is also joining the list with almost 11 times its trading volumes on a 2-week average in today's trade. So a lot of volumes generated on a couple of these counters. But nonetheless, Nykaa is also buzzing on the back of the companies targeting more than 5 billion gross merchandise value, or GMV, for their beauty and lifestyle business by FY30. Mangalam is here to put all of that into perspective for us. Mangalam, tell us more.
Well, it's an 8% up move that we've seen on the stock, and this after a 5% up move that we saw already. So the street was obviously fairly gung-ho on the prospects that the company has in terms of growth for the investors for the next few years, and that's exactly what's taking place. Even as the analyst day is underway, the presentation is uploaded on the exchanges, and the key highlights tell you the long growth runway that the company is projected for itself. I'll tell you some of the numbers. 50,000 crore or over $5 billion in terms of total gross merchandise value across their businesses by FY30 is what the company is projecting. And what does this mean in terms of their own reported revenues and EBITDA? Well, from current levels, FY26 levels, they project the revenues to grow anywhere between 3 to 4 times in the next 3 years. And were that to happen, the EBITDA would actually grow one step more. 4 to 5 times is the EBITDA jump that they are expecting. They are projecting a near low to mid-teen sort of margin for the company. Remember, last year, the EBITDA margin of the company was close to 7.5%. So they're expecting the margins to double from current levels as well, even as the revenue triples from current levels by FY30. The two key segments of the company, beauty business, they expect near 3 to 3.5 times growth in their gross merchandise value out there, with double-digit margins. Remember, this number, all of FY26 was 7.5%, 8%, and they expect that to go into double digits, so that's a positive. And add to that, they are expecting to touch over 600 stores as well. So not only will this growth be online, but a large part of that will also move offline. So the community building for Nykaa continues. For the fashion business, which has been a bit of a margin drag, broke even just in the last quarter, they expect good growth coming in here as well, with EBITDA margins of double digits, or rather high single digits in FY30, from just about breaking even in the fourth quarter. And the target is over a sustained period, they could do more than 10% or double-digit margins in the fashion business. The other parts of the business that are strong call-outs, House of Nykaa, which is their own brands, which include the likes of Dot & Key, K-Beauty, etc., which did about 3,200 crores in gross merchandise value last year. They are projecting that to grow over 5,000 crores as well. And eB2B Superstore, which is basically their wholesale fashion business, wholesale beauty business, they expect to reach 1 million stores by FY30 with a GMV of nearly 3,000 to 3,500 crores as well. This was a number which was sub 1,200 crores in the last year. So multifold growth across all parameters is what the company is targeting, and which is something that the street is excited about.
Okay, take that point. Thank you so much, Mangalam, for joining us. By the way, Brigade Enterprises is on our radar. Company's Morgan Heights project, which is in Chennai, there is a permission which has been revoked. So basically, Tamil Nadu authorities, they have said in their order, but remember, this order is dated 8th of May. So it's been like 1.5 months since this order was issued. They say that they cannot begin construction, or they cannot continue construction on this particular site because they started construction before they got approval from Wetland Authority, which is needed as per clause 9 of some of the regulations there. This particular project is an important one for Brigade. They have a project area of 1.09 million square feet. Their own interest in this one was 0.08 million square feet. They had launched it back in Q1 of FY26, and this is something which could be a dampener for them. We need to understand what kind of sales value were they expecting from there, but considering it's a 1.09 million square feet of area or a project that they're looking at, it has come in as a negative for the company. We'll watch out for any clarifications from them because the order date is in May, 8th of May to be very specific. So why did this come to light right now is something that we need to. Okay, so 2,100 crore is the gross development value from this particular one. So it's a big one for a company like Brigade Enterprises. We'll keep getting you more updates on this one. The stock though has come up sharply from the highs, is down 2.5% as we speak, this is coming in as a negative for the company. We'll slip into a short break and come back with more details on the other side.
Welcome back to Halftime Report on CNBC TV 18. Like you can see at the top of the screens, we're seeing a good recovery that's come in for the Nifty as well from when we started the show. 24,130 around that mark. So near the day's highest point is what the Nifty is trading at. Bank Nifty continues to see a bit more of an up move as well, and broader out of the market sustaining their positive move in today's trading session. Advance decline ratio has moved more towards advances versus declines. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch.
Stocks are steady after US and Iran ink a peace agreement, even as the US Federal Reserve strikes a hawkish tone. Healthcare and financials notch some gains while IT and utilities drag. NSE files its draft offer document with SEBI revealing 10 shareholders to sell nearly 6% equity. The likely over 30,000 crore rupee offer will not just rake in profits for the sellers, but can also draw in crucial foreign portfolio money. Stocks of textile exporters are climbing after the 15th of July has been fixed as the effective date for the India-UK FTA, and the European Union promises to ink its own by the end of the year. The Indian exporters to UK will see tariffs drop to zero, while imports of spirits by the likes of Diageo-owned United Spirits will also get cheaper. Brent crude slides below $78 a barrel after Donald Trump signs the deal with Iran ahead of the Friday schedule. The move, aimed at opening up the Strait of Hormuz quicker, could see 60 oil vessels with 120 million barrels sail through. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Well, the markets, the bulls are trying hard to turn this into a good day, to turn this into a fifth straight day of gains for the markets. Well, it's a 60-odd point recovery from the lows of the day, but the range of the market has been very narrow all through the session. 24,050 on the downside, 24,150 on the upside. And this has been the case all through the last 2 to 3 days for the better part of this week, as the index has continued to trade in this very narrow 100-point range. But the good part towards the end of the session has been that we usually end up at or near the highs of the day, and that is something that the bulls would also be aiming for. Of course, today being the Sensex weekly expiry as well, so that will bring its own fair share of volatility on the in the second half of the trading session. Now, what's doing well today though? PSU banks, and they are being led by SBI. This is going to be a windfall for them as well, as they are among the selling shareholders in the NSE IPO. So PSU bank index is the top sectoral gainer. The Nifty bank is the one that is ensuring that the index remains in the green, while on the other side it is the Nifty IT that has been sulking all through the day. 330 points higher on the Nifty bank, and now they are at the higher end of the range of 57 to 58,000. They are just 70-80 points away from the 58,000 mark, and that will be a positive as well for the bulls. The banking stocks continuing to do the heavy lifting, as has been the case since last week. Of course, there are a lot of broader market stock specific movers as well. Nykaa has now moved to a 52-week high as we speak, after some positive commentary coming in from its investor day, where they have laid out some targets as well for FY30, and the stock is now up 7%. Good going for Nykaa, good going for Reddington as well. That's another 7%. There are reports of Apple looking to raise prices of its products, and that has also done very well in today's session. Both Reddington and Nykaa trading with gains of around 7%. But of course, New India Assurance continues to remain the top gainer in the broader market, still holding on to gains of around 12%. Now let's focus on the top story first. Then US President Donald Trump and Iran President Masoud Pezeshkian have digitally signed a memorandum of understanding to end the conflict and reopen the Strait of Hormuz. CNBC's Dan Murphy joins us now with all the updates on the 14-point MOU.
Overnight, the United States and Iran electronically signing an interim deal to end the war, reopen Hormuz, and open up a 60-day negotiation window on some of the finer points of this conflict. But of course, the pushback has been quite loud, including from those within the president's own party, who have suggested that perhaps the United States may have given away too much to Iran in order to get this deal done. Of course, the president also suggesting overnight that he would keep up the bombing if Iran did not come to the table over the next 60 days. Listen in.
If you don't adhere to the agreement, I don't want to do that, but we're going to bomb the hell out of you. And I don't think that they're going to veer from the agreement. What else am I going to do? Am I going to say I'm going to take you to court? Let me take you to court. Let me sue you. No, we're going to bomb the hell out of them if they violate the agreement. I don't want them to. I want them to honor the agreement.
President Trump speaking earlier. So the question is, what is inside this deal? This is a 14-point MOU that has now been electronically signed between the United States and Iran. As I mentioned, on top of the table here is the reopening of Hormuz, and markets have already responded to that. At the same time, the agreement also paves the way for Iranian sanctions relief as well. Again, this is going to be really critical in assessing just how much supply is going to be returning to the market and from from which point. But of course, the deal has also been criticized for some of the other arrangements here that are on the table, at least for now. Of course, the deal is silent on Iran's missile and drone program. It's also silent on Iran's support for regional militias and its proxies as well. These were key red lines, even concerns raised by the Gulf states and by Israel.
Dan Murphy there with the latest updates of that 14-point MOU. But the positive for the Indian markets has been, as a result of this MOU, is the 25% fall that you have seen in crude oil prices from the record highs of the war. Now Brent trading sub $78 as well. And this is due to the imminent opening of the Strait of Hormuz. And that has resulted in City India cutting its inflation forecast for the country and, more importantly, raising its GDP forecast to 6.9% from 6.6 earlier. Lata is here with all of those details. Lata.
This is a seminal event for India, the 26% fall in crude prices. I'm elaborating the City India report simply because this is definitely the first of a whole host of brokerages who are going to come with similar reports. Now, the City India says that based on their global city saying that the average crude price for 2026 calendar and for the first quarter of next year is being brought down from the earlier $93 per barrel average to $70 per barrel average. So a $20 fall. And because of that, they expect India's balance of payment surplus, which they originally estimated at $5 billion, to now come at $45 billion. But here it's not only Hormuz Strait. This is also because of the FCNR-B scheme that Reserve Bank has announced. They're expecting flows on that and hence the BOP surplus. The surplus will be higher, Citi says, if Indian bonds get included in the Bloomberg index. Then on current account deficit, this is directly linked to the Hormuz Strait. The current account deficit for Citi earlier was 2% of GDP for FY27. They've brought it down to 0.9% of GDP. And why? Because the trade deficit is going to be lower, and that's because of a $31 billion fall, net fall in the oil import bill. Then inflation. There, the forecast is being lowered by 20 basis points. Earlier, the Citi forecast was 4.9. Remember, RBI is sitting at 5.1, but Citi is bringing it down to 4.7. And this is because, of course, further rise in domestic prices at the pump are not expected. More importantly, fertilizer prices, chemical prices, petchem prices, all of them had shot up in the global market. And, you know, the WPI in India also went up to 9.5%. That will at some point get transferred to consumer prices was the fear. Now that fear goes out because global fertilizer prices have crashed, crashed to half actually, from $900 to $400 for urea, and so on for other petchem prices as well. So that's why the inflation forecast brought down. GDP, most important, the forecast is upped from earlier 6.6 to 6.9%. The Reserve Bank is standing at 6.7. Now, this Citi bases on the RBI model that a 10% fall in crude prices results in a 15 basis rise in GDP. Now, this is a 20% fall in, or even more than a 20% fall in crude prices, and therefore they've raised the GDP forecast by 30 basis points. Because of the expected fall in inflation, Citi now expects no rate hike at all. Their earlier forecast was a rate hike starting as early as August, and one more. They had 2 hikes. Now, the risks to all these forecasts is that if the Middle East peace process for some reason breaks down, let's hope not. Of course, it's Friday evening that the actual signing will happen. But that is the risk. If it breaks down, or if El Nino turns out to be much worse than expected. Under current forecasts, El Nino is not expected to have an impact on the inflation. Again, I'm highlighting this because Citi is likely the first of many other forecasts that are going to raise GDP and lower CPI forecasts.
A big note there indeed from Citi. Lata, thank you for summarizing that for us. Take a short break. On the other side, the US Fed has decided to keep rates unchanged. It's first under new chair Kevin Warsh. More on the other side. Welcome back. India's largest stock exchange, the National Stock Exchange or NSE, has filed its IPO DRHP with the market regulator SEBI. Yash is here with more details from that offer document. Yash.
Well, the largest stock exchange in India, and of course, coming out with the largest fundraise through an IPO in the history of Indian capital markets. The National Stock Exchange filing its IPO DRHP after what was a decade-long wait of multiple times going back and forth with SEBI. This happened yesterday evening. And as far as the details of the IPO are concerned, all of them in line with what we've been reporting, in the last 2 days. So just taking you through those details, it is a complete offer for sale document, which means the entire fund raised through this IPO will be taken by selling shareholders in the proportion to which they would be selling their stake, and nothing comes into the company, into the National Stock Exchange as fresh capital. How much is being offered? 14.89 crore shares is what would be on offer, which forms 6% of equity dilution, which would be the size of the IPO itself. Now, from sources, what we've been given to understand, and this is what we had reported yesterday as well, is that in terms of number, in terms of size, this is likely to be about 30 to 32,000 crore rupees. That's going to be the size of fundraise, and that is likely to value the National Stock Exchange at 5 to 5.33 lakh crore rupees. It gets important to understand which are the selling shareholders as far as the IPO is concerned. The largest selling shareholder will be State Bank of India. It owns about 3.23% stake in NSE, and as a part of the total offer, it would be selling about 16.62%. MS Strategic owns about 1.2% stake, second largest shareholder, selling shareholder. As a part of the total offer, which was upwards of 14 crore shares, the amount of shares which would be offered by MS Strategic would be about 10.75%. And just like that, you can see the large shareholders who would be selling their stake as far as NSE's IPO is concerned. There are multiple public sector institutions who would come forward to sell their stake out of the total holding in the National Stock Exchange. Now, let's understand what is the paid up capital, what is the offer size. The total paid up capital of NSE is about 247.5 crore shares, and what is on offer, that is upwards of 14 crore share, hence forms about 6.02%, which is the size of the IPO itself. A quick look at the financials for NSE. The last reported financials, FY26, was a weak year for the exchange. You see, financial matrix across revenue to operating EBITDA margin all came under some pressure. But of course, all eyes would be on how FY27 pans out for the National Stock Exchange. Finally, this is an important slide because it tells the dominance which NSE has as far as Indian capital markets are concerned. The market share, that becomes a very important metric. In cash market, NSE has a 93% market share, equity futures, 99.8%, equity options, 74.7%, currency futures, 99.5%, currency options. The total market belongs to the National Stock Exchange. So, of course, very strong numbers in terms of the presence which it has. All eyes would be on the kind of financials which the company provides in FY27, because by the time the IPO gets approved and launched, we'll be through the first half of the year. So those numbers will also be very crucial.
Crucial indeed. Yash, thank you for putting that together for us. On to some global action then. The US Federal Reserve has kept the rates unchanged under Kevin Warsh's first meeting as Fed chair. In his first press conference, Warsh also refused to give any forward guidance, stating that it was not well suited for the current policy conjuncture. Now, Steve Leisman has all the details on this.
Hawkish message on rates, reflecting that he inherited an inflation problem and saying the committee is strongly committed to dealing with that inflation problem.
We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Warsh clearly has embraced, at least for now, the existing hawkish bent of the committee, where 9 officials now project at least 1 rate hike this year and 6 see 2 or more. Only 8 expect to hold rates steady, and only one cut is projected. And markets have taken Warsh and the Fed seriously. The 2-year sold off hard, and the first hike is now seen with a 66% probability to happen in September. It had been December. A second hike now has a 55% probability for January, and there wasn't one priced in before the meeting. Warsh also pledged a rethink of how the Fed does business, appointing task forces to review Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework. Warsh stuck to his long-standing view that AI and productivity will be transformative for the U.S. economy. But it seemed as if any incorporation of that into policy would have to await dealing with the current inflation problem and hitting the 2% target.
Now, the Fed chair also explained why the Fed statement had been shortened. Listen to what he had to say.
A difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture. You also received the usual summary of economic projections. It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so. I, however, have refrained from offering any projections of my own consistent with my long-held views on the SEP, at least as currently structured.
That's all on the Fed. Take a short break. Back with more on the other side. Welcome back. Now, the long pending India-UK free trade agreement will come into effect from the 15th of July. Our correspondent Abhimanyu is here to tell us more about the contours of that deal. Abhimanyu.
Well, several benefits are expected to accrue to different segments of Indian exporters, including labor-intensive sectors and agri-product sectors, in which exporters are going to gain from duty-free access into the UK market, and possibly they'll enjoy parity with several other labor-intensive exporters from different countries like Vietnam and Thailand, who also export to the UK market. So, of course, huge gains expected for them, and also the double contribution convention, that is the DCC, which also has been affected between both the sides. This is going to possibly increase services trade between India and the United Kingdom. Now, several Indian companies already operate in the UK too, and there are a lot of intra-company transfers which usually take place. And as of now, over 75,000 workers from India are posted in the UK by Indian companies which are operating in both the countries. And the DCC, which has been agreed upon between both the sides, will essentially exempt Indian workers posted in the United Kingdom from making social security contributions in the United Kingdom if they are making such contributions already in India. So that, of course, would be a big shot in the arm as far as the overall profitability and the competitiveness of Indian companies operating in the United Kingdom is concerned, and $500 million are expected to be saved by this. Also, government sources have indicated that around 85% of India's steel exports to the United Kingdom will not be covered under the steel measure, which the UK is going to come up with from the 1st of July. So essentially, most of Indian exports are not going to be impacted by the upcoming steel measure of the United Kingdom, and services as well as goods trade is expected to increase between both the sides. As far as government procurement is concerned, that though has been allowed for UK companies to participate in India's government procurement, however, they will be accorded the status of second-class suppliers subject to value addition norms within the domestic Indian market. Also, a quota has been given for EVs after the 6th year, which is going to begin after the 6th year. It will be based on 3 price bands. The first would be up to $20,000. The second would be between $20,000 to $40,000, and the last one would be between $40,000 to $80,000. So several segments of exports from India are expected to benefit, and a larger synergy is expected as far as an increased trade between India and the UK is concerned.
Abhimanyu, thank you for that update there. Take your leave on this edition of Business Lunch. The markets have come slightly off the highs of the day, but from me and the team, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Ekta Batra. Good afternoon. Well, we recovered from the lows, so that good run continues. We are above that 24,100 mark, but a slight dip from those highs. So whether that could be a continuous phenomenon, but for now, bulls are enjoying the fact that we continue to edge higher.
Hi, Sonal. Yes, absolutely. You know, we've managed to recover above 24,100 at this point in time. We have the mid caps, which are just about 0.25% higher, but the advanced decline ratio is maintaining on the advancing side. So over 2,300 stocks advancing to around 1,800 stocks declining. So this is the picture for the market. The banks are doing very well today. So the Bank Nifty itself is up around 0.6%. Well, some news with regards to State Bank of India. The board has approved fundraiser of around 60,000 crores via bonds as well as other debt securities in FY27. Remember, a lot of these companies do take these annual approvals, so that could possibly be in line. But nonetheless, 1.3% higher for State Bank of India, where they've approved a fundraise of up to 60,000 crores via bonds and other debt securities. But nonetheless, let's take you through all of the top stories that we're tracking this afternoon. Nifty trades above the 24,100 mark, led by realty and financials. IT and metals lag among sectors, and small caps outperform.
The India-UK FTA is to be implemented on July 15th following talks between PM Modi and UK PM Keir Starmer. Deal to allow zero duty access to 99% of Indian exports. Textile and Alcobev stocks rise.
Shares of Nykaa surge as the company unveils FY30 roadmap at its Investor Day. Eyes 2 to 3 times revenue, 4 to 5 times EBITDA growth, and $5 billion gross merchandise value across beauty and lifestyle.
Shares of Kirloskar Ferrous skyrocket on the back of an international order worth $13.5 million. Shyam Metallics also gains as the company lays out an ambitious FY31 vision, eyeing 42,600 crore in revenues, 6,200 crore in EBITDA, and $1.1 billion capex plan funded entirely by internal accruals.
And shares of RR Cable rise over 6% as Motilal Oswal upgrades the stock to a buy with a target price of 2,600. The brokerage says the industry is poised for continued outperformance and will be a key beneficiary if infra expansion drive continues.
All right, those are the top headlines that we are tracking on Midcap Radar today. The Midcap Index doing well, though it is one of those where we are seeing the advance decline ratio in the favor of advances as we speak. The small caps also contributing as far as the markets are concerned. But let's talk about our special segment, Midcap Movers. We have Upasana to take us through the midcaps that are moving around in trade.
Well, certainly the mid-cap index is up nearly 0.3%. So let us first focus on the top gainers in today's trading session. Topping the list is Fino Payment Bank, up nearly about 12% as we speak. NetWeb Technologies and even Saskin Technologies remain in focus as both these counters hit 52-week high with an uptick of nearly about 5 to 10%. PG Electroplast also in focus since quite a while. The stock is up 16% in 1 week and up 3% as we speak today. RR Kabel also in focus. It's up nearly about 4% on back of that rating upgrade by Motilal Oswal. Now moving the focus to the unusual, that is general insurance stocks are also seeing some buying today. New India Assurance also in focus on back of that, on the back of the NSE IPO that the company is to offload nearly about 1 crore shares out there. Star Health Insurance also in focus with nearly 7% uptick, and ICICI Lombard also seeing a bit of a uptick, nearly about 2.5%. Now on the flip side, let us look at some of the top losers. Cohance Life also in focus as the CFO resigns. NIIT, it is 27% off its 52-week high. Aeroflex Industries down nearly about 4%. And lastly, Brigade Enterprises down about 0.5%. So all in all, these are the movers in today's trading session.
Okay, all right, Upasana, thanks very much for that. Well, Brigade Enterprises is in focus because the environment clearance for one of their projects in Chennai is in fact revoked. So we have Sonal to tell us more about it. That stock is under pressure. Well, it's not China, definitely, but
But we are in the Friday mood. It's okay, Ekta, we can do that.
Chennai for sure.
Yes,
but
of course.
recovered from the day's low.
It has. So, these, just to put things into perspective, we do get revocation of permissions, but again, on submission of documentation, there can be, further permissions granted as well. But of course, we don't know what will happen here. For Brigade Enterprises, the environmental clearance for Morgan Heights project in Chennai is revoked for them, and they revoked the environmental clearance note that they had received earlier. Now, this order is dated 8th of May, and it has come to light today, and that's what a lot of these, reports have been talking about as well. They said that the construction was commenced before they got the appropriate approval, especially from the Wetlands Authority. Now, Brigade Enterprises Morgan Heights project in Chennai is a 2 million square feet project. They started the first phase, which is around 1.09 million square feet, and they do have substantial interest in this because it's a JV. They have estimated gross development value of around 2,100 crore rupees. So it's a substantial chunk of their overall bookings, right? So if it does go and does not get that approval, it will be a big hit for them. But again, as I said, we still need to see whether they will submit some documents, and there could be some change in the permissions that would be granted as well. So for now, it of course did see some sharp fall when the news was flashed, but recovered from there.
Okay, all right. So that's on Brigade Enterprises from the real estate space. But Somal Mehta, head of retail research from Mirai Asset Sher Khan, joins in for a technical check on the markets this afternoon. Welcome to the show, Somal. Thanks very much for joining in. Well, for the Nifty, there is some amount of an uptick which has taken place. We've recovered back above 24,100 at this point in time. What would you approach in terms of stocks as well as the Nifty strategy today? What would your approach be? And for the Bank Nifty, are you seeing more traction there?
Good afternoon to everyone. We have broken out of a ending dangling pattern on the upside, and this breakout targets. First target was of 24,100. The next target is 24,600, which is the previous swing high on the quarterly charts. Now that we have been trading about 20 and 40 daily moving average, the medium-term outlook, the short-term outlook, both looks really good from here. Support would be around 23,800 and 23,600. So that will be a very, very crucial support for the markets at this point of time in the very, very short term. Medium term, definitely 23,100, which is a very crucial level for us because it is the 61% retracement level of the entire rise which we saw from 22,000 to 24,600. So that level remains extremely crucial in the medium term outlook. However, the strategy should be to buy on declines around 23,800 or 23,900 levels. On the upside, as I said, the target should be 24,600. Now on Bank Nifty, the next level on the upside that as a target would be 59,300, which is a previous swing high, and the support would be around 57,000, and in the medium term, 55,600.
Okay, that's on the Nifty and Bank Nifty. What about individual names? You said buy on dips could work for the benchmark. Is that something you're looking at in the broader markets as well?
Absolutely. I'm looking at PSU banks and I'm looking at defense. These two sectors are looking great to me at this point of time. The first one is Union Bank. Union Bank has broken out of a small consolidation, taking support at 20, 40, 200 daily moving average. Started making high top, high bottom formations. My target would be 188 and my stop loss would be 172. The second stock from the defense pack is Mazgaon Dock. Mazgaon Dock is looking great as well. Today it is little flat to negative. However, it has broken out of an indignangle pattern on the daily charts, trading above averages. Great setup for a short to medium term outlook. Stop loss would be 2470 and my target is 2850.
Okay, all right, Somal, we're going to leave it on that note. Thanks very much for joining in. We'll take a short break, but up next, we'll be talking to Elara Capital's Prerna Jhunjhunwala to focus on the textile space on the back of the UK-India FTA. Stay tuned.
Welcome back. Well, let's focus on the UK-India Free Trade Agreement, which comes into effect on July 15th. The pact eliminates tariffs on textile imports from India, giving Indian exporters zero duty access to $263 billion UK market. To understand which are the companies which benefit the most, which are the stocks that should be on your radar, Prerna Jhunjhunwala, Vice President Equity Research, Irara Capital, is joining us now. Prerna, good afternoon. Thank you so much for joining us. Well, we know it is a positive, but can you list out some of the stocks which will benefit the most, which do have a lot of exposure to the UK market?
So UK FTA is a very important milestone that Indian government has achieved by getting ratification from the government. So we will be in a position to gain market share given the level playing field now with competing countries like Bangladesh, Pakistan, and Vietnam, which are exporting to UK market at almost 0% import duty. Now, still we have companies which are actually exporting to the UK market, and substantial portion of their revenues comes from the UK market. Some of them are SP Apparel, which have almost 50% of their revenues coming from UK market. KPR Mills, almost 15% of their garment revenues come from UK market. Wellspun Living, almost 10% of their revenue comes from UK market, and Indocount, almost 7 to 8% of their revenues come from UK market. So these are the four companies which are actually having an existing exposure to UK market. But at the same time, I would like to highlight that there are companies who are actually having minuscule exposure, but looking forward to add UK as a substantial market through their existing capacities and the new capacities that they are adding. So, for example, companies like Pearl Global have Indian capacities which can be now focused on serving the UK market. Similarly, Arvind, Gokaldas, all these players whose exposure is right now negligible can gain from adding exposure to these markets.
Okay. All right, Prerna, hi. Thanks very much for joining in. We'll get to your picks and your top picks at this point. But before that, with the UK FTA now coming into execution soon, how competitive are we vis-a-vis countries such as Bangladesh as well as Vietnam?
We are now at full competition with respect to these countries, largely because we have our cost structure is largely aligned due to availability of cotton and other materials that are required, which other countries don't have. So we were earlier disadvantaged due to this duty benefit that they had versus we did not have, and we also were higher on the labor cost. Now with duty going away and Bangladesh facing some issues with respect to power availability and other problems, we believe that UK in the UK market or anywhere, if we are at level playing field, we should be in a position to compete with these countries.
Okay, so it will create a level playing field for now. So, removing the duty structure is one thing, and you spoke about the companies which will benefit from that or potentially benefit from that. Is there anything else which is happening in the industry which is a dampener right now? Anything with raw material prices or imports otherwise that the industry is doing, and that also is something that investors should keep in mind before they look at textile stocks?
I think there's a lot going in the industry. For example, US tariffs are now, we are at level playing field in US tariffs. So our market share, which we had lost due to punitive taxation by US, is now likely to return back to us. So we'll see a cyclical recovery in our market share in the US markets, which is a core market for many companies currently. And we'll also see these FTA tailwinds panning out. So we are, in our opinion, at an inflection point in textile sector where growth opportunities are likely to unfold due to market access that we are going to get due to various FTAs, and we getting to level playing field on the duty structure. With respect to cotton prices, they have been very volatile. But at the same time, removal of import duty by the government is a big positive, and we are at par with international cotton prices. So that disadvantage is also not there anymore. We just need to be aware of the volatility that could that we are facing as a country or and in global markets. Otherwise, all things are in place for improvement in margins and garnering better revenue growth.
Okay. Well, Prerna, stock specific wise, if you had to recommend maybe buying 1 to 2 stocks amongst your top picks from a 1-year horizon, which ones would they be and why?
We like Arvind Mills, Arvind Limited as our top pick. They have recently got an acquisition done in the technical textile space, accelerating their growth in the technical textile business. The Indian technical textile business grows at around 18 to 20% for them. And this addition in the US market gives them market access. So technical textile is one growth segment that would drive their top line as well as profitability. Plus, garmenting business is likely to scale up for them with more focus, with US coming to level playing field and focus on FTA-driven countries. So we believe Arvind is one of the stocks that could give better returns among the pack going forward. Apart from them, home textile companies like IndiGo and Welspun, which have and KPR and SP Apparel, as mentioned earlier, they are well positioned to actually take advantage of these FTA benefits in UK and Europe.
Point, Prerna. Thank you so much for joining us with your take on the textile industry and what this UK-India FTA mean for some of these stocks. That's the word coming in from Ilara. For now, we'll slip into a short break. When we come back, we'll get you more on the markets and also focus on RR Kabil, which is buzzing in trade after a bullish note from Motilal Oswal.
Welcome back. Well, RR Cable is buzzing after bullish note from Motilal Oswal. Upasana is here with the details on this stock.
Well, Motilal Oswal has put the spotlight on the cable and wire industry. It says that the industry is poised for a continuous outperformance and the demand tailwinds, they continue to remain intact over the long term as well, as India's energy transition remains as one of the key long-term growth driver for the sector. Now, higher growth visibility will drive the earning upgrade for RR Cable, and it is given a rating upgrade from neutral to buy with a target price of 2,600 per share. It has also raised the EPS estimates for the stock by 11% for FY27 to FY28, and even has given one of the highest, that is 21% revenue CAGR for 26 to 28 for the company. Given the stronger revenue growth outlook, market share gains, capacity expansion and even margin expansion that the brokerage is factoring in for the company. Now, earlier this week, mind you, Citi had also given a buy rating on the stock with a target price of 2,650 per share on the back of the sharp rebound that the company is seeing in terms of its exports, which is one of the largest contributor as compared to its peers. So all in all, this stock certainly remains in focus on the back of this.
Okay, all right, Upasana. Thanks very much for that. Just watch out for Bata, which has got a new MD and CEO. And after the news, the stock, which is up around 5% has surged to an 8% rise at this point, at the high point of the day, reacting to that bit of news, as you can see on the charts. Well, we need to wrap up on the show. That's all the time that we have on Mid Cap Radar. But MF Corner, once we're back. Stay tuned.
Hello, good afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra. Sonal, good afternoon. And today we're back with Know Your Fund Manager.
We are, and this is an episode where we try to break down investment philosophy in easier terms and understand what really goes behind the entire investment process, right? We'll talk about how they navigate changing market cycles, generate alpha, and identify the growth strategies they believe are most effective for building long-term wealth. To discuss all of this and more, we have with us Mr. Ajay Tyagi, who's the President and Head of Equity at UTI AMC, joining us now. Mr. Tyagi, good afternoon. Thank you so much for joining us on MF Corner today. To the most basic question, because that's what retail investors would always think. What do fund managers really do? So take us inside your portfolio construction process. How many stocks do you ideally want to own? And what's the maximum you would put in a single stock or a sector? And when do you decide the position has gotten too big, but your thesis that is still intact?
So Sonal, let's start with the first question, the most basic question. What does a fund manager do and what does a mutual fund scheme do? I would say at the most fundamental level, what we are trying to do is identify great businesses and have fractional ownership of those businesses for our investors. So as we all know, not everybody can actually be an entrepreneur. Not everybody can actually float a great business, the one which not only creates value for its customers, but also creates value for its investors. Mutual fund at the most basic level allows society at large and retail investors in particular to partake in such great businesses by way of a collective investment scheme, which in India is called mutual fund structure. So that's point number one. Your second question was more nuanced, of course. How do we position size? How does when does a stock become too big, and so on? So, I think for us, what's important is to understand how the business would actually behave over the next 3 to 5 years. We usually try to disassociate the business outcomes from what the stock prices are reflecting in the near term. We want to focus more on what's the ability of the business to deliver over, the coming years, and hopefully, beyond, 5 years as well. And when we do that, we basically try to keep the near-term factors outside of our frame of reference, because the near-term factors can lead to a lot of noise, can actually lead to, our conviction getting jolted every now and then. The third part of your question was that when does a particular stock become too big? I would say this also is very nuanced. I think if I were to answer it at the most basic level, I would say our position size is a function of our conviction about the business to actually have a very long runway in front of it. So the longer the runway for compounding of profits and cash flows for that business, obviously the conviction would be higher. Along with this, we also look at, does the business have the required moats to keep competition at bay, which means it has the economic characteristics which can help it sustain its profitability, and without compromising on its balance sheet can continue to enjoy this long growth runway. So it's the profitability and the sustainability of the profitability and the ability to compound earnings that leads to the position size in our portfolios. Yeah.
Mr. Tyagi, good afternoon. Thank you so much for joining us. Rightly said, near term leads to a lot of noise. You spoke about business runway and how, growth and compounding of that growth is key, as well as profitability. But you all have been consistently negative on sectors like metals, oil and gas, real estate, infrastructure for years, and positive on private banks, consumer goods, pharma, and IT as well. So what is the underlying framework for this? Is there some business characteristics furthermore that disqualifies maybe some sectors and stocks as well? You spoke a bit about it, but a lot more in detail if you could highlight that.
Sure. That's a great question, Vinny. But let me just, before I answer this question specifically, let me just say that, some of the sectors that you mentioned where we've been consistently negative may be true of some of our schemes. But that's not, a view across the board. The one thing which I must say upfront is that at UTI, we run the full suite of mutual fund schemes covering the entire spectrum. Some of them have a tilt towards quality and growth. Some others have a tilt towards value. Some are blended. So yes, what you just mentioned is completely true about some of our schemes which have a quality or a growth orientation. And that's where cyclical sectors like energy, oil and gas included, metals and so on have been absent. And the reason for that is simple. In these schemes, we basically want to focus on sustainability and compounding of earnings. We want to have the predictability of earnings in front of us before we commit, ourselves to these businesses. Wherever we think that the outcomes are fairly volatile and therefore we can't predict the outcomes 2 or 3 years out with any amount of certainty, we would not invest in them. Once again, I'm repeating for the benefit of your viewers, this is true of all our schemes which have a quality and a growth tilt. Equally, you also mentioned sectors where we've been positive for fairly long. Private sector banks is one of them. Pharma certainly is another one of them. And I would say healthcare rather than just pharmaceutical. Pharmaceutical is just one part of healthcare. As we all know, the healthcare sector has really expanded over the last 5 years to grow beyond the typical pharmaceutical sector into hospitals, into diagnostics, into CDMO players who are becoming extremely critical to the innovator companies around the world and so on. Moving on, we're also positive on the consumption sector per se. And last but not the least, IT, which has been a contra call for us, for some time now. And here again, the rationale is very simple. The predictability of these businesses, the pricing power of these businesses, their ability to continue growing because of the low penetration of majority of the businesses across these industries is something which actually gives us a lot of comfort in terms of our ability to think of outcomes 3 and 5 years out. So the predictability in these businesses is much better in compared to the other sectors that I mentioned early on. And I think that's what is weighing on when we construct our portfolio. Yeah.
Get that point. So that's your investment philosophy, but investment is a lot about finances, yes, financial performance. It is also a lot about behavior. You've said the best wealth is created through delayed gratification and that investors should not expect positive returns every year. But the returns that we saw in the last 4 years, the SIP investors, they're checking returns monthly on apps. It's so accessible now. What realistic return expectation should a 5 to 10 year equity investor carry? It is very important to have that aspect in place when you start investing.
So once again, a great question. And I think every investor should be able to understand the true potential of equities as an asset class. Now, the construct here again is very simple. Look, equities, after all, are nothing but businesses which are thriving within India. India's economy on a nominal basis is growing, give or take, at about 11 or 12%. And if that's the case for the larger economy, then for the aggregates, whether it's the Nifty large cap or it's the Nifty mid cap, these aggregates also cannot grow meaningfully different from this number of 11, 12%. They can't consistently keep growing at 15, 16% for a full decade ahead of us. By the way, some businesses can still grow in high teens, maybe in the 20s as well, just like some businesses will grow in just single digit. And that's why it's important to understand where the aggregates would be and what can they deliver in terms of their earnings growth. And that's why it's important to keep the framework of nominal GDP growth and the commensurate earnings growth of the markets at large, whether it's the large caps or the mid caps in front of us, to have realistic expectations of the true return potential of equities. And if we were to keep this framework in front of us, then I would say Indian equities are primed to give somewhere around 12 to 14% return annualized over the next 5 or 10 years. Of course, active fund managers do have the ability to generate some alpha, that too through the cycle, not every year. And that's what we strive for, I would say. So maybe something slightly better than the indices, the underlying indices. But yeah, once again, this can't be too different from the 12, 13% number that I spoke about. So that should be the target returns investors should have in mind. And markets are always cyclical, by the way. They're always driven by the behavior of investors. Sometimes, markets deliver 20, 25% return over a 3 or 5 year period. To my mind, this is nothing but borrowing of returns from the future. Whenever this happens, usually the next few years are a little soft in terms of returns. The most important rule investors should always keep in mind is reversion to mean. If you have over any period enjoyed excess returns meaningfully higher than 12, 13%, then in the following period, you will have to give up, those excess returns. And the period can actually give you returns lower than 12, 13%. But through the cycle, if you hold it for a fairly long period of time, you should target something around, 12, 13 or 12 to 14% returns. Yeah.
Okay, that's it, 12, 13%. And I think we're facing that in 2025, 2026 as well, right, Mr. Tyagi? We've seen good returns before that, and now maybe a bit less in terms of returns for investors, but patience is what we should be the key for investors. On that note, let's just slip into a very short break. We'll come back and continue this conversation with Mr. Tyagi. Stay tuned in. Welcome back to MF Corner on CNBC TV 18. We still have with us Ajay Tyagi, President and Head Equity at UTI AMC. We're discussing his strategy, his thought on how mutual fund investing moves about as well. Mr. Tyagi, you spoke about high quality business is what you focus on. Sustainable growth runway, profitability is key when you're selecting a business. And holding them for the long term with a low portfolio turnover is what's been the strategy for you all. But quality stocks often look expensive at times, right? So how do you reconcile quality with valuation?
Once again, that's a great question, Vinny. So you're absolutely right. On the surface, quality businesses always look very expensive, but then they are expensive for a reason. You see, without getting technical, the earnings multiple or the P multiple, as we often discuss in the marketplace, is nothing but a shorthand for a more comprehensive exercise, which is nothing but what we call as discounted cash flow exercise, which basically measures the true worth of a business, not just from the perspective of the next 1 year or 2 years or 3 years, but from the perspective of the next 10, 15 years. And in fact, I would say even beyond that. Now, for businesses which are strong, which are actually growing their earnings year after year without seeing a down year, more importantly, without seeing a year of losses, and without exposing themselves to the risks of sometimes having too much of debt, which can lead to very dire outcomes for businesses during a bad phase of the economy. When we evaluate such businesses on a price earnings multiple, which I said initially is nothing but the earnings only of the next 1 year, they ought to be looking expensive because this price is capturing the true compounding nature of such businesses over the next 10 years rather than just the next 1 year. If you compare this to a business which is cyclical, which sometimes gives great profits, but then those profits can even see a decline and sometimes even losses, then any rational investor should be very careful in giving a very high multiple to just the next year earnings, because the next year number can be very, very volatile into the future. So I think that's the, I would say, basic premise between a very steady eddy compounder, where there is a much more predictability around not just growth in profits, but also growth in cash flows, versus a business where there is too much of volatility, where even the best of analysts can't predict, what the outcomes could be. So for instance, if anybody is evaluating an energy company, what should the crude price be? 6 months back, people were working with an assumption of $70. 2 months back, they were working with an assumption of $100. Now, perhaps they're working with an assumption of $80. How do you evaluate the earnings potential of such businesses over the long run? So for such businesses, you ought to be giving a lower price for the next year earnings compared to the more steady ones. Yeah.
And considering that so much has happened already, since you spoke about forecasts on crude oil prices, there was Russia-Ukraine war, COVID, then we had the West Asia war. So things keep changing for some of the businesses where volatility continues to be very high. Mr. Tyagi, you are on the other side of the table. You started with the basics of what a fund manager does. You run the fund. But if you had to advise a 30-year-old starting their mutual fund journey today, how should they choose a fund? Should they look at the past returns? Is it the fund manager, the philosophy, or the AUM size? Because a lot of them which have outperformed have huge AUM. So what's that one thing that investors generally get wrong when they are picking a fund, which you have seen over your almost a 25-year career, and more than that, actually?
Yeah, so you're right. I would say the first thing that any investor should start with is the asset allocation. Asset allocation is, I would say, even more important than fund selection. So you ought to realize whether you want to be 70% in equities or 60% or 80%. For each one, it's slightly different. And this is where the role of a financial advisor or a mutual fund distributor comes in. So that's basically the first step. Then the next step is what your question exactly was, which is how do you select a scheme? Here again, there are quite a few things you have to look at. It is indeed a very bad starting point if you were to base this decision only on the performance of the last 1 or 2 or 3 years, because, like the markets, performance also witnesses reversion to mean. The best funds inevitably go through a downdraft, just like, the funds which are, in absolute doldrums can actually see a very strong performance in the coming years. So this is where the importance of understanding the philosophy of that fund and that fund house is very, very important. So a lot of effort should go into that. And that's why, merely opening up screens and looking at the best performers of the last 1 and 3 years and then choosing, or allocating money to these schemes can be a very, very dangerous exercise. You ought to go, one level deeper, open the hood and try and understand the core philosophy, the strategy of the fund, how has the portfolio been. I remember when he spoke about, portfolio turnover ratio. Is the portfolio churning too much, which means that possibly lower conviction of the fund manager or the fund house. You also have to see what are the broad themes that the fund house is bullish on and whether they resonate with you or not. So I think a lot of this goes in. And of course, returns are important. So I can never undermine the importance of returns, but you have to see them over a fairly longer period, along with the risk that that fund has taken. So yes, returns are important, but you also have to measure that against the underlying risks that those funds have taken. Yeah. So I would say these are the few things that you'll have to take care of. Yeah.
Absolutely, sir. You know, that's for a first-time investor. They have to look at a lot of things. Just returns is not the only criteria. But what about someone who's already been investing, right? What would the message be right now? You see volatility coming in as well. They need to prepare for specifically any data points you would suggest. What should they be watching out for now?
I would say I'll take the big picture and put that in front of us once again. I think the big picture is, at least we are very confident at UTI that the country will continue to show us about 11 to 12% nominal GDP growth. Look, just like markets are cyclical, funds are cyclical, stock prices are cyclical, so is the economy. The economy goes through bouts of expansion and then bouts of slowdown. The economy has, and earnings therefore, have gone through their own share of slowdown over the last couple of years. Therefore, the stock markets haven't been too gratifying. If you also consider the fact that, maybe exactly 2 years back, markets were very, very richly valued, that is also leading to this consolidation. But like I said in response to one of your earlier questions, the potential for equities is somewhere around, low to mid-teens. You just have to be patient. We have seen many times, and these are not just times around COVID or times around great financial crisis of 2008 or 9, but also times in between when even a 5-year SIP has delivered just about 7-8% return. So it is not uncommon even for 5-year SIP returns to be just single digit. That doesn't mean anything. The average of 5-year SIP returns still measures up to that number of 13-14%. So if you are getting a little jittery and a little anxious about the fact that the money that you have been investing in very, very assiduously over the last 2-3 years is still not making respectable returns, I would say just continue with those SIPs. I would say what is most important to generate wealth as an investor is persistence and patience. If you have carefully chosen your schemes, I'm sure they will deliver the results to you in the fullness of time. And by the way, the last point, actually great returns and great investments are made during times when markets are consolidating and going nowhere. If you're catching a market which is making a new high every other month, then from a prospective basis, it may not turn out to be a great time to have been investing. On the contrary, perhaps today is a much better time compared to 2023 and 24. Yeah.
Take that point, Mr. Tyagi. Thank you so much for joining us with your insights. Very helpful discussion for new investors and for investors who've been investing since COVID and just saw those massive returns and now the downturn. So that puts things into perspective. With that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
A Nikkei, Hang Seng, Shanghai, Kospi, all are in the green.
And it won't be from us. We don't have to give them anything.
9 officials now project at least one rate hike this year.
Fed upgraded its inflation outlook and removed its easing bias.
Market reacted so negatively to the statement were the dot plots.
And the details have largely been in line with what CNBC TV 18 had reported.
0.1 higher on the Nifty and about 0.2 odd on the Nifty Bank.
The markets have been reacting to the Fed, the statements that have been coming in from US and Iran.
Well, it's been a quiet day for the market so far.
Since they target nearly 50,000 crore plus gross merchandise value.
Seminal event for India, the 26% fall in crude prices.
This is going to possibly increase services trade between India and the United.
Well, we recovered from the lows, so that good run continues. We are above that 24,100 mark.
Well, that is the day so far. Markets are kind of more in the flattish zone today, the indices at least, but there is a lot happening beyond the surface, below the surface rather, below the Nifty index, the Nifty bank, and so much in the broader space as well. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Nigel is with me. Nigel, hi. Afternoon.
Hi, Prashant. Today what's encouraging is also the money market action, because on the day when the dollar index showed some strength overnight, the rupee actually, after weakening initially, it went to around 94.7. That's pulled back to around 94.25 the last time I checked. So good to see stability in the rupee, even in the backdrop, where the dollar shows some strength. To be fair, when the dollar index itself had weakened, a fair bit, the rupee as well weakened. So this is good to see. I think some kind of stability in the rupee is something I think the bulls will like.
Yeah. I think those numbers are still doing the rounds in terms of how much will foreigners be able to, how much will NRIs put in, and we had a few numbers this morning as well from Federal Bank and others, etc. So I think that flow is very much keeping the rupee bid alive, even though earlier in the morning you had a bit of a sort of sell-off coming through. 94.28 or so is where now we are at. The Nifty bank, the mid-cap, small-cap indices, just take a quick look at all of them before we go any further. The Nifty is unchanged. We started there, we're there still. I mean, actually, we're pretty much, we've had a bit of a rally, bit of a dip, but almost unchanged now. Nifty bank is maybe a little higher compared to where it started in the morning. And the mid and small-cap indices, take a quick look at those as well. So 100 points higher, so nothing, about 0.15, and the small cap index is also about 57 odd points in the green. NSE advanced decline ratio is also not that. I mean, it's about 1,700 stocks are higher and about 1,550 stocks are lower. So about 150 stocks separating gainers and losers across the board. So this is a much more closely matched market as compared to what we've had in the recent past. Well, let's just quickly run you through what's coming up here in terms of the program. So we'll talk about individual names, and we'll talk about Bata, where there's a management change. We'll talk about Nykaa. We'll talk about a bunch of other names as well as we come through. Bata is still up about 6.5%, was up almost 10. New man at the top from Nike, by the way, at Bata. So Mangalam talks to us about that. Nykaa is the other one which continues to be strong. There are some numbers which the company's put out as far as aspirations are concerned. So that's coming up in just a bit. How should you position yourself is the question. Mitesh is with us with the answer. Mitesh, good afternoon. Good to have you here. What would you recommend?
Good afternoon, Prashant. See, on the indices, nothing has changed. Nifty is practically flat. The bank Nifty has moved up slightly. And I've been highlighting that the financials could slightly outperform the Nifty, and therefore banking index would do well. But broadly, I think stay long. There could be some intraday volatility, but so I have.
Okay, I think we are having a little bit of trouble. Mitesh, give us 30 seconds. We'll just sort of patch you in again, and maybe the connection will be a little better, but we lost him right there as he was about to start talking about levels and stocks, etc. But Just going back to Mitesh in a bit, maybe Mangalam is with us in the meanwhile, and we can sort of address those two names we were referring to earlier, Bata and Nykaa. Mangalam, take it away.
Well, let's start with Bata. Bata's got a leadership change. The announcement that has come in right now, Sanjay Rao has been appointed as the managing director and CEO of the company with effect from October 2026 to August 2031. It's a period of 5 years. The stock is up 7% on the back of that announcement, and there are two reasons why. One, over the last 3 years, if you look at it, the revenues of the company grew at a measly 1% CAGR. The profits actually declined by about 20% on an annual basis. And the stock, which was in November at around 2150 rupees a piece, has now come down to sub 700 rupees before this announcement was made. So it's been a rank underperformer. And what does Sanjay Rao bring as experience? Two things that really stand out as keywords for me. One, Nike. Second, Zara. What does Bata do? If it has to, increase its fast fashion quotient, then Zara experience helps. At the same time, if you look at, the footwear quotient, who better than Nike when it comes to designs and moving into the premium part, sneakerization of the world, if you must. And finally, if you go through, Sanjay Rao's LinkedIn profile, he marks himself as a turnaround specialist. So all these three things coming together for Bata, a company which has been struggling with growth, gets a turnaround specialist who has experience in both Nike as well as Zara. Can that be any better as a combination? Perhaps not. So, we are seeing a lot of excitement built in right now. Remember, he joins from October. Performance is something that the street will monitor more than just the credentials right now. But as of now, a leadership change is something that, is giving some hopes to a lot on the street.
What are valuations like, Mangalam, for Bata, if you've looked at them lately?
Well, lately the valuations have not been, particularly attractive, largely because while the stock price has corrected, you've had the EPS correct as well. Last 3 years, I was looking at it, the stock price is corrected by about 25% on a CAGR basis, whereas the net profit too over the last 3 years has corrected by about 20% CAGR itself. So which tells you that the multiples of the company have not, really compressed. It's more an earnings-led depression in the stock price than just a multiples-led depression that we're seeing.
But the gentleman, Mr. Rao, I think it was based overseas, right? He's not he's not based here in India, at least the last posting.
Yeah, he's not based here in India. Last posting was basically Senior Director, Nike Retail for France and another, country in that region itself. But importantly, what really stands out is that his Zara experience, the Inditex experience, works very handy in India because while he was at Inditex, he was instrumental in launching the Zara clothing into India with the joint venture with the Tatas. So obviously, it's not that he's completely alien to the Indian business. He's actually set up the Zara stores in India along with Tatas while working from the Inditex side.
Okay, I think stock was up 6.5, and they like what the backdrop and the profile. It's moved up to the day's highest point as we are addressing it. So another 4% as Mangalam was talking about, basically the profile of who the new CEO is and what he's done in his previous roles, etc. The other one is Nykaa, Mangalam, if you want to address that as well. The stock's up 6.
From foot to face, so let's come back up now. You talk about the beauty and personal care opportunity out here. Nykaa, the analyst meet is currently underway, but we do have their investor deck, which they've uploaded to the exchanges. And out here as well, they are speaking about a multifold opportunity. They expect from now to FY30, the gross merchandise value could be as high as nearly 50,000 crores or $5 billion. And they've broken it down into both beauty as well as fashion business. Beauty, obviously, they believe that, can be a multifold growth here and margin expansion too. From an overall company basis, they expect the revenues from current levels can become either 2x or 3x by FY30. EBITDA grows a shade higher by 4 to 5x. And margins, which are currently at around 7.5%, would grow to low to mid-teens from here on as well. So EBITDA margins double, EBITDA quadruples, and the revenue doubles or triples as well, depending on what side you're looking at on both sides of the range. For beauty segment, the gross merchandise value grows between 2 to 3 times. Healthy double-digit margins as against high single digits that the company is posting right now, with offline presence in 600 stores as well. If you look at the fashion business, that's been a bit of a margin drag. Now here, which broke even in the fourth quarter last year, they believe that they can get to high single-digit EBITDA margin by FY30. So that's a big jump from current levels. And they believe sustainable margins here could be over 10%. Two other call-outs that really stand out for me, their own brands, the House of Nykaa, which did about 3,100 crores in net sales value in the last year, could go all the way up to 5,000 crores. And if that were to happen, margins increase further. And add to that, we've also seen, their wholesale business, which is outside of the Nykaa ecosystem, they are selling to all the other retailers in the country, that business could do about 3,500 crores in gross merchandise value as against 1,200 crores earlier. They are targeting 1 million retailers in reach by FY30. So across the board, multi-fold opportunity is what the company is targeting, and that's what the street likes. Stock was up 5% yesterday, up another 7% today.
All right. Thanks very much, Mangalam, for that. So that's, consumer right on the top of the program. Two names, Bata and Nykaa, in focus. Well, let's just go back to Mitesh. We had a bit of a technical issue with him earlier. Mitesh, hopefully in a better line. Go on. What would you recommend?
I was giving a buy on Lupin with a stop at 22.90 for targets of 23.75. And the other one is ICICI GI or ICICI Lombard General Insurance. That's a buy as well. Keep a stop below 1800, look for targets of 1890.
Bata, any thoughts? The two names, first Bata and then Nykaa, which Mangalam was talking about?
So Bata, a big breakout, very good pattern over here. I think the stock had made a high of around 774 in April and then corrected all the way down to 650. So that could be a profit-taking point, but eventually I think the candlestick today along with the indicator position suggests that we should be looking at 850 over the next few weeks. So that's, maybe one target we can eventually even get past that, but 850 looks very logical and gettable over here. And Nykaa is something, which again, I also am interested into. The breakout was 282, so if we get a pullback, I think then the Nykaa stock looks like, heading towards levels of around 330, 325, 330. So very positive setup and a good breakout on Nykaa as well. Even if traders want to buy, 10, 11 point kind of decline should invite long positions.
Okay, all right. Got that, Mitesh. Thanks a lot. Well, let's welcome Deven Choksi onto the show. Hi, Deven. Good afternoon. Good to see you. When can Mr. Rao, who's coming in and taking charge in place of, Gunjan, can he change the fortunes of Bata? As Mangalam said, it was a 2,000 rupee stock that after today's 10% up move is at around 750 rupees. I'm looking at the last few years, they've stagnated at around 3,500 crores. That's around 4-5 years they've done just that. And margins actually have come down from 23% to around 20%. What's your view on the stock from here on?
Yeah, Nigel, good afternoon. Well, I have always seen Bata as a company which has got a fantastic amount of distribution reach, which is probably quite compelling kind of a proposition. If you look at exclusive outlets, I think of the company, they would be somewhere around 2,500 plus. They would have, I think, the merchant-owned outlets, I think, which would be more than 25,000, where multi-brand products are also displayed. More than 25,000 location presence that they have. And in the FOFO segment, that is the franchisee-owned, franchisee-operated segment, they would have about 700 odd kind of outlets. So from a perspective of looking at the reach, Bata has always been a very compelling proposition. Of late, I think one has also studied this particular company and found that they have actually started integrating the entire network of the company, the store network of the company, to suit the local demand and requirements. Up till now, I think they would be operating at a centralized level, and possibly, I think, as a result of which destocking was always being a bigger challenge. I think they have corrected this part as well. Now, with the Nike man coming into the company, what could be the differentiator? The differentiator could be product. If the distribution is right and if the products are compelling, then possibly I think you have prospects lying ahead. And that's what I think one would like to look at. We haven't yet had a chance to understand what kind of different product categories that they would like to bring in. But the fact remains that I think with a strong distribution network and if the product portfolio changes, it could be a good moat, I think, which one would like to look at.
It's a strong theme itself, right, Deven? I mean, not every management change will result in the stock performing, but there have been, and we've done pieces. I think Mangalam has done pieces. Nimesh has we've put out data in the past over the last 2 years. Exactly these kind of situations where management changes have resulted in pretty large, which have turned the corner in a pretty substantial way. For a range of businesses. So actually, as a data point, it's a pretty useful data point, a starting point. And then, of course, other things all need to fall in place and has to be the right strategy and all of that. I mean, the market matters, which segment they're in. But I think it's something to pay attention to with regards to when someone new comes in. I think it's happening in the case of Bata. Of course, I mean, here, the business, as Mangalam pointed out, has been suffering. Growth has been low. So there is room to do, at least try to do different things. And we'll see what the new strategy really is. Devin, I mean, the other big story tomorrow is going to be the RIL AGM. Any thoughts?
Well, I think the more importantly, the few announcements which definitely one would like to hear, and one among them would be on the Reliance Intelligence side. They have been putting across the data centers, both I think to offer to their own companies within the group network, and also in partnership with companies like Meta, where they would be offering, I think, a captive facility to likes of Meta by running the complete infrastructure. Back-ended connected with a complete, I think, the energy segment, the renewable energy segment, and in a way, I think becoming more formidable force in this particular space with even the LLMs that they are talking about, including different industry verticals that they will be providing. So one would like to listen more about how exactly Reliance Intelligence is being positioned in coming times. Their building blocks are in place. Second most important point, which everybody wants to hear, would be, I think, Geo Platform. Again, a large company, probably I think 40-50,000 crore offering in the marketplace at some point of time. And that's where probably would like to hear what kind of preparation that the company has made to roll out this program. In fact, I think the satellites, the LEO satellite that we are talking about, based communication, that is again, I think, going to be a big announcement that we are seeing it. So completely transform business as far as I think the Reliance is concerned in the customer-facing businesses along with the industrial businesses. In my viewpoint, I think these are 2 or 3 main areas where one would like to listen more in detail from the company.
Okay, all right, Deven, I'm going to turn the attention to metals yet again. I'm going to ask you about 2 stocks, Kirloskar Ferrous as well as Shyam Metallics. Let's address the news spaces first. Kirloskar Ferrous is up close to around 10%. The stock has come off a little bit from the top as they bagged a small but clearly an effective order. Now, do note the stock was down close to around 25% from its 52-week high. What's the news flow we got overnight? Well, they received a contract for supply of pig iron. The buyer, well, he has an office in London, UK. That's what they've disclosed. In terms of order details, the order deals with a supply of around 30,000 tons of basic grade of pig iron on a FOB basis. The contracted value, well, close to around $13.5 billion. And this has to be completed by 15th of August 2026. So a small but effective order, 30,000 tons on a capacity of around 7 lakh tons basically means that it's close to around 4%. But they're seeing a big outsized move. So clearly the street is looking at other factors and getting excited about the stock after it corrected from 650 to 450. Next up, Shyam Metallics. That one's buzzing in today's trading session. They have laid out a very, very ambitious 2031 target. To give you the numbers, on revenues for 2031, they're talking about around 42,650 crores. On the EBITDA front, 6,236 crores. So big numbers. Just take a look at it. They're looking at a surge from current levels. On ratios, they're talking about 20-22%. They'll stay net cash positive, and also they'll be focusing on the value-added downstream products. The key EBITDA drivers for the next few years, talking about such big numbers, what's going to drive that? Stainless steel currently is very small in terms of an EBITDA contribution. But the focus is clearly there because they're talking about the number going to around 1,100 crores. Carbon steel, currently it's, the key part of their business at around 1,700 crores. It'll go up, but not in the manner that stainless steel will go up. So it'll go to around 2,900 crores. And on SBQ, which is special bar quality, that's likely to report close to around 1,000 crores of EBITDA. So that's how they come to that enormous number of around 6,200 crores or thereabouts. They'll require capex. $1.1 billion of capex is what they're looking to deploy over the next 4 to 5 years, which will be funded by internal accruals. They're saying there'll be no debt. And the past record has been pretty good as well. Over the last 20 years, the CAGR has been around 20% on revenue, EBITDA as well as PAT. But keep in mind, that's on a rather low base. Jefferies, they're enthused post this analyst meet that was held yesterday. They have a buy rating. They have upped their target price. They are factoring in the EBITDA moves up as well as EPS move compound at around 14 to around 16%. They also go on to add that this is one of the best growth potential stocks in the metal space here in India. So stock is up 2.5%. Any view on either of these names, Deven? Do you like either Kirloskar Ferrous or Shyam Metallics?
So I think the pig iron and the coke supply, I think, has been always, something which I think we have looked at in kilosquare ferrous. Now, due to the war-related issues, I think the coke supply probably was becoming expensive affair, which now, at least, I think that part is taken care of in form of, I think, the price is coming down. So that is an important point from the profitability point of view. Second most important point, which I find that with this UK business getting started with effect from next month, it appears that I think many of these particular companies who own their export business are likely to be significantly large beneficiaries. Few of them with whom we have been talking in general, I think they have been extremely optimistic about the FTA business bringing a good amount of collection for them on form of exports, and at the same time higher amount of profitability. So could be, I think, one of the possibility for this kind of companies to look at from the perspective of seeing the higher amount of growth, both in form of the turnover exported and at the same time, I think, lower amount of input cost because of the ease of the supply chain logistic pressures on the import of coke oil.
Okay, got it. Deven, I wanted to ask you about these kitchen appliance makers. Any view on either of them? You know, Stovecraft, that's been the biggest underperformer among the three listed players. That's TTK Prestige, Hawkins, as well as Stovecraft. But in the last 1 month or so, the stock is up close to 20%, though all these three stocks, they're either down between 25 to around 50% from their peak. Now, valuation-wise, you're getting comfort with Stovecraft, and we spoke to the management, I think, 2 weeks ago. They sounded very optimistic. For the time being, the stock is at the high point of the day. You like any of the three?
Honestly, we don't have any coverage, so I think won't be able to give any specific price, target price, etc. But we have been looking at the space, and probably we have been finding that post GST cut in various cases, the products have become, I think, more affordable, and as a result of which, we are seeing a traction in most of the cases, including in the white goods products case. So frankly, I think that's where many of these companies have been remaining extremely comfortable about the journey going forward. And current year, despite of whatever the first 2 months of current year in which the war-related situation has affected, including on the input side of the activity and even the production side of the activity for some of the companies, still I think the demand scenario is remaining absolutely robust. So yes, I think they are likely to see the better current year in times. Maybe I think valuation-wise, I have not looked at them enough, but maybe slightly priced, I think, as I would like to call it as. They are not completely available at the cheaper levels.
Got it. Okay. All right. Thanks a lot, Deven, for joining in. Valuation's not very comforting, though Deven and team are having a look at it, the kitchen appliance makers. So I think good time to slip into a short break. You come back, we'll have Rahul Veera, who'll be joining in to help us out with his view on the markets. Stay tuned. Hello and welcome, back to Closing Bell. Well, it's that part of the show where Hormuz joins in, and he, as always, will bring us something very, very exciting. High valuations in the Indian market have been a concern for domestic as well as international investors alike. But do higher valuations also imply underperformance? Well, as per Jefferies' note, multiple sectors have seen strong returns over the last few years despite valuations being high. Hormuz joins us to help us out with all of those details. Hormuz?
It's a very interesting analysis that Jefferies has done, and they also are of the opinion when we usually talk of high valuations, we usually talk of it with a tinge of concern. But here they have highlighted 8 sectors over the last 15 years where their valuations have been significantly higher in comparison to normal levels. But despite that, they have managed to deliver strong returns over the next 2 to 3 years. Now, which are those sectors? Well, they have highlighted defense, retail, NBFCs, cement, FMCG, capital goods, hospitals and hotels. I highlight a couple of them for you. Now, for example, defense was analyzed between September of 22 to July of 24, and by September of 22, their 10-year average multiple, the valuations were 41% higher than their 10-year average multiple, and despite that, they still managed to outperform the Nifty by a whopping 229%, and it was led by a 33% EPS CAGR as well. What led to that? The indigenization push, strong order visibility, import substitution, all of them contributed to this defense outperformance despite expensive valuations. Take a look at NBFCs as well. Over a 5-year period between October of 21 to February of this year, the valuations for the NBFC sector as of October 21 had gone up as much as 78% higher than their 10-year average, yet it managed to outperform the Nifty by 40%, and that was led by the rising credit penetration, improved asset quality after the IL&FS incident, and of course scalable digital models as well. And the one sector that continues to be in the spotlight even today is the capital goods space. The first bits of re-rating happened in September of 2022 when the valuations at 32 times were already 28% higher than their 10-year historical average, and yet they managed to outperform the Nifty by 90% along with the 26% earnings CAGR. Now, what led to that? It's a revival in the investment cycle after COVID-19, strong order inflows, better margins, all of them fell into place. Now, there is one more sector that is joining this category, and that is power. Why is that so? Jefferies believes that supply and demand side drivers are aligning, and therefore the power stocks are among the best structural plays in the country currently, as there is a strong demand visibility, the balance sheets of the state electricity boards are improving, and the demand from the data centers is also on the rise. Then they have highlighted among their top picks JSW Energy, Adani Energy Solutions, Premier Energies and Siemens Energy going in with their thesis of hard assets. So they have highlighted that despite expensive valuations, sectors have done well in the past and they expect power to follow suit.
All right. Thanks very much, Hormuz, for that. That is interesting, as always. There is news at the bottom of the screen. Lloyds Engineering has made an acquisition. Lloyds Engineering, the stock is... Nigel will have more on this, but the stock basically has doubled in the last 2 months. So from basically 40 to 85, I think it was up 10% yesterday as well. And they're making an acquisition which is about just under 1,100 crores in size. Nigel.
Well, that's right. Just a couple of words with regard to this. I think the Steel Infra Solutions, that's the entity I think that is owned by Ravi Uppal. Ravi Uppal, as we know, I think he... if I got the name right, he used to be the MD of JSPL. So the acquisition is close to 1,000 crores. But I think, they've also gone ahead and they've done a pref issue as well. There's an issue of shares that should come up for you on the screen. And there are some marquee names in there. I think MK Ventures as well is in there. The issue is done at close to around 70 rupees, And Mr. Ravi Uppal is also part of that issue. So the consideration appears to be around 1,000 crores. Part of that will be via shares. Part of that will be via cash consideration. So the stock, as Prashant mentioned, had run up. But I think, close to a year or 2 years or so ago, it was at the similar levels. Then it saw a sharp correction. Mr. Prabhakaran has come in as, as an investor. And we know that when he came into Lloyd Metal, that's where the big turnaround did start off. So, yeah.
He came in at $49, right?
Yes.
48, 49 rupees.
Yes.
And that's basically when the move started. And, it's a very, very sharp gains in a very short period of time. But the thing is, I think the deal is financed through some stock and cash.
Yes.
So when, your stock's done so well, the acquisition is... is cheaper. I mean, because you're paying with
Share swap is actually close to 50% of the acquisition. 1,073 crores is what the acquisition is, and the share swap is around 500 crores or thereabouts. So we'll have to see strategically. The management has put out very, very big guidance for Lloyd's engineering works. So this is part of that as well. Organic, inorganic growth. I think they're going to be putting in another entity as well, merging it into this entity. So we'll have to see how that goes. For the time being, there is some profit taking, big warrants issue. A big acquisition as well. We'll have to see how it pans out.
What's the market cap, Nigel?
It's 12,000 crores.
12,000 crores. Okay. All right. Well, that's the Lloyd's Engineering stock as things stand right now. And half financed by a stock which has doubled in the last 2 months, so which is good. I mean, from an acquirer's point of view. Rahul Veera is with us, fund manager, equity investments, Nippon India AIF. Rahul, good to have you with us here. Good afternoon. Good to speak with you. There is a bull market, and the bull market and the euphoria is in capital goods / industrials, right? That is the one pocket, and then the entire mid and small cap part of the market gets blamed. But actually, the euphoria is in 1, 2, 3 of these pockets, right, Rahul? So what are you doing in that broader space? Because lots of action, lots of opportunities.
Absolutely. So we are seeing the mid cap and small cap doing relatively better going forward. But what we did is we did one very small exercise from 2009 to 2019. We pulled out the data in terms of the valuations for around 800 companies along with the newer listings. So Nifty 500 plus all the newer listings. We found that 66 companies, that's across IT, your FMCG and banking and financial services, are still trading lower than the 2009 to 2019 cycle. Now, that cycle also saw some demon, GST, all the NPAs that were happening. So private banks at this point of time looks pretty good to us at this point of time. Capital goods, we have gone on an equal weight. Last year, we were overweight. We've been reducing the overall weight in the cap goods side. Beyond that, consumer discretionary is something that we are looking forward to. We believe some of the names have corrected very sharply. There are some decent opportunities there.
Got it. Hi, Rahul. Good to see you in. Name a couple of opportunities, right? If you could disclose, I mean, a couple of stocks that you all have bought into with due disclosures. We'll take it on the screen.
I would avoid refrain from taking the names, but from a consumer discretionary, for example, some of the luggage companies are doing very well. We are seeing the competition going off given the PVC prices, the luggage imports that were happening from China. So there is very minimalistic competition going on for one of the large players there. Beyond that, some of the private banks, large private banks are trading between 1.5 times to 1.8 times price to book on a forward basis. Look very attractive to us at this point of time.
Okay, so the luggage player is the one that's got a new promoter or the one that's been growing very fast?
I'll refrain from discussing that.
Or both of them?
I'll avoid any further discussion on this, please.
Okay, got that. But you've been quite, enthusiastic on this space itself, I think. So travel as well as, I think the other stock that y'all had, I mean, if I look through the large trade details, I think Taj GVK is what you picked up a large chunk out there. What about hotels, tourism? You're still bullish on that?
Absolutely. See, from a 3-year perspective, we believe this space is going to continue to grow. Your average room rates are growing at 8 to 9%. The supply is very limited across the tier 1, tier 2, tier 3 cities. And given all the geopolitical issues that are going on, we believe the domestic names will do slightly better than the global names.
Sorry, so you're saying local will do better than the global
yes.
companies. Okay. By the way, the market's seeing a bit of a spike as we speak. If the Nifty will tell you that we're up about a quarter percent. So from 24,100, we've basically added on about 50 odd points in the last. It's come through in the last couple of 2, 3, 4 minutes or so. That sharp spike we're talking about. Maybe just take a look at the Nifty Bank as well. There is a bit of a move, but I think it's more pronounced as far as the Nifty is concerned. But the Nifty Bank has also moved higher as we go into the last 30 minutes or so of trade. So that's that. Just a quick word. I think if you look at the portfolio breakup, Rahul, financials is still the top weighted, right, for you?
Absolutely. So banking and financials, consumer discretionary, pharma is something we are very positive for the next 1 to 2 year perspective.
PFCs. These are banks?
Equal weight or basically reducing weight in the cap goods sector from this point of time. And IT, we continue to remain underweight there.
I see. This bank, the financials is largely private banks, or it's a mix of everything?
It's a mix of everything. So overall BFSI, banks plus capital markets plus your PSU banks. Across the sectors, we have the names in our portfolios.
I see. And industrials, capital goods, etc., you're kind of trimming as you go along.
Yeah, we are continuously trimming the names because some of them are trading at like 60 to 80p. We believe any one blip, or in terms of what we saw recently in one of the names where one of the large order got cancelled and the suddenly stock went off. So these high valuations cannot sustain beyond a point.
Yeah. Within that pack, defense, right? Many of these stocks are back to, I think they are back at Operation Sindoor kind of levels. If that is a marker in that sense, either it's a double top in the making or these are fresh breakouts. What's your sense, Rahul?
See, going forward, we saw the total export data, right? For FY26, almost 1.78 lakh crore was the export from the defense side of it. So government order book will continue to increase. Valuations from a 1 year or 2 year forward basis, it will never make sense. You'll have to play it as a theme. So from a 3 to 5 year perspective, how the cash flows will turn out, how the government is going to see defense as an opportunity. So between 11 lakh crores, the total capex that was allocated in the budget, right? So power and defense is something that will continue. Your role and road and railway might see some kind of a reduction this year, given the balance sheet of the government.
I see. Got that. And I see some healthcare names also in the portfolio, Rahul. There's on the hospital side.
Right. So see, they are continuously, if you see the ARPOBs or the margins, again, what are the capex cycle for the hospitals had to, for the past few years that we saw margin compression for some of these names. We believe the businesses will turn around from here on. The newer acquisitions, some of these names have done, improving the margin profile, ARPOB profile. And again, valuations from a 3 to 5 year perspective seems very sustainable at this point of time.
Okay, got that. Rahul, we'll leave it there. Quick conversation. Thank you very much for joining us. Really appreciate your time here on CNBC TV 18. We'll take a break. We are back. We'll get you what's happening in dealing rooms with Nimesh on D Street Chatter and some trading ideas as well. Stay tuned.
Welcome back. Well, keep an eye out on Bajaj Auto because the record date has come, on the exchanges just now. Remember, they'd already announced a buyback, and I think the buyback price was approximately, 12,000 rupees approximately. Yeah, 12,000 rupees per share is what the buyback price is. But what's new is now they've set the record date on the 24th of June. So if you have to be eligible for that, you'll have to buy it on T-1. I think on 23rd, that will be the last date. So that's why you're seeing an additional fillip that's come in there for those that are purely paying it for this particular event. That is the buyback. The record date has just been uploaded on the exchanges, 24th of June. It is, so it spikes up a little bit. But good time to get in Nimish. He's here to tell us on D-Street Chatter what's going on in dealing rooms. Nimish?
Well, another strong day for the market as it consolidates with a positive bias and backed by FI buying as well. For the last few days, we're seeing the trend of FI buying has resumed, and that's the case today as well. At the same time, there is a lot of supply of paper coming in. Even today, there were a couple of large blocks. So the trend of large QIPs blocks continue. Today, for instance, the number will look a bit larger because of the large two blocks, which was amounting to close to 1,600 crores. So that's something to watch out for in the institutional data. Having said that, as I said, there is a bit of consolidation with a positive bias. But on the upside now, 24,250 can act as a bit of a resistance. So that's the level to watch on the upside. But broadly, this momentum in the broader markets and in Nifty seems to be backed by a bit of FI buying as well.
Okay, got that, Nimish. What about individual stocks that are on your radar?
Well, in terms of individual names, the first stock on my list is Shaily Engineering. That's been under pressure today after a large block. Nearly 11 lakh shares got changed hands, and I believe one of the domestic mutual fund was a seller in today's block deal. So disclosures, if any, could be interesting to track in Shaily Engineering. The second name is Bharat Coking Coal. That's been buzzing as well on very large volumes. In general, there has been buy flows at HNI desk, and I believe one of the leading HNI investor has an active buyer as well in Bharat Coking Coal of late. The third name is Jyoti CNC. Even that's been consolidating in a narrow range of late, but I believe the management happened to meet some large investors in the last couple of days, and there is a very strong indication of a large order win as well for the company very soon. And the last is DLF. Even that's been buzzing in trade today on good volumes. I believe there were multiple block deals as well in DLF today, but additionally, some larger HNI seems to be actively buying as well into DLF in the last couple of days.
Okay, thanks a lot for that, Nimesh. Well, let's take a quick check on the F&O markets. Then the India VIX continues to cool off. Remember, the India VIX had gone dancing away to 29.30 when that war was on. So that's cooled off to sub 30 now. That's one of the indicators of the kind of move that we see in the market, and fear is gradually, subsiding in the market. Once it breached that 15-odd mark, from there, I think we have seen another 400-500 points on the Nifty itself. The PCR, that's holding at around 1, so it's more or less in the middle of that range of 0.6 to around 1.6. Put writing is evident. 24,100 put premiums half to around 80 bucks from around 160 rupees. But on the flip side, I think the bears will want to protect this 24,250 mark. The reason I say that is at the 24,100 call, the premium out there is 150 rupees. And if you add that to around this 24,100 call, let's pull up the 24,100 call. It should come up for our viewers on the screen. Yes, that's the one that I'm talking about. That one was around 150 rupees. So if you look at the 200 DMA, that comes in line with around the 24,250 odd mark, which is the next resistance zone from a bullish perspective. The Nifty Bank, that's the one that's leading the way. It continues to outperform. And HDFC Bank, the big underperformer, that's come into play as well. And as we speak, that's at around 800 rupees odd. Individual stocks, Keynes, that's been in the F&O band. That's coming for a bit of a short covering bounce. So good move is what we're seeing out there with the open interest down. I think that one, in fact, could be one of the candidates to come out of the F&O band. Let's see how that goes. Trent is the other one that's seeing a bit of a short covering bounce. But on the flip side, you have Radico that's seeing some fresh buying in today's trading session. So the screen is looking good. The Nifty Bank is leading the way. And you have the big boy, HDFC Bank, that's woken up from its slumber. Will be good times for the Nifty as well as the Nifty Bank from here on, if that can continue with this sort of a momentum. Midesh Thakur, those back with us. Midesh, what are your buy or sell call recommendations that you have?
Last 1 hour, actually, has been very good, and that kind of reaffirms the uptrending movement. So we'll take some BTST calls. MFSL was a BTST with a stop just below 1675.74. Look for a 1705, 1710 kind of a target for tomorrow or day after. And the second stock which I like, that's Page India. BTST with a stop below 39,900, 39,890 and a target of 40,254.
Got it. Okay. All right. Thanks a lot, Mitesh, for that. Well, let's focus on the big IPO. NSE has filed the DRHP with the market regulator. Yash is with us to fill us in with all of those details. Yash?
Well, the largest stock exchange in the country coming out with the largest fundraise through an IPO as far as the history of Indian capital markets is concerned. A closer look at the DRHP document would tell you that the total number of shares that are on offer through an entire offer for sale issue is about 14.89 crore shares. This forms about 6% of the total paid up capital of the National Stock Exchange. We had reported this thing yesterday and we continue that. That is, the IPO size is likely to be expected between 30 to 32,000 crore rupees, and that would value the National Stock Exchange at 5 to 5.33 lakh crore rupees. As I said, it's the largest fundraise in the history of Indian capital market so far. Who's selling out of the NSE's OFS portion? The largest selling shareholder is State Bank of India. They have about 3.23% stake in the National Stock Exchange, and out of the total shares which are on offer, their portion comprises of about 16.6%. The next one is MS Strategic. They have about 1.2% stake and they offer about 10.75% of the total shares on offer as far as the OFS is concerned. These are the companies on the extreme left. You'd see how much they hold and how much they offer. Stock Holding Corporation, GICRE, various other PSU institutions coming together to offer partial stake as far as the OFS itself is concerned. Now, in terms of, as I said, the paid up capital, total about 2,475 crore shares. What is on offer forms about 6% of the equity paid up capital. In terms of revenue and the financials for NSE, FY26 was a weak year in terms of top line growth as well as the operational performance of the National Stock Exchange. But do remember, by the time the company files its RHP, it will release the first half numbers for FY27. So those numbers will be very crucial in terms of how the company is performed in the first half of FY27. As far as the next slide itself is concerned, here in terms of market share, this tells a large story in terms of the domination which NSE has had in Indian capital markets. Cash market segment about 93% market share, equity futures about 99.8, equity options about 74.5, currency futures 99.5, and currency options almost entire market belongs to the National Stock Exchange.
All right. Yes, thank you very much for that. So that's interesting. Well, we spoke with, Mrugang Paranjpai, ex-MCX, on his thoughts on the upcoming NSE IPO. Listen.
Can you imagine that one single stock like NSE, with the amount of foreign holding that it allows, can actually draw in close to the amount that we talked of in the entire deposit mobilization? Maybe $40-50 billion of FPI investments can just come in purely because of one stock of NSE, which will draw lots and lots of foreign investors. I would expect a lot of, sovereign funds, all of that sort of long-term and very, very strong capital flows coming in. So it's not going to take away. In fact, to a lot of people who've been suddenly saying that, hey, India's lost the flavor, etc., we might be able to add back and get the capital allocations coming a little more towards our side with something like this.
Sudeep, welcome to the show. What do you make of this large IPO? We've been hearing about it for a while, and it could probably see the light of day in the next few months. What's your preference? BSE has been a super-duper outperformance. It has good amount of momentum. But now NSE could be coming to the bosses, and it will be at a discount in comparison to BSE. So your preference among exchanges, NSE that could be listed, BSE and MCX that have been big wealth creators?
Well, I think it's a very welcome development, Nigel. And I think, overall, from a capital market point of view, it's a good news. BSE also will gain. Remember, NSE is going to get listed in BSE. And BSE cash market volumes are expected to go up significantly. So one indirect beneficiary will be BSE as well. But if I have to pick one stock amongst the exchange stocks, Amongst the listed ones, I've been preferring MCX for quite some time, and I do continue to prefer that. Once NSE gets listed, let us see where the valuation settles. Post that, we can take a call. But at the valuation which is being talked about, at the offer price which is being talked about, it of course is at a discount to BSE's price today and does look attractive compared to BSE. But let's see where it settles post-listing.
Yeah. But you out of the lot, you like MCX, right, Sudeep?
That's right.
Yeah. Do you own a NetWeb, Sudeep? I think we discussed this earlier, not lately, but I think it's at a new high, 5,100.
Well, Prashant, unfortunately, I don't own it. But the excitement, obviously, this entire AI-related excitement is getting played in India through only a handful of stocks, and NetWeb is one of them. Not sure about whether it's justified or not, whether we can impute an AI valuation to NetWeb, but that's what is happening. I don't think I will recommend a buy in NetWeb at current levels or try to buy this stock at these levels.
Yeah, I think in the case of NetWeb, Sudeep, they are not. I mean, in most of the data centers being built are not AI data centers in India. They will come, but they are more standard data centers. And where NetWeb comes in is basically racks and servers, etc. GPUs, of course, they have to depend on NVIDIA, but they also are distributors for NVIDIA in India. But they do racks, server racks, etc. But the point is they're a kind of a late cycle player, right? You got to build the data center, you got to do all the wiring, cabling, all the EMP work, and then you put the servers in. So the ordering at some level for a company like NetWeb will only start after all of this. So this will, right now we're hearing these big announcements, but all of this will translate into orders in a big way only, I guess, a little later. So it's not an early cycle play in that sense. Of course, and the play is data centers, it's nothing else for this one. Lots of stuff moving around, and we'll talk more. We'll take a break. Sudeep, stay with us, and we come back with a few more names on the other side.
Welcome back. Well, let's squeeze a couple of, questions into Sudeep. We have some comments coming in from the RBL Bank CEO as well. I think we'll tag the correct stock. India remains the fastest growing major economy driven by rapid digitization. The RBL stock actually should come up for you. We'll get that corrected as well. Sudeep, any view on RBL Bank? The stock ran up in anticipation of the deal. The deal got concluded. The stock ran even more, after the initial news flow got cleared out. Your view?
Well, I've been positive on RBL. I think it's a good deal from an RBL Bank point of view. They needed capital, they needed growth, and they needed certainty as far as promoter is concerned. They've got all through this transaction, and I think it's a long-term positive for the bank. And I expect the stock price to keep moving up. Performance also has been improving. Stability in management will do wonders. That's what I believe. Overall, BFSI, our view has been positive, and we do like RBL, and also we like IndiGo, which I thought I'll mention because it's a turnaround case, and we do like that as well.
Okay, got it. RBL as well as IndiGo, got it. What do you were earlier bullish on aluminium, right? On all these players, Nalco, Hindalco, Vedanta Aluminium is just listed, and you have a couple of brokerage calls that have come out. What's your view? Aluminium price was $3,850 per ton around 7-8 trading sessions ago. Now the war is called off, which is good for the globe, good for equity markets, good for humanity. But it may not be so good for aluminium because aluminium was factoring in a war premium. That's come down, though structurally it appears it'll be in deficit. Your take?
Well, I completely agree, Nigel. I think the war premium is gone, but structurally there is a deficit. The 10% of world supply, which comes from the West Asia region, it will take some time before the supply is restored. Anywhere between 1.5 years is a time which our guesses will be required. And aluminum prices will continue to remain at elevated levels. It may not reach the stratospheric levels it was, but it will remain elevated. And companies like Vedanta Aluminium will continue to gain because of that. Also, look, specifically Vedanta Aluminium is fully integrated. They're expanding production capacity, and they are definitely very well positioned to take benefit of this aluminium, for lack of better word, super cycle.
Sudeep didn't ask you about Bata India. We discussed it earlier. Look at the stock. Oh boy. It's up 16% now. At 230 when we started, it had come off the highs and it was up some 7%, 6.5%, 7%. It's up 10% from that point on in the last 1 hour or so. Any thoughts, Sudeep?
Well, Prashant, I think this is one stock which can do wonders. I mean, today's excitement is on the appointment of the new managing director who's coming from Nike. But I think this has got a fantastic potential. They have got an unmatched distribution across India. Every nook and corner, you have a Bata shop. The product and the pricing and positioning was probably not appropriate. That's why they could take the benefit of the massive distribution outreach. Now, somebody with the right skill sets and somebody with the right efficiency coming in can really turn around the company, and it can be a multi-bagger even from current levels.
Yeah. So that's an interesting one. And as I was saying earlier, management changes could be interesting things to look at more deeply, study more deeply, because some of them have turned out to be big winners over a period of time. And Bata, of course, is especially depressed. Price has been depressed because earnings have been depressed for a while now. So 790 on Bata at close. It's clearly the stock of the day. By a mile. And huge volumes, by the way, not small volumes at all today. Okay, so we end about 90, 95 points in the green, and almost all of the 90 points have come in the last, 40 minutes. 255, the Nifty was at about 24,100, and we ended about 24,180. So that's the final thing. Nifty Bank, mid-cap, small-cap indices looking good. And if you want to go sectoral, tourism, top gaining sector, healthcare, the CPSE index, real estate is the index. And perhaps the only loser was the IT index, which was down across the board, cuts coming through today. Now, Max Health was the biggest Nifty gainer by far, 6.5% gain. Adani Enterprises was up at number 2, and there was IndiGo, which did well. As I said, Infi, TCS, Wipro, the big losers as far as IT on the Nifty go. And of course, I mean, in the broader space, there is Bata, but there were NetWeb, there was CDSL, and so many else, so much else which did, very well. So KPR Mills was up 14, Keynes and DLF and Astra Micro, Electra, Nelco, Radico. I could go on with enough and more action to see us through this Thursday afternoon. On the other side, I mean, maybe Shaily Engineering was down 5.5%. It's the big volume-led cut. MCX was down a little bit, 1.25%. Walkhard was down 1.5%. Varun Beverages sold off about 2%. And there was a Paytm which was down about 2.33% or so. So that's the picture. That's the day. Sudeep, thank you very much for joining us on closing. But stay tuned. Stay with us in Markets Forward coming up in just a bit. Thank you for staying with us on the show. More on the other side.
Indian markets end higher for a fifth consecutive session, extending their winning streak amid broad-based buying. The Nifty closed above the 24,150 mark, while the Bank Nifty outperformed.
Textile and Alcobev stocks rally after the India and UK move closer to implementing the free trade agreement from July 15. The deal will grant zero duty access to nearly 99% of Indian exports to the UK, raising hopes of stronger export growth and improved competitiveness for Indian companies.
Consumer-facing stocks surge in trade. Nykaa unveils an ambitious FY30 roadmap at its investor day. Target 2 to 3 times revenue growth and 4 to 5 times EBITDA growth. Bata appoints Sanjay Rao as its new MD and CEO for a 5-year term.
Good evening, you're watching us here on Markets Forward. This is your go-to show where we aim to get you all the important updates and key data points that you need to get up for the next trading day while recapping today's session as well. I'm Mangla Malu, with me as always Sonal Bhutra, doing extremely well for the markets. Sonal, towards the end we saw that big spike. 24,168 is where the Nifty ended, much above 24,150, very close to that 24,200 mark as well. And a large part of that spike came in the last hour of trade, as we can see, and that was led by the Nifty Bank. All through today's trading session, the Nifty Bank did well. There was a bit of a tug-of-war between both the Nifty Bank as well as the IT index, but at the end of it all, it was the Nifty Bank that took the cake away. And then we did see some notable contributions coming in from names like Interglobe Aviation. Reliance too moved off its lows, and some other index heavyweights doing a lot better too.
How did you forget consumption? Because consumption stocks were all we could talk about through the course of the day. Of course, that index did underperform something like a banking index, realty, financials, but did well in trade today. It was up around 0.5%. Most of the sectoral indices ended in the green today. So yes, fifth consecutive day of gains for our own markets. We'll discuss that and a lot more, but let's tell you what we do have as a lineup and what do we have in store for you today. We start with top movers and shakers of the day with Hormuz Fatakia. We break down the rally Nykaa and textile stocks today, along with Bata India's leadership rejig as the company positions itself for its next growth phase. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session. So let's get to the first segment of the day now. Hormuz Fatakia is joining us now from the big wall with the top movers and shakers of the day. Hormuz, over to you.
Another good day for the markets, right? And it's the last hour of trade when the heavyweights pulled the index higher today. The Nifty Bank continuing its outperformance, and that shows in the contributors as well. HDFC Bank, SBI, all of them pulling their hand up and ensuring that the Nifty ended higher in today's trading session. HDFC Bank now back at 800, SBI nearing the mark of 1,050 as well. Some of the other notable contributors today are Max Health and NTPC as well. Max Health ending with gains of 6.5%. The India-UK FTA had its impact across sectors, textiles being the predominant one, of course. KPR Mills ending 13.5% higher. Gokaldas Exports also doing well. Welspun Living of another one that saw double-digit gains in today's session, and among the liquor names, it was United Spirits that did well, 3.5% higher on this one as well. Among the newsmakers, you look at Nykaa, the ambitious growth plans that the company has laid out, the stock ended 6% higher. Lloyds Engineering, the acquisition announced by them in Reddington on reports of Apple looking to raise prices of its products, ending 10% higher in today's session. Some of the high-flying names from earlier in the weeks are seeing some profit booking today. IFCI ended with losses of around 8.5%. IDBI Bank was up 18% in yesterday's session, ended 6.5% lower today. Some sell-off also seen in Paytm and in Azad Engineering. And the one stock that took the limelight in the last 30 minutes of trade was Bata, and that is after the announcement of its new MD and CEO, 16% higher on the stock. The last time a stock had gained at such a quantum was all the way back in March of 2006. That's the kind of moves you've seen on a day like today for Bata.
All right, take that point. Hormuz, thanks a lot for that. You spoke about Bata and a bunch of other stocks as well. We missed out on consumption at the opening of the show largely because throughout the show we'll be talking about just that itself. And let's kickstart with FSN e-commerce, the parent of Nykaa, where, you know, the company met a lot of analysts and they laid out their ambitious growth plans for FY30 as well. What is it that they're saying? Well, to start with, their overall gross merchandise value would actually jump over 50,000 crores in the next 4 years from now. 50,000 plus crores is the gross merchandise value that they're targeting, nearly $5 billion. And they've broken it down on the revenue, EBITDA and EBITDA margin basis as well. The revenue from current levels could double or triple depending on what the industry does, at least double, and they can also triple. And were that to happen, the EBITDA will grow a step further. 4 to 5 times growth from last year's EBITDA is what they're expecting. Margins, which are currently at 7.5%, will also double to low to mid-teens in FY30 from FY26. And in their two important verticals, the beauty vertical, they are expecting margins to come to healthy double-digit. This compares with the high single-digit that the company is reporting, with the GMV out here as well, growing 2 to 3 times. Fashion, which has been the margin drag for the company, broke even just in the fourth quarter last year. That's likely to report a high single-digit EBITDA margin over the next 3 years as well, with the GMV jumping 3 to 3.5 times. Steady state margins here, they see over 10%. More importantly, their other businesses, House of Nykaa, which is their own brands, they expect there too the revenues to be over 5,000 crores. This was about 3,100 crores in FY26. And the B2B superstore business, they expect from about 1,100 to 1,200 crores of gross merchandise value to jump all the way up to 3,500 crore plus by FY30, with a reach of over 1 million retailers in India. So that explains why Nykaa was surging in today's trading session. And this despite a 5% surge that we saw yesterday. But from makeup, let's go down to footwear. And we do have Bata, that was another stock which did extremely well in today's trading session. One of the biggest intraday moves that we saw on the stock in the last 20 years, and that's largely because the company has appointed Sanjay Rao as the MD and CEO of the company effective October, as soon as the current MD and CEO Gunjan Shah's term gets over in September itself. Importantly, the credentials that Sanjay brings are fairly high, 20 plus years of experience across India, South Asia, China and Europe. What he currently does is, the senior director at Nike Retail for 4 European nations. So obviously footwear experience. And before that, he was with Inditex, established Zara's presence in India with Tata. So across the board, fast fashion and footwear is something that he brings. And if you look at his LinkedIn profile, it says that he's a turnaround specialist. If there were 3 Venn diagrams made for Bata, footwear, fast fashion and turnaround, the stock has done nothing over the last 3 years on a sales basis. 1% CAGR, net profit is down 20%. The last 3 years, the stock has delivered 25% negative returns on a CAGR basis over the last 3 years. From a November 2021 high of over 2,100 rupees, the stock had fallen to sub 700 rupees as well. So needed a turnaround, and you have someone who's worked at Nike, someone who's worked at Zara, someone who's a turnaround specialist coming to the company, and the street is understandably excited about that. That explains why the stock was up 16%.
Okay, 16%. That's a big surge that you have seen in the stock today. Thank you for explaining those moves in the consumer stocks. To take this discussion forward, I'm now joined by Sudeep Bandyopadhyay of IndiTrade Capital and Ruchit Jain of Motilal Oswal Financial Services. Gentlemen, good afternoon. Thank you so much for joining us. Sudeep, let me come to you first. That big surge in Bata, do you think this leadership change is good enough for investor sentiment to turn in the positive direction? What is your take on this particular name and Nike as well?
Well, Sonal, investor sentiment definitely has turned. That's the kind of excitement we saw in the market today. And I must say that, Bata is definitely, potential has not been utilized. The kind of distribution network Bata has in India is absolutely unmatched. I think you can hardly get a better network in every nook and corner of India. They need the right products, they need the right pricing strategies, and of course, efficiency needs to significantly improve. Now, if the new MD can do all of that, I think the sky is the limit as far as Bata is concerned. They can give pretty much all the other footwear retailers a run for their money. Nobody has even 10% of the distribution reach which Bata has. So obviously the potential is significantly high. The market is excited and will definitely watch the performance post the new MD taking charge in 1st October. As far as Nike is concerned, I think things have been improving in terms of performance over the years, and the kind of roadmap they have laid out for the future is definitely inspiring, and that's why the market is rejoicing. But we'll have to wait and watch how things move. The private level strategy house of Nike is doing good. They definitely are aggressively moving in that direction, which will be margin accretive. The target of mid-teen margin for overall company, again, is commendable. And that's why I think the market is kind of excited about Nike today.
Take that point. House of Nike, some of their important brands, the likes of Dot & Key, K-Beauty, etc., are doing extremely well. Now, there are, reports of them going ahead and buying Deepika Padukone's brand as well. So let's see how that pans out in their overall house of brands strategy. But let's talk markets with Ruchit Jain. Ruchit, the last hour spike that we saw, how much of that would you attribute to short covering and how much of that is sustainable from here on? Nifty very, very close to its 100-day moving average now.
Yeah, hi, very good afternoon. Well, it just seems to be a continuation of the uptrend that we have been witnessing since last few days. The good thing is that in this entire last 4 or 5 trading sessions, the market breadth has remained positive. We are not seeing any kind of significant sell-off over there. Major hurdle for the markets is straight around 24,500, 24,600, where the 200 EMA and the previous swing highs are placed. So I think we should see a continuation of this momentum, a gradual up move towards 24,500 in the near term.
Okay, take that point. So that's on the markets. Gentlemen, stay on. Let's talk about textile exporters. The shares of such companies, say Gokaldas, KPR Mills, Pearl Global rallied after India and the UK resolved the remaining issues in their free trade agreement. The pact is now expected to come into force from July 15th, paving the way for zero import duty on Indian textile exports to the UK. Devyani joins us with more details on this one. Devyani.
Well, the textile pack was all buzzing in trade today, and that's because the UK FTA, the much awaited UK FTA, is now going to come into effect from the 15th of July 2026 onwards, while the EU FTA is expected to come in by the end of this year. Now, what that does is it brings free trade access for our Indian exporters to the UK as well as the EU, where we were paying roughly around 8 to 12% in import duties previously. Now, what that does is it helps with bringing in better competitiveness for our products as well as better margin expansion for the current companies that are already supplying to these particular markets. Now, it's expected that the UK FTA will end up in our textile exporters gaining about a 5% market share over the next 2 years, while the EU agreement is expected to boost EU sales by about 50 to 100% of their current value, which sits at around $5 billion over the next 5 to 7 years. Now, the key stocks to watch out for include Gokuldas Exports, Indocount Industries, KPR Mills, and Raymond Lifestyle, as they all have exposure to these markets and will be looking forward to growing in these markets going forward.
All right, take that point. Sudeep, your view on the textile space. Obviously, the last quarter will be good for them despite the West Asia crisis, and that's largely because of currency-led depreciation. And we saw good numbers coming in from a lot of these companies as well. With this UK-India FTA being signed, do you think textiles warrant to look now? And if yes, what would be some of your preferred picks here?
Definitely, Mangalam, this is a very good development as far as these companies are concerned. Look, it's an extremely competitive industry, and they compete with Bangladesh, Cambodia, Vietnam, and the likes. And this duty relief which they get through the FTA definitely increases their competitiveness in the market and will help them increase their market share and business in these markets. UK starting July 15th and EU hopefully before the end of the year. I think it brings a significant revenue advantage, and that overall should improve the margin as well. So we have been positive on these FTAs, and we have been positive, particularly the FTA benefit for these companies. We will also await finally the USA trade agreement to be signed and executed. I suppose it will take some more time, but as and when that happens, that also will be excellent for all these companies. Amongst these companies, we do like KPR Mills quite a bit, and we have been, recommending that for some time.
All right. So textile companies continue to be in focus on the back of this UK-India FTA. The other pack that was doing well was metals. Shares of Shah Metallics in particular, they were in focus as the company unveiled an ambitious FY31 roadmap. What did they say? How do they plan to fund it? But how realistic also are these targets? Nigel is joining us with more details on this one. Nigel.
Well, Shah Metallics had their investor meet here in Mumbai, just yesterday, and they've laid out a very ambitious 2031 target. Let me run you through a few details. They're talking about revenues at around 42,650 crores. The EBITDA number they're talking about is around 6,236 crores. Very, very ambitious if you just look at what they've done and where they believe they're headed. Now, in terms of return ratios, they're going to maintain it healthy at around 20% to around 22%. They also say that the net cash positive number will continue, and the entire focus is going to be on value downstream products. And that's why the EBITDA number in various segments are going to balloon up. A lot of focus is on stainless steel, and from around 77 crores, they're talking about 1,100 crores by 2031. That's extremely ambitious. Now, on carbon steel, from around 1,700 crores, which is bulk of the EBITDA right now, they're saying it moves closer to around 2,866 crores. On special bar quality steel, that's going to move to around 1,019 crores or thereabouts. So that's broadly the breakdown in terms of the EBITDA number. For this, there'll obviously be a capex. They have highlighted that around $1.1 billion of capex will be deployed over the next 4 to around 5 years, which will be funded by internal accruals, and there'll be no external debt. Let's see how that goes, because that's a very ambitious number. The past record was pretty good. In the last 20 years, on a far lower base, they have compounded their EBITDA, their revenue, as well as PAT at around 20% CAGR. But from this base, it'll be interesting to see whether or not they can go the distance. Jefferies, one of the brokerages that were positive, they're even more positive. They have a buy rating. The target price they've upped to around 1,150 from around 1,040 earlier. What are they factoring in? EBITDA and EPS to compound at around 14 to 16% over the next 3 years. They believe the company is offering one of the best growth potential in India metals. So that's why they're optimistic. Stock as well, reacting positively.
Stock reacting positively. Nigel, thanks a lot for that. Ruchit, how are the charts looking on the metal space in general? Because as the world is looking at more peace coming in. The war premium is ending in the commodities. So as a result of which, we've seen a bit of a slide. Do you think there is tradable chartically?
15-20 sessions, the stock has just consolidated within a range, 940, 950 being a support zone, and 1020 is the resistance. So I think, but if you look at overall structure, then there just seems to be a time-wise correction within an uptrend for Shyam Metallics. So the 20-day MA is a good support for the stock. If that remains intact and we see the stock surpassing that 1020 range, then we could see a broader resumption of the uptrend. So can be on the watch list above 1020. One should look for fresh buying opportunities in the stock. Overall metal space, now we think that the index is going to some time-wise corrective phase. We have seen a pullback phase from the highs in many of the base metals, and hence we are not witnessing any kind of relative outperformance in last 4-5 days within the metals. So I think metals as a sector can see some more time-wise correction in the near term.
Okay, all right. Take that point. Thank you, Ruchit, for those thoughts on metals and Shyam Metallics. Thank you, Sudeep, for joining us with your fundamental analysis on some stocks and sectors. With that, we'll slip into a short break. We get you the top corporate voices along with the key market events to watch out for on the other side. Welcome back. You're still tuned into Markets Forward. Let's get you some corporate voices of the day. Federal Bank is expecting strong participation in the RBI's latest foreign currency deposit mobilization scheme. The lender alone expects to attract more than $1 billion and sees an inflow of up to $50 billion for the Indian banking system.
Pune-based Kalyani Steel is also seeing strong demand across its key markets, with the company benefiting from healthy order flows from the automobile sector, exports of auto components. In fact, speaking to CNBC TV 18, the management said they are operating at 100% utilization for nearly a decade, while environmental clearance for their Odisha project is taking longer than expected. The company has around 800 crore rupees in cash reserved for future expansion.
And before we wrap, we bring you some key events to watch out for. Riya Bhatia standing by with that list.
Well, yeah, starting off with the global events. First, looking at the economic data, we have the CPI print coming out of Japan to watch out for. And in the UK, the retail sales data will also be closely tracked. Also, remember, it is a market holiday in the US, China, Hong Kong, as well as Taiwan tomorrow. And back home in India, we will be keeping an eye on the AGM of Reliance Industries. And in terms of the IPOs, Total Mint Fintech's rupees 883 crore subscription will be opening tomorrow. And in other news, PM Narendra Modi will be disbursing incentives worth nearly 2,400 crores under the PM Viksit Bharat Rozgar Yojana.
Okay, Riya, thank you so much for that list. And with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening.
This was not easy, I can tell you.
US President Donald Trump signs a 14-point agreement with Iran at the Palace of Versailles in France. Iran's president signs the accord separately in Tehran. The Strait of Hormuz is set to reopen. Iran promises status quo on nuclear weapons. US will lift all sanctions. Both sides have 60 days to work towards a comprehensive peace deal. Brokerages expect oil prices to ease, but the pace of decline will not be rapid. Goldman Sachs, Morgan Stanley and Citi see Brent between $70 to $80 by the end of this year. JP Morgan is an outlier as it pegs Brent near $60 by the end of 2026. Sensex and Nifty gain for the fifth straight session. Mid-caps outperform. Rupee regains more lost ground against the dollar. US Federal Reserve holds rates steady in the first policy under Kevin Walsh as the new chairman. Walsh refuses to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. Walsh sets up 5 new task forces to overhaul the Fed communication, balance sheet and data sources. The ball gets rolling for what could be India's largest IPO. NSE files draft papers, looks to sell 6% equity, raise up to 32,000 crore at a valuation of over 5 lakh crore rupees. SBI and Canadian Pension Fund pegged to be among the largest sellers. Shares of textile exporters rally as India and UK announced the free trade deal will be effective from the 15th of July. Government sources say Indian workers in the UK will be exempted from social security contribution for 5 years. The CEOs of Anthropic and Google DeepMind call for a US-led coalition to shape rules and standards for artificial intelligence. CNBC reports the pitch was made at a closed-door meeting with world leaders, including President Trump at the G7 summit. Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. Cook says a price hike is unavoidable due to semiconductor crunch and rising cost of storage. And Portugal disappoints as DR Congo stuns in its first World Cup in 52 years, holds the Cristiano Ronaldo-led side to a draw and secures its first ever World Cup point. England begins its campaign with a comprehensive win against Croatia. All right, to the top story this evening, 111 days after the US and Israel attacked Iran and dragged the entire Gulf region into a conflict and choking global oil supply, we have the framework for a peace deal. Trump and his Iranian counterpart have signed a memorandum of understanding to end the conflict, but the agreement comes with major caveats, including unresolved issues surrounding Tehran's nuclear program. US President Donald Trump said, and I quote, "This was not easy," as he signed the 14-point agreement at the Palace of Versailles in France. Iran's President Pezeshkian also signed the agreement separately in Tehran. Pakistan's Prime Minister Shehbaz Sharif, who mediated the negotiations, also signed the agreement, which is called the Islamabad Memorandum of Understanding. Addressing G7 leaders, President Trump claimed Washington will not have to give anything to Tehran and took a swipe at his former president, Barack Obama. President Trump withdrew the US from an earlier peace deal with Iran, which was signed during Obama's presidency.
Technical discussions on the removal of all stockpiles of enriched materials will begin immediately. We're going to start that immediately. And unlike Barack Hussein Obama, who sent Iran pallets of cash and any relief they receive under this deal, they'll have to get based on merit. And it won't be from us. We don't have to give them anything.
Well, Trump's claim that US will not have to pay Iran anything contradicts the text of the agreement, which includes a $300 billion fund for Tehran. Here's a closer look at the 14-point agreement. The document signed by both leaders is a 60-day truce agreement and not a comprehensive peace deal. Officials from the US and Iran will now begin negotiations for a comprehensive peace deal tomorrow in Switzerland. The 60-day agreement is good news for thousands of seafarers stuck in the Strait of Hormuz. US has agreed to end the naval blockade in the waterway within 30 days. The memorandum also says that Iran will not charge transit fees for 60 days. However, both Iran and Oman will decide the future administration of the strait in discussion with other Gulf countries. Remember, just a month ago, Iran had constituted a body to regulate maritime transit. Iran has also agreed to maintain the current status quo of its nuclear program. Tehran has said that it would not procure or develop nukes and will commit to down-blending of enriched material. Under the agreement, US will terminate all types of sanctions imposed against Iran, including UNSC resolutions. The US Treasury Department is also set to issue waivers for export of Iranian oil until termination of sanctions. The US will also develop a plan with at least $300 billion for the reconstruction and economic development of Iran. This will be undertaken along with Washington's regional partners, and the framework will be developed in 60 days. Iranian officials had initially demanded around $400 billion in reparations and war damages. There's also a clause in the document that allows negotiation timeline to be extended beyond 60 days with mutual consent. But Trump has said that if the deal is not done in 60 days, they will, and I quote, get back to bombing, end of quote. Listen in to President Trump defending releasing Iran's frozen assets.
Can you explain, though, what the difference is between giving Iran U.S. dollars and unfreezing U.S. dollars for
Well, the unfreezing is an easy one to answer. We have taken a lot of their money, and we have their money. We have taken their money. It's not our money. It's their money, and we froze it. At a certain point in time, I guess we're going to have to give it back. You know, if we didn't give it back, nobody would ever invest in the dollar again.
Well, brokerages are largely in sync on oil price glide path after the US-Iran agreement. Goldman Sachs, Morgan Stanley and Citi see Brent crude easing into the $70 to $80 range in the final quarter of this year. As supply risks fade, Manisha Gupta has more. Manisha.
Well, yes, the crude oil prices have declined quite sharply from $120 a barrel off a high during the West Asia conflict to almost $78 a barrel right now, which was the price on the 1st of March as well. So it has been a very volatile journey, but the prices are off by nearly 15% in a matter of last 5 days and down nearly 27% in the last 1 month as well. This is as there is a peace deal now, an interim one between US and Iran, and the expectations that you could be looking at Strait of Hormuz opening, almost 100 ships which are in and around Strait of Hormuz and are carrying anywhere between 20 million barrels of crude would perhaps be available to the global markets. This has brought the prices down, and this also has brought the forecast of crude from the Wall Street banks and brokerages also on the lower side. To name a few, you have Goldman Sachs, which has cut its fourth quarter 2026 Brent forecast now to 80. Earlier it was at 90. For 2027, they believe that the crude prices could average $75 a barrel. And then you have Morgan Stanley talking about $80 a barrel of an average in this year. The most bearish of reports is coming in from Citi. They're talking about $75 a barrel of an average in this quarter, $70 in next quarter, and by the time it's 2027, they're anticipating $65 a barrel of an average price there. JP Morgan, more bearish, $60 an average for the price is what they're anticipating for this year now. And then you have Barclays on the higher side of the range, anticipating $100 in this year and $80 a barrel of an average in the next year as well. So clearly, all these banks and brokerages, which were talking about 90s and 100s and beyond of averages, have clearly cut it to size, and we're looking at lower price moves now.
All right, thank you, Manisha, for that. On the other hand, brokerage firm Citi has raised its GDP growth forecast for India to 6.9% for FY27. The firm has also revised its balance of payment surplus forecast to $45 billion from $5 billion earlier. Citi also sees India's average headline inflation for the fiscal year at 4.7% versus 4.9% from a year ago. All right, on to the day's market action. Sensex and Nifty closed in the green for the fifth straight session. Nifty closed above 24,150 mark with Max Health, IndiGo and Trent leading the pack. Nifty IT snapped its 3-day gaining streak, emerging as the top losing sectoral index. Nifty Bank outperformed, and 11 out of 14 constituents closed higher. US Federal Reserve has held rates steady in the first policy decision under Kevin Warsh as the new chairman. Warsh refused to submit a rate forecast of his own, even as a majority of other Fed members expect a rate hike later this year. On inflation, he said that the policy would aim for price stability. Further, the new Fed chair also set up 5 new task forces to overhaul the Fed communication, balance sheet and data sources. CNBC's Steve Leisman is here with more.
Hawkish message on rates, reflecting that he inherited an inflation problem and saying the committee is strongly committed to dealing with that inflation problem.
We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability.
Warsh clearly has embraced, at least for now, the existing hawkish bent of the committee, where 9 officials now project at least 1 rate hike this year and 6 see 2 or more. Only 8 expect to hold rates steady, and only 1 cut is projected. And markets have taken Warsh and the Fed seriously. The 2-year sold off hard, and the first hike is now seen with a 66% probability to happen in September. It had been December. A second hike now has a 55% probability for January, and there wasn't one priced in before the meeting. Warsh also pledged a rethink of how the Fed does business, appointing task forces to review Fed communications, balance sheet policy, data sources, productivity and jobs, and the inflation framework. Warsh stuck to his long-standing view that AI and productivity will be transformative for the U.S. economy. But it seemed as if any incorporation of that into policy would have to await dealing with the current inflation problem and hitting the 2% target.
All right, India's largest stock exchange, the National Stock Exchange, has filed the draft red herring prospectus with SEBI for its upcoming IPO. As per the document, the IPO comprises up to 14.89 crore equity shares, representing approximately 6% of NSE's paid-up capital. It is entirely an offer for sale. Sources have said that the size of the public issue is likely to be between 30,000 to 32,000 crore rupees, which could value the stock exchange at over 5 lakh crore rupees. SBI, Bank of Baroda and New India Insurance are among the key investors who will be selling their stake in the IPO. Tata Motors has announced a price hike of up to 2.5% across its commercial vehicle portfolio effective July 1st. The company says the increase is aimed at partially offsetting rising commodity prices and higher input costs, with the quantum varying across models and variants. This marks Tata Motors' second commercial vehicle price hike in FY27, following an increase of up to 1.5% announced in April. Shares of textile stocks gained in early trade as the India and UK Free Trade Agreement comes into effect from 15th of July. As part of this trade agreement, UK import duties on textile and garments, which were earlier between 8 to 12%, will now become zero. UK's textile imports to India stood at over $28 billion, while Indian textile exports into the UK stood at $1.5 billion. And speaking of the trade deal between India and the UK, sources have said that exporters of labour-intensive and agri-product sectors are expected to benefit from this deal. Abhimanyu Sharma joins us with more. Abhimanyu, please take us through the contours of this trade agreement.
Several benefits are expected to start accruing to Indian exporters in different segments, particularly for agri-products and in labour-intensive sectors, as the India-UK FTA is slated to come into effect from the 15th of July. It remains to be seen what are going to be the new targets which will be set as far as increase of trade between India and the United Kingdom is concerned. Also, the DCC, which has been finalised between both the sides, will mean that Indian workers who are employed by Indian companies and are working in the United Kingdom will be exempt from paying any social security contributions in the UK for a period of 5 years. Now, this move is going to save $500 million per year, as that amount would be paid into Indian social security contribution system itself, instead of the same amount being paid within the UK. Now, currently, over 9,000 Indian companies have employed 75,000 Indians who are working in the United Kingdom. The number is expected to grow in the next few years. So, several benefits are expected to accrue to even India's services sector. Also, speaking about government procurement, British companies have been allowed to participate in India's government procurement system. However, they will be classified as second-class suppliers subject to value addition norms. Now, as far as the UK steel measure is concerned, government sources have indicated that there will be no market loss, no loss in market access to Indian exporters, as over 85% of India's steel exports to the United Kingdom will fall outside the ambit of the steel measure. So, the government is expecting several benefits to accrue, not just to its merchandise exports, but also to India's services exports, and more importantly, to an increase in bilateral trade between India and the United Kingdom.
All right, thank you, Abhimanyu, for that. Prime Minister Narendra Modi is expected to meet French business leaders in Paris in the final leg of his two-nation tour, which included Slovakia. Prime Minister Modi will address Viva Tech 2026 alongside French President Emmanuel Macron. The two leaders are expected to pitch a shared vision for human-centric AI innovation. Right, time for a short break. Coming up, Apple will hike the prices of its products, says outgoing CEO Tim Cook to Wall Street Journal. He says a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Details in a bit. Welcome back. The Indian Met Department has reiterated that widespread rainfall over Maharashtra is unlikely over the next few days. In a statement, the Weather Department said rainfall over most parts of Maharashtra is expected to remain isolated over the next 4 to 5 days. However, forecasting models indicate an increase in rainfall activity over the Konkan region after June 24th. And speaking of delayed monsoons, Mumbai's lake water levels have dipped below the 10% mark. This has raised concerns about drinking water supply in the city. The data by BMC showed that the 7 water supplying lakes were at a critically low level of 9.67% as of 6 a.m. today. Similarly, water levels in over 3,000 dams across Maharashtra dipped to 24%. The CEOs of Anthropic and Google DeepMind call for a US-led coalition to shape rules and standards for artificial intelligence. The pitch was made at a closed-door meeting with world leaders, including President Trump, at the G7 summit. CNBC's Charlotte Reed has more.
AI CEOs attending a lunch and meeting these G7 leaders yesterday. Of course, this came just a few days after Anthropic was banned from rolling out its latest model to non-US nationals. And of course, the Europeans being left in shock on that front. And we heard from President Macron on this, saying that there'd been some fruitful conversation between the G7 leaders on the best way to roll out some of these models, these frontier models of AI. But he warned as well that we should be careful to not on the non-cooperation among democracies on these questions of AI. And he warned against any nationalistic reactions to this.
What is their fear? That these models could be used by others to attack them or us. In response to this, a very strong decision was made by the administration a few days ago. So it's a good thing, an awareness that it can be dangerous. Until now, there was a prevailing discourse that said nothing should ever be regulated. All this is not dangerous. So it's a good thing there is awareness. It's a bad thing, the reaction is somewhat strictly nationalistic.
And as you were saying a little bit earlier, of course, the CEO of Anthropic himself talking about how we must resist the temptation to splinter amongst democracies in the sharing of these models. And Macron saying, you know, the US should be careful in doing this sort of bans, because then the other countries in the world won't be buying US AI if it can be plugged out and plugged off at any moment. So, you know, that was a conversation that was happening.
Right, tech giant Apple said it will hike the prices of its products. In an interview with Wall Street Journal, outgoing CEO Tim Cook said a price hike is unavoidable due to semiconductor crunch and rising cost of storage. Meanwhile, Meta has announced a series of new updates designed to strengthen protections for teens across all its platforms. Rachna Dhanrajani joins us now with more. Rachna, what are you picking up?
Well, Tim Cook has said the quiet part out loud. In an interview with the Wall Street Journal, Apple's outgoing chief executive admitted that price rises on Apple products are now, in his word, unavoidable. He said the company has been trying to shield its customers, but that the situation has become unsustainable now. That is a remarkable thing for Apple to say. The most valuable consumer brand on earth, famous for protecting its margins, is telling you plainly that your next iPhone is now going to cost more. And the reason is a single component, and that's memory. There's a worldwide shortage of the memory chips that go into phones, laptops. And this one is not like the pandemic, because this one is deliberate. The big three makers, Samsung, SK Hynix, and Micron, have shifted almost all their production to premium chips built for AI. The logic is brutal. Every chip that goes into an AI data center is the one that does not go into your phone or laptop, and the data centers are paying more for it. The numbers are pretty staggering. Memory prices have jumped around 90% in a single quarter. Apple has already raised MacBook prices by up to $400, and analysts say that a relief may not come until 2028. For India, one reason is Apple, but the reason that this one hits hardest of all is because memory can be a fifth of what a mid-range phone costs to build. And India is a mid-range phone market. So apart from Apple, the other phones are also expected to take this price hike. A shortage would start off this boom. So what begins in a data center in California ends up on the price tag of the world's most cost-conscious buyers, which is here in India. Now, away from pricing, the same industry is fighting a second battle this week, which is over children. On Monday, Britain announced it will ban under 16s from social media outright. Not restrict, ban. Instagram, Facebook, TikTok, and others must keep under 16s off or face heavy fines. That's what they said. However, this excludes WhatsApp. Prime Minister Keir Starmer called it a line in the sand. But Meta is now pushing back hard. It opposes the ban outright, arguing its own teen accounts already do the job needed. And on cue this week, Meta rolled out a fresh wave of teen safety features globally. Stricter default content settings model on movie ratings, AI that scans for underage accounts, alerts to parents. Much of it notably was tested in India first. So now you have two camps forming. Governments who want children banned and the burden placed on the platforms, and thus Meta betting it can self-regulate its way out of a ban. It will be interesting to watch which way Apple leans, because with iOS 27 coming later this year, Apple will also be introducing the age detection tools that could decide who is right here. So two stories, 1 week. One decides what your devices cost, the other who is even allowed to use these devices.
All right, thank you, Rachna, for that update. Shifting focus to the big newsmaker of the day, HCL Tech is doing it right by investing in Sarvam AI. That's the word coming in from Vishal Sikka, founder and CEO of VNI Systems, in an exclusive conversation with Shireen Bhan in San Francisco. Sikka, who also served as Infosys CEO in an earlier capacity, said that India is not far behind in the global AI race.
We've just seen an announcement coming in where HCL Tech has picked up 10.5% in Sarvam, which was India's frontier model company. Will bets like that now have to become stable stakes?
They will, yeah. I think I met Roshni back in February. I think what she has done is exactly right. I think it is. India is too important and India is too big to let go of any of these layers. I think it is a fallacy that we should not work on the foundation models. I think for two reasons. One, you have to have your own foundation models, and we are too big and too important to let go of that. But at the same time, we are still very early. As dramatic as the advances have been, we tend to think of this as, wow, we are so far behind, but we are not. It is still like maybe the second over of a T20 match, maybe the third over, But there are still remaining, 37 overs to go. And I think on power consumption, on hallucinations and understanding of the world, on improving access, there are so many advances that are still to happen in AI that it will be years of work. And I think that we should be working on those. And I see, and of course on the applications of it, what can we do with this continuously? I think all of this has to happen at the same time.
And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18. Thank you for watching.
Microsoft isn't just building AI tools, it's rebuilding the entire software stack for the AI era. At the core of this transformation is Core AI, a startup inside Microsoft led by Jay Parekh, focused on creating the next generation of agentic applications.
So how many times do you get mistaken for Satya?
I was waiting. I was like, I wonder if she's going to ask that question.
Of course I'm going to ask you. So how many times do you get mistaken for Satya?
From weekly iteration cycles to rethinking how humans and AI agents work together, the rules of software are being rewritten in real time. Core AI is building the end-to-end platform to run, manage, and secure agentic applications across enterprises.
Meeting Satya Nadella, joining Microsoft in 2024 to set up the AI startup, if I can call it that. You know, with a 50-year legacy behind the organization, how challenging has it been?
Yeah, so when I got here about 1.5 years ago, really what we want to do in the Core AI team is help not only the company, but also our customers kind of reimagine, rethink what it's going to take to build, to run, to manage all of these like new applications that are being invented, being created out of this technology that is AI, right? So, and that requires an entirely top to bottom kind of systems overhaul of what we've done to build software in the past, right? So in terms of like being able to build the applications with different tools, being able to support and build a new platform where these agents are running because they're interacting with the real world, they're thinking, they're planning with the models. You need different security guardrails around these things. So the entire technology stack needs to be kind of, we need to rethink the whole thing. And that's what we're focused on, is migrating or kind of transforming the way we create this new agentic software stack.
You know, I'll come to the agentic software stack in just a little bit, but let's talk about what's happening with the pace of change that AI has brought upon us. I mean, you know, within 3 months, the world is looking completely different. Now, from your point of view, as you plan out for the future, is this pace of change sometimes overwhelming? I mean, how do you deal with it?
Yeah, it is.
And
absolutely.
how do you plan for it?
Absolutely, everything's going so fast, right? And sometimes for us, it is where you will come up with a plan or an idea one day and you wake up the next day and you have to scratch it out and try something else. So there's a few things here, which is one is it's really about the way we are working as an organization, because the technology in the world is going to keep changing quickly. So saying, hey, we're going to read more, we're going to like work more hours, we're going to invent more days of the week, like while those things they would be nice, they still probably won't keep up, right? So a lot of it is really making sure we are adapting faster and faster. And so that is a lot of how you kind of change the team dynamic. So one is making sure we do have time to learn, to observe, to be curious with our customers. 2 is making sure our iteration cycles are very fast, right? So we don't do, for example, you know, planning over a really long period of time, because you can go and make a plan for a roadmap for 6 months or a year, and you know within like a few weeks that it's going to be out of date.
Right.
So you want these short iteration cycles of what you're doing. You absolutely want a North Star, but you want to be iterating kind of week by week.
So is it literally week by week?
It's day by day for some teams, you know, at most kind of week by week. Yes.
You know, agentic future that everyone's talking about at this point in time, where are we in that journey? You know, are we close to that inflection point? I'll link that back to what Satya said in his post yesterday, that we have to reimagine the workforce and reimagine work with human capital and token capital coexisting. So what does that mean now as far as the way that organizations are structured? What do you prioritize today?
Yeah, so there's going to be a few things. One is just the overall system that is supporting this new way of working, right? So it's going to be the tools that we use as employees to do our job, whether you're in finance or you're a developer or whether you're a salesperson. There's where these applications and how those applications are going to run within your enterprise, as Satya mentioned in his post, where there is this end-to-end system, right, that has to come together that does allow you to manage kind of your human capital, your tokens, and then really we got to be focused on these different outcomes, right? And knowing what we can do with the power of the technology plus the power of our people. What types of new problems should we go tackle? What is the ROI on that, and what more value can we build? Either stuff that we may be able to do to save, because some organizations and some teams may get the biggest benefit there, but also what else can we tackle together? So it's really bringing those together and not as disparate concepts. But for me, what I focus on in all of the stuff that we do on our team, it's really how do we get to a new cycle of delivering that value, that quantifiable ROI to the customers.
You know, when you came up with the idea of the agent factory, and as you look at where we are today, what is the most exciting aspect of it, and what is it that we should be prepared for as we look at 6-12 months down the line?
Well, I think for us, it is continued change, right? So that is something that is both exciting. It's also hard as a product building organization of how to, one, make sure that you create these very valuable technologies that organizations can be successful with, that they can deliver that ROI, but also making sure that a platform that is adapting over time too, right? Because you can build the platform in a way and the tools in a way that they solve yesterday's problem, and then you're always kind of lagging the technology. So it's exciting to be able to build the flexibility in the platform and how to build the flexibility in the platform. I would also say that for us going forward is how you're going to manage your AI applications, right? And Satya talked a bit about this of how do you manage that, in some ways, the cost of the cost of this estate. And there's a lot of work that we're excited to do and that we'll do around, you have all of these different use cases. You can imagine in an enterprise, you may have thousands, tens of thousands of these AI agents and use cases. Some of them may need the premier tokens, like the premium tokens, I should say. And then over time, as these things are doing different types of workflows and tasks, you can optimize that with your data in your tenant, with your kind of compliance and guardrails. And then you can use kind of model choice, framework choice, tool choice to really make sure you have the right quality for the job, but you also have the right cost efficiency for the same job.
Which also means that you need to have an open ecosystem.
Yes.
You know, what have been the results in terms of efficiency and optimization that you've been able to drive through the work that you've done so far?
So this is an area of constant work for us, right? So for example, in GitHub Copilot, we have work and science work that goes into modes that developers, builders can use where they defer to an automatic picker. So based on your task, based on what you're trying to do, we locally can classify that and pick the best model, right? So it doesn't always have to be the premium model. It can say, hey, you're going to use this for this complex planning task or this complex refactoring task, but these other things, we can pick a cheaper, faster model for that, right? So we want to take some of that burden of having to pick off the end user and make that just part of the platform, part of the product. But that's also requiring you have model diversity, right? So both in GitHub and in our productivity M365 Copilot, as well as in Foundry, we offer that choice of the wide range of choice, right? Big models, small models, open, closed, but also multimodal, image, voice, video, etc. Those are all part of that builder creation process.
Were you surprised by what we've seen recently with companies saying we've blown through our budgets? Did that surprise you?
Yeah, I don't know.
Token maxing is now almost an insult.
So, as somebody who's been in tech for a long time and led, supported kind of technical product organizations, I think it's easy to, I think, get over-rotated on these activity metrics, right? And a long time ago, it would be like, you would have lines of code or these types of things. These are activity metrics, right? And if you're in sales, it's like, okay, how many leads do I have, right? And you could have lots and lots of leads, but if none of them are qualified or none of them are real, that doesn't turn into, that's activity, right? It's not actually revenue. So it's not that it's a new thing to me. It's actually, again, businesses needing to separate kind of these activity metrics versus these output metrics that are important to the business, right? Or because the activity doesn't always translate into the outcomes. One of the things that we work on in our team here is equating, okay, if we're going to invest X dollars, some number of people and some amount of tokens, what is that, what is the output, the impact to the business that we get? And thinking about that time from an idea that somebody has to when it ends up in our customer's hand, what can we do to shrink that time, but also make that experience more valuable, more delightful, et cetera, right? So these are the metrics that actually move the needle for our customers, for our business, versus these activity metrics, right? It's easy, you can imagine, everybody should use a lot of tokens, right? We all see what happened in the news about that. But now we have to just be wiser, smarter, and kind of come together with the right controls, with the right visibility into how these token resources are being used.
Speaking of ROI, I think what has worried the street is that, this massive capex spend being announced by each of these companies, including, of course, Microsoft, $190 billion in 2026. And is this real? Is this going to lead to an unraveling? I'm sure you get a lot of those questions as well, but how do we make sense of this, of the kind of spends, what it's eventually going to lead to, what it means as far as an ROI perspective is concerned?
Yeah, absolutely. So I think just staying focused on what value we're delivering to customers, right? When we see kind of the evolution of how people are using the products, right? So you could even go back a couple years ago and say, okay, Copilot, what was the typical use case? It was ask a question, get an answer back, right? Now today, people are launching very big, elaborate research projects like competitive research or product research or ways to kind of maybe think about a business model analysis where they're bringing in different artifacts, maybe a spreadsheet, presentation, outside research, other information that may be in your flow of work, right? Stuff that's in your Teams or email or other documents. That corpus and being able to think about it, reason about it, do more sophisticated kind of planning or outcomes, that is where I think the flow of work is just picking up the pace, right? So doing a question, getting an answer back, that was, a year or two ago.
Yeah.
But now if I can use this technology to do what would take, days, weeks, months with a lot of people, and I can do that in hours or minutes now, then I think there's tremendous demand. And that's what we see in how we're building our products and how we generate our ideas for our roadmap too, right? Which is to really be able to have the tools and the platform support these more complex and just higher ROI or just more valuable outcomes, right? And I think then the spend will flow from that. Now, we obviously continue to match, our spend is based on our demand, right?
Yeah.
So but the demand comes from working backwards and working closely with our customers.
Let's talk a little bit about India, because you've said previously that it's not just about the models. It is going to be about how those models are deployed at scale, how they're used, and of course that's where the talent aspect comes into play. How do you read the India story in an AI landscape?
Yeah, so India is it's a really exciting community in India, right? In GitHub, we have 27 million developers that are in the GitHub community in India. Just this year, we've seen more than 2 million new developers join the GitHub platform, right? So it is an incredibly fast growing and very, very vibrant community of developers. And it is one of the most activated, I would say, in terms of thinking about using AI and actually building ambitious product solutions to serve the world, right? So very exciting to see the range of what people are doing from the big multinational companies in terms of what they're doing to help even other companies around the world do transformation, as well as the startups and how small teams moving fast with this technology are building some of the most valuable startups in the India startup ecosystem of all time, right? So very, very fast moving. It's a community that's contributing a lot to open source in AI as well. And it is an area where we continue to invest. Obviously, Microsoft all up is investing in data centers and skilling. We have a big presence there for our own product development in the different offices as well.
The debate on whether India should do frontier models or not, we do now at least have one. And we've just announced a big deal where HCL Tech, one of the services companies, has decided to pick up a little over 10% stake in Sarvam. Do you believe that that is going to be crucial? It's going to be imperative as India builds out its AI ecosystem, this kind of ecosystem building?
I think it's important for where there is the talent and the dollars to continue to invest in as much of the stack as possible. Like there's an incredible amount of investment going into building out the infrastructure. There is obviously a vibrant startup community. The larger, I would say, companies, the companies that are doing work for all the multinationals, like we work with, Wipro, Infosys, all of them in terms of what they're doing to drive that transformation. So it is very good, in my opinion, for investment to be happening at all of these layers of the stack, because so much is still yet to be invented and to be decided. And having having folks work on what may be specific needs of the Indian market, I think is great. It's a valuable part of the ecosystem.
Sovereign AI and a national strategy as far as AI is concerned, that's gotten a lot of play on account of what we're seeing happen on the geopolitical front. With the Trump administration telling Anthropic what it can or cannot do as far as Claude is concerned, does that become an emerging concern for the industry? And, and how do companies like yours look at it?
So the way I think about it is, again, we have defined and we are working on this end-to-end system in terms of how organizations all around the world can build these AI applications, how they can contextualize it or connect it with their data, right, their proprietary business data, how they can run this in this platform, how they can govern these applications for their compliance, their governance, their whatever sovereign constraints or requirements they may have, and then how we can make this whole thing continually improve over time, right? And so that really is the notion of the platform that we're trying to build. And so that over time, this should be able to meet whatever requirements, because it does, as a platform, allow you that flexibility. It does allow you that choice. So you can lean into one model, you can lean into lots of models. If something happens in the geopolitical landscape, you have choice, right? And that's where the extensibility, the flexibility of this end-to-end system, this end-to-end platform, I think is super important as we see the world continue to change.
The anxiety is also coming from is that what is this technology going to do to people in the workforce, in the workplace? How do you address that
And I'm sure that, a lot of young people who come to you, or startups who come to you, or even employees who talk to you about that. How do you address that question, the short-term, medium-term dislocation that is expected, but in the long term, what do you believe is likely?
Yeah, I think for us it's a journey. And I'd say that one, we have to think about the type of people that we need for different problems, different projects, right? And I think some ways you see maybe the specialization in an organization is starting to blur, right? You're starting to see folks in our legal team or our finance team using our developer tools to help them do their jobs. You're seeing people in maybe in product and engineering being able to think about maybe marketing strategies, because they're able to like brainstorm with these tools, right? And give it context in work and other documents they may have. So in some ways it's really neat because the functions are blurring, which means one, people are learning things that maybe they in the past, because they were specialized inside of a function, they couldn't learn, right? Or it was hard for them to learn. Now you're able to kind of, I would say, expand your knowledge across the function and really think about, okay, I have this product, I have this feature. I'm not just going to be responsible for the code or for the spec or just for the design of it. I'm going to think about it with a couple of other colleagues, how we think about the idea, how we vet the idea, how we iterate on it, how we build it, how we get it into customers' hands, how we position it against the competitors. So we're not going to have all of these handoffs where we go slow. But now if I can have employees actually gain way more experience because they can understand these different functions that may have been separated from them, then I think that is a huge learning opportunity for the organization. And then I'd say the other thing for us is just continuing to learn and gain new skills about how to use these tools, right? And that I think is something we invest a ton in terms of how we drive those programs, those learning programs. And, frankly, the other thing that we see a lot of is there's a lot of work that is, I would say we classify it as toil. It's like repetitive, mundane work that isn't, and goes kind of in your face of when you're trying to create and deliver value to customers. There's a lot of work that we can automate away that then saves time. You get time back to then go work on those higher ROI or higher value or higher ambition problems.
Well, we look forward to hearing more from you, and we look forward to seeing you in India. Jay, thanks so much for joining us here on Voices from the Valley. Appreciate your time.
Thank you.
And wish you the very best of luck.
Thank you for having me.
Well, with that, it is time for us to take a quick break, but the headliners and newsmakers will continue. We're right back with you after this short break. Stay tuned.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the much-awaited suspense around the Iran agreement has finally come to an end. The US President Donald Trump and Iranian President Masoud Pezeshkian digitally sealed an agreement to bring to an end the West Asia conflict, at least as of right now, temporary truce. Now, Trump acknowledged that the deal was not easy to achieve as he signed the 14-point agreement with Iran at France's historic Palace of Versailles. Commenting on the deal, Trump said that it helped avert what could have become a worldwide depression. He also said that the removal of all nuclear stockpiles from Iran would begin immediately, while claiming that Washington would not have to give Tehran anything in return. Meanwhile, initial talks between the United States and Iran are scheduled to take place in Switzerland on Friday, following the ceasefire agreement between Tehran and Washington. Now, the Swiss Foreign Ministry has said that as of right now, the plan remains for the US and Iran, along with mediators Pakistan and Qatar, to meet tomorrow in Switzerland to finalize this deal.
Technical discussions on the removal of all stockpiles of enriched materials will begin immediately. We're going to start that immediately. And unlike Barack Hussein Obama, who sent Iran pallets of cash and any relief they receive under this deal, they'll have to get based on merit. And it won't be from us. We don't have to give them anything.
Can you explain, though, what the difference is between giving Iran US dollars and unfreezing US dollars for
Well, the unfreezing is an easy one to answer. We have taken a lot of their money, and we have their money. We have taken their money. It's not our money. It's their money, and we froze it. At a certain point in time, I guess we're going to have to give it back. You know, if we didn't give it back, nobody would ever invest in the dollar again.
Well, a lot of moving parts as far as this temporary truce is concerned. To help us understand this further is with us Turkish professor Omer Anas, as well as joining us now is former Foreign Secretary, Mr. Shashank. And joining us in a bit will be Mr. Ajay Dua, the former Commerce Secretary as well. Gentlemen, thank you so much for joining us. Mr. Shashank, let me come to you first. Again, a difficult situation, but we finally see some light at the end of the tunnel, a truce between the two sides. But the question that many are asking is that, has Iran come out on top? They get control of Hormuz, no sanctions, they get to keep their nuclear material, nothing as far as their ballistic missile program is concerned, and cherry on top, $300 billion fund.
Well, I don't look at it that way. I look at it that G7, which was becoming more and more irrelevant, has again come back into prominence, and President Trump has been able to sign this rather than giving threats to Iran. Now he has finally agreed to sign this agreement, memorandum of understanding, and start the talks immediately for the final agreement. That's number one. Secondly, there is some certainty already that now there is no immediate prospect of a bombing campaign in Iran, and even perhaps as Lebanon is included, that there is a possibility that the countries involved in G7 and other major powers all over in the region and all over the world will help out in making sure that West Asia gets peace rather than more confrontation and war. So I would look at it, the whole thing from this angle, that it has brought about peace in the region. It has brought a deal which is acceptable to both sides. There will be many difficult issues to resolve, and we wish them all the best to resolve these issues, because after all, this is not the first agreement. We all talk about JCPOA, and so the Democrats also can't say. They can discuss whether their agreement was better or this is better, but I think this is more comprehensive, and this is a continuing process, which is much more important. And this will help Iran also get its frozen assets, get more reconstruction assistance. And once they move from the very principled approach to get rid of Israel from that continent, I'm sure that they will move towards a more prosperous area and to have a better relationship with the neighbors, whether Arabs or the others. So there will be hope for President Trump's Abraham Accords in the region. I think that may not be an immediate demand, but I think ultimately that would be also expected by President Trump, that he would be able to do something better before the midterm elections.
Right, so some stability in the region, perhaps, in light of this temporary truce that the two sides have reached for now. Let me come to you, Mr. Umair Anas. From the region, from the Persian Gulf, tell us, what do the optics of this 14-point MOU look like for a person on the ground?
Thank you very much for having me on your show. Let me say that this deal is being seen as a victory for Iran, because Iran has made this crisis so very complicated that the Israelis and Americans found very difficult to have a safe and honorable exit from this crisis. And Iran had effectively made this crisis as an international, in which every single country, the neighbors, the extended neighbors, the European countries, the big powers, the big economies of India and China, everyone was affected. So Iranians have used this kind of a strategy, and finally they have got the best of the result. So on the ground, I would say that there is a sense of fear as well, that this deal has also given Iran a stature and a superiority in the region that sometimes Saudis and Iran's rivals fear. So, of course, the Iran's gain have come sometime at the cost of the regional rivalry. So, the regional countries, especially Saudi Arabia and Egyptians, would be seeing this deal very carefully, and they would like to have a balance between Iran and regional powers. So, this is the sense which is going on. And Iranians have made it sure that this crisis is being resolved completely bilaterally between Iranians and the Americans. In this way, what I have been thinking for a long time, that there is a greater possibility, increasing possibility, that Americans and Iranians would be coming together, maybe to normalize their bilateral relations as well in coming months or years.
Well, that is the hope, Mr. Anas. But let me then ask you another follow-up question. An issue that will affect the region, that will affect the Gulf countries, control of Hormuz. Now, let's break down the 14-point MOU. One of the points very clearly says that within the 30-day period, the U.S. will withdraw its forces, as far as the blockade is concerned, will withdraw its forces from the Strait of Hormuz. Does that, in effect, give the control of Strait of Hormuz back into the hands of Tehran?
At the same time, these 40 points also include an interesting point that Iranians would be working with Oman. So what does it mean? It means that there will be, they have been talking about the maintenance of the Hormuz. So in the name of maintenance, they would be taking minimum charges from many of the ships, and this will be distributed between Oman and Tehran. So even though it has not been said clearly in the document, but there will be some maintenance things, and it will be collaborated between Iran and Oman. So Iran is not alone in control of the Hormuz, but also one of the Gulf countries will be there. So in this way, Hormuz has been partially internationalized.
Sure. Mr. Dua, let me come to you again. Let me make a reference to what Mr. Anas was referring to, that as a part of this MOU itself, there is a mechanism that it seeks to develop between Oman and Iran for maintenance as well as administration of the Strait of Hormuz. So while Donald Trump says no charge right now, there is some kind of administrative mechanism that Oman and Iran are likely to deploy. Once that happens, should we take it as a given that there will be some fee levied? You can call it whatever, maybe not a toll, but maybe some kind of administrative fee that tankers will have to pay in the region?
Thank you, Ashwat, for having me in this discussion. I fear that could happen. Otherwise, under the international law, as we all know, the Strait of Hormuz has to be free beyond the waters of the 12 nautical miles of the border state, or the bordering landmass. But in this case, to say that two countries will jointly administer it, and knowing that how critical this waterway is, and the fact that it is only 40 miles wide, which means about 60 odd kilometers wide, does make me look like there could be a fee to which the United States has obliquely agreed. How desirable it is altogether a different matter. considering that the countries east of it, which includes India, are heavily dependent upon movement of their essentials as well as non-essentials through those waterways. And second is the fact, and again an apprehension, I hope it's not true, that other straits in the world, including closer home, the Malacca Strait, Malaysia as well as Singapore could start talking about it. There are then, why not the Suez Canal? Suez Canal, luckily, because it's a man-made lake, already is allowed to charge. Panama Canal is similarly on that ground allowed to charge. But we are beginning to commercialize such straits which can be constrictions, as they have proven recently.
That's an interesting perspective as to how this could serve as a precedent for some other critical waterways. We have two more questions I need to quickly address. Mr. Shashank, let me come to you. The nuclear question. Iran has conceded that it will not pursue nuclear weapons. It has not conceded that it will not be pursuing nuclear power. It still maintains control as far as the nuclear material is concerned. Is this likely to come as a setback for the US and a win as far as Iran is concerned in the longer term?
But so long as Iran does not move away from NPT, I presume that they have retained full right to civil nuclear power. And I think that was accepted also in JCPOA. And Iran did go up to 60% enrichment, but that was only after the United States withdrew unilaterally from JCPOA in 2016. Therefore, Iran never had any interest, as far as I can make out, with a fatwa issued by the late Ayatollah Khamenei. And they could have changed it if the war had continued, conflict had continued for more time, then perhaps some hotheads in Iran might have decided to go for a nuclear weapon thing and follow the example of North Korea. But I think otherwise they would respect their late Ayatollah, and there is no question of any nuclear weapon program, and the Americans will make sure of that. G7 would make sure, and I hope that other countries in the region would also help in that process, because we want to move towards peace and economic growth in this area, not towards the kind of uncertainty and conflict which has been plaguing this area for a long time.
Sure. Let me take on one final issue with Umair Anas. Anas, I just want to read out the very first point of this MOU. It says, both the sides will undertake from now on not to initiate any war or any military operation against each other and to refrain from threat or use of force against each other, and ensuring territorial integrity and sovereignty of Lebanon. Now, this is the very first point. Israel, meanwhile, says we are not bound by this MOU. In fact, just hours back, we saw strikes being conducted in southern Lebanon. Is this something that could potentially lead to unraveling of whatever little truce that we have in the region?
Yeah, first of all, I would like to add one more point to Mr. Shashank's discussion, that Iran has effectively used its enriched uranium for its advantage, and that's why it has got that big deal in its favor. Had it not been having this much enriched uranium, perhaps the deal wouldn't have come at all. Secondly, your point that Lebanon has been included as an important point. It means that, in my understanding, there is a window, there is a possibility that Iranian and Israeli conflict may continue for some time from now, maybe a month or so. Limited strikes and limited escalation may continue. So Trump administration has left that impossibility, but officially Trump has included Lebanon and its territorial sovereignty as part of this deal. And Saudi Arabia especially has wanted this Lebanon clause to be there.
Right, that's an interesting way of looking at it. Lebanon is mentioned in the MOU. Israel and Hezbollah are not mentioned as far as that 14-point MOU is concerned. But I'd like to thank all of our panelists for joining us. I'll request, in fact, Mr. Shashank and Mr. Dua to stay on with us. We're heading into a very short break, but up next, we'll focus on the bilateral meeting that we witnessed only hours back between Prime Minister Modi as well as President Donald Trump. What that entails, what those comments mean, we'll focus on that on the other side. Welcome back to News Center. Now, another big development from the G7 summit was the bilateral meeting between India and the United States. Prime Minister Narendra Modi held talks with US President Donald Trump, their first formal bilateral meeting in 16 months. Now, ahead of these talks, the two leaders briefly met and were seen exchanging a handshake. The meeting comes just days ago after just an incident involving commercial shipping in the region that claimed the lives of 3 Indian sailors. New Delhi subsequently summoned the US envoy. During the discussions, Modi underscored the importance of freedom of navigation and raised concerns over the safety of seafarers following the deaths of 3 Indian nationals in the US strikes. Meanwhile, Prime Minister Modi praised Trump's leadership efforts. Trump returned the compliments, describing Modi as calm under pressure and a tough negotiator. Trump also said that if India were to face an attack in the future, the United States would stand by its side. On the India-US interim trade deal, Trump said that an agreement is very close and added that he looks forward to visiting India soon.
How close are you to a U.S.-India trade deal?
Very close. We've been there for a little while, and he's a very tough negotiator. He's one of the toughest, actually. So you look at this man. I'll give you a lesson. He's the most beautiful-looking man. He looks so nice. He's like an angel. But actually, he's as tough as he's a killer. I don't want to. He's a killer. He's as tough as they come. But he looks so good. So he gets you by surprise. But there's few people like this. People say he's such a nice man. I said no, he's very tough. He's a tough trader. And he loves the Indian people, but he also loves the USA. We had Howdy Modi in Houston, remember? And the stadium was full. Right, remember that?
He did Namaste Trump in
That was great. And we'll be going to India sometime in the future.
Do you expect India to play any role in West Asia? I'm Siddhant from
Say it.
Do you expect India to play any role in West Asia?
Yeah, I do. I think India plays a big role in everything. As long as he's the leader, India's going to play a big role.
And you said many times that India has a great friend in United States, in Washington, D.C., in White House, till the time you are president. But some of your decisions recently caused trouble, concern in India. How would you like to assure people of India?
Well, I said it. As long as I'm president, we have a great. They have a great friend in the White House.
Well, to discuss this further, we still have with us former Commerce Secretary, Mr. Ajay Dua, as well as former Foreign Secretary, Mr. Shashank. Gentlemen, thank you for staying on with us. Mr. Dua, let me ask you that again. From the visuals before us, we could tell that the two leaders seem to have a very close chemistry. They share a close bond. They've shared pleasantries publicly with each other when it comes to personal situations that they have in between them. Is it really yielding the kind of results that India would be hoping for? The last time that the US trade delegation was here, we were met with Section 301 tariffs. Now with this exchange of pleasantries, do you think it will yield any results for the upcoming Jameson Greer visit to India? He's, of course, coming next week.
I hope so, that the warmth which the two leaders expressed towards one another would now turn into something more substantive, something more productive for India. And the nearest where it would get tested is in signing of the first tranche of the US-India trade deal. Hopefully, Mr. Greer, who visits us on 23rd and 24th, meets his counterparts in India, including the Commerce Minister, Mr. Piyush Goyal, would not insist any longer on opening up of the Indian agriculture, Indian dairy, as well as the high-end almonds and walnuts, which they've been insisting upon for quite some time. Because for us, as I always been explained, agriculture is a way of life. It's a vocation for most people of India, and not just it's not commercial farming. And we have stood by that in every forum, including the two agreements recently signed by us, one with New Zealand and second with Australia a little earlier. So that is one I'm hoping. Second, I'm hoping that the visit to India by the trade delegation would be to say that 301 would not be applied if there is a trade pact signed just prior to it, maybe the first tranche, maybe whatever has been signed. Because otherwise, the United States administration under their Trade Act, Section 301, the 1974 Trade Act, has such wide powers that if they suspect anything is happening, so if they suspect that a country is creating excess capacity, structural, or is trying to dump goods on another, they can investigate and then start levying duties, maybe for limited time, but those are additional tariffs that could neutralize whatever would get agreed in the pact. So the two need to be separated if necessary, an assurance given at this stage saying we would not apply 301 on the items which are being covered in the first tranche. It's not saying that the US administration abdicates its power under that, but on whatever the two sides are bilaterally agreeing, rest assured, we would not impose 301. The rest still remains, and the US president would continue to have that decision to make use of that.
Well, India, of course, will be pushing hard for that. But in short, Mr. Dua, if I can ask you, do you expect a deal? We've had the US TR now visiting India. He'll be calling on the Indian Commerce Minister. Donald Trump has met Prime Minister Modi. Do you expect some kind of deal, maybe by the mid of July?
I think so. In fact, I've been saying that the last time President Trump imposed duties, it was on us, and he called it the Liberation Day. That was in April 2025. Now, July 4th, which is the American National Day, he would this time show the gesture and sign this agreement. With this, all that we are saying is it would have been legally drafted, etc. All those scannings would have taken place because the US, if you would recall, Just 2 weeks ago, the ambassador of US had said 99% of the agreement has been reached. Only on 1% certain items remain. I'm sure they met earlier for 3 days in India when the US trade delegation was here. He would have now the ministerial level 2 days visit here. That scrubbing being over, they can enter into an agreement, whether it's the 4th of July or sometimes during the
Private sector has been batting hard for it. Mr. Dua, private sector has been saying that at least some kind of deal is better than no deal at all. Let me also get Mr. Shashank in on this. Mr. Shashank, I want to get you on a slightly different dynamic. Donald Trump there, as a part of that bilateral meeting, was heard saying that while we may not have a NATO-like pact with India, but if India is attacked, we will be there to support. United States will be there to support India. Was that a message for us? Or was that a message for someone else, like China?
I think the United States is really riled with the position taken by China. While they were happy that China was willing to let them have a deal with Iran and not support Iran to the extent that the war could continue. So that was welcomed by the Americans. But on the other hand, on Taiwan, the Chinese had made it very clear that there could be direct conflict in case America continued to support Taiwan. So therefore, America is now trying to, they have delayed giving weaponry to Taiwan and various other equipment. But they are now trying to see how they can change their attitude a little bit towards India. I'm not very sure whether in India there is a great amount of welcome to this kind of a generous offer. What we would like is to have better relations even with China, to have peace in the region, and to make sure that the Chinese do not flex their muscles over their smaller neighbors, and India would be willing to tie up relationships with the other neighbors of China to make sure that all of us put together kind of a peaceful atmosphere. And in case there is a China plus one technology transfer from the West or from any other country, then we should all be prepared to help in that, and India would be very much there. So I think we are not looking at this in the terms of NATO or Quad becoming NATO or AUKUS, but I think we have a completely different viewpoint. Americans in the last 1 year specifically thought that they could either treat Pakistan in a very mollycoddling and then making sure that Indians would also fall in line. That did not happen. And I think now they are thinking that India would perhaps become like a NATO power against the countries in the region. I think that will also not happen.
Right. Well, interesting dynamics at play here. We'll, of course, see it all play out. Next week, of course, we'll be keeping an eye. Jameson Greer, USTR, will be here to negotiate what is often referred to as the final 1% of the India-US trade deal. I'd like to thank both Mr. Dua as well as Mrs. Shashank for joining us. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Vishal Sikka helped build SAP, one of the world's most powerful enterprise software companies. Sikka spent nearly a decade at SAP, rising to become its first non-German board member. In 2014, Infosys made a historic hire, bringing in Sikka as the first non-founder CEO to transform the company. His 3-year stint was marked by bold ambition and a bitter public fallout with the founders. Since then, Sikka has turned entrepreneur. In 2019, he founded VNI Systems, a Silicon Valley AI company built around one big idea, that enterprise leaders shouldn't need a data scientist to talk to their own data. The company has filed 30 patents, raised nearly $200 million, and counts TCS, Google Cloud, SAP, and KPMG among its partners.
Hello and welcome to Voices from the Valley. I'm Shireen Bhan, and joining me today is a guest that I had with me exactly 10 years ago here in the Valley. Palo Alto is where we were, and today we're in the Stanford backyard in Menlo Park. Vishal, it's great to see you back on the program. Thanks so much for joining us. So much has changed, not just in the last 10 years, but in the last few months. I mean, artificial intelligence is coming at us like a juggernaut. You know, from where you are sitting today, Vishal, what's the most transformative change that you are witnessing?
One is in the technology itself, the rate at which around here, you know, I was reading somewhere that 91% of the unicorns are in the Valley, in the startup unicorns. All the rest of the world, including the rest of the United States, is 9%. So the amount of work that is going on in the technology itself is just astounding. And every day you see something new. But what I am even more excited about is what can you do with it? And the great problems that we can solve with it. And somehow it is the nature of our minds that we tend to think about, when we see a new technology, we tend to think about the problems that we already know about, you know, the past. But what is really exciting is the things that we will do with this. And that is what I am really psyched about. To give you an example, drug discovery is on the minds of a lot of people. I serve on the board of GSK. And when AlphaFold discovered 200 million proteins, that really boosted the whole drug discovery process. Of course, there's a lot more to drug discovery than protein finding, but that protein folding, the 200 million proteins that AlphaFold found would have taken humanity more than 400 million years. So the thing is, what is it that we can today think that would take decades to do that you can now do in days or hours or even minutes? And I think those problems are just so exciting to go after.
So what is exciting you at this point in time specifically? What are the kinds of problems that you intend to go after?
Of course, you know, problems that humanity faces that are of a really, really complex nature, problems that businesses face that are of a really complex nature that are, so drug discovery is one example of those, but every company, you know, that works in different industries has problems of that magnitude, of that scale. And I want to go after those. And so I'm here.
You just set up a new office to do exactly that.
To do exactly that. Yeah, this is what I'm doing here. And you will be the first one that I'll talk to about this. But really, my team is inside there. We are all very fired up about it. And I will soon be ready to talk about this.
Okay, we look forward to that. But, you know, since we're talking about things that are firing up imagination, but also firing up conversation. You know, Satya Nadella wrote a post yesterday, which has evoked a fair degree of response. I think the reason why it's evoked so much response is because it captures how people are feeling at this point in time, especially those who are not on the AI bus. Have you missed the AI bus? If you have, what happens to you next? The concentration of power, have we become a tech oligarchy almost? How do you respond to some of that, Vishal?
The asymmetry problem is real, and you and I have talked about this over the years. It is getting worse. I've been talking about this for a long time, more than a decade, and it is getting much worse. So just to put some numbers in perspective, out of 8 billion people in the world, only about 2 million could build an AI application. That's it. And this is not people who are building the models. These are people who would apply them to do something, to find if this roof is going to fall, or when a machine is going to fail, or if something is fraud, or to approve a loan. Those kinds of problems, that's 2 million. Out of those, the ones who could operate a machine learning model, an AI model, is about 250,000.
Wow.
The number of people who can build a frontier model is about 5,000.
5,000, that's it?
Yeah. In the whole world, the number of people who can build a foundation model, so like one of the 100 or so big models that are on the various leaderboards, is about 5,000 people building them. And out of those, the ones working in the frontier labs are about 1,000, 1,100. So this is an unbelievably asymmetric situation. So you have essentially a bulk of the world who is completely blind to this, completely oblivious to this. And yet here in the valley, we get excited on a daily basis that, oh my God, this dropped and that dropped and what happened here. And so I think that fixing that asymmetry is a very, very important problem. That is something also for India. That is something I have spoken to folks in India about a lot. That needs to be fixed.
From your vantage point, as a former insider, what happens now to the services model? What happens now to SaaS companies? And I think that is the question that's being asked. And I don't know if we have any definitive answers on the way forward. As you look at it, is it all gloom and doom? Are we already prematurely writing obituaries? Or do you believe that the path forward could see these companies make the pivot, make the transition into an AI world?
No, that's a very important question. The answer is multifold. It is not a simple, straightforward answer. Does AI make it possible to do the work that we have done before dramatically faster and easier and cheaper? Yes, it does. I have examples where not just things happen 30% faster, but like work that would have been done by teams of people over years can be now done.
You were giving me an example where you were sitting outside on a bench quite literally and creating something that would have otherwise taken you years.
It was a very shocking personal example because that was years of my own life that I was able to recreate basically within less than an hour. And I just could not get over it for many days, that what the hell just happened. Because I built a system that I had a large organization that painfully built over years, that more or less a kind of a low fidelity version of it I was able to build in less than 1 hour.
In less than 1 hour, what had taken you several years to build previously?
An elite team that had taken 2.5 years of overtime, 500 people. Initially 100, going up to 450, 500 people, 2.5 years of our lives. Painful 2.5 years of working 15-hour days that I could basically redo in 1 hour.
By yourself?
By myself, sitting by myself, and it worked, and I showed it to people and they could not believe it. And so what does that mean, right? And I think we can look at it in these two ways, back to your question.